Guests, good morning, good afternoon, and good evening, depending on where you currently are in the world. Thank you for joining this session here in the room. We are delighted to welcome you, but also online for the people joining us from all over the world. I'm very pleased to welcome you to this research conference on the sidelines of the third edition of the Finance in Common Summit. My name is Carole Atumbre, and I will be your host today. Before even starting, I must say how humble I feel to be among you today, this morning. I explored the idea of a PhD myself a few years ago, and the first thing I was told is how demanding it is to do a research. So when I was told that I would be emceeing this session, and I had a look to the speakers and attendees, and I realized that you are all eminent scholars and researchers, I really felt excited to join this high-level conversation, especially as we will be paving the way for the future of development financing. This third edition of the Finance in Common Summit will focus on building a green and just transition that will allow for a sustainable recovery. A particularly relevant topic for us, as the world is currently facing major challenges, a lot of them at the same time, that seem to be altering the prospect of a better future. As the knowledge pillar of the Finance in Common Summit, this conference will aim at analyzing the crucial role of public development banks in creating the conditions for this transition to happen. We are here today in the presence of some of the most knowledgeable people in the field. And I would like to start by introducing two of them who played a key role in making this conference happen. I would like to call them to set the scene with their opening remarks. First of all, join me in welcoming Mr. Rémi Rioux, the CEO of the French Development Agency, also chairman of the International Development Finance Club, who has been instrumental in making the Finance in Common Coalition a reality. Mr. Rioux, please join me on stage. And the floor is yours.
Thanks a lot, Carole. I will speak in English. To thank you all and share how pleased I am to see you in person here in Abidjan to open this Finance in Common Summit, the third edition. I want to thank our co-hosts, the European Investment Bank, EIB, Ambroise is here, and also the African Development Bank that have embarked with us on this journey. And it was a journey. We started the initiative with many friends here in the room and online back in 2020. It was in a virtual Paris, and something happened then. And then we went to Rome at the invitation of our dear friends of Cassa Depositi e Prestiti, and of course it was hybrid, a meeting. And of course, even better, and the momentum is here in Abidjan to move forward the Finance in Common coalition. And of course, we are meeting at a very special moment. A moment of crisis, of course, a moment of urgency and tension, but also a moment where the discussion about the global financial architecture and is it apt to the challenges ahead is now, I think, fully open. We were in Washington last week, Ambroise and I, and probably many colleagues, and you've heard that this conjunction between Secretary Janet Yellen of the US Treasury on one side and this Bridgetown initiative launched by the Prime Minister of Barbados, Mia Mottley, and many colleagues, asking for a new vision, a new thinking, a new narrative about the global architecture. Of course, the question of reforming the World Bank was at the heart of the discussion, but we all know as fellow public development banks that I would say we are next in line. We are also questioned on our capacity to do more, to do better, to do differently. Question of a twin mandate is in the air. A mandate, of course, to be more specific, focused on the most vulnerable, being a green and just transition. Vulnerabilities out of poverty, but also because of environmental disruptions happening that we have to tackle together. So that's one. And the second mandate is about scale, is about mobilization, is about orienting our tools in order to unlock more investments, private, of course, but also public. And in the end, private through other public development banks. And stop, of course, opposing poverty and climate, as many of us are still doing it, despite the message that was phrased back in 2015 at the SDG summit and in Paris and in Addis Abeba. So finance in common, I think, is particularly useful at this very moment because we are providing scale, of course. You will learn about the latest database, more than 500 public development banks in each and every country, more than 10% of global financing that are at the disposal, of course, of political authorities with the capacity in their respective constituency to mobilize. So that's huge. And it's also, I think, a forum, a place of consensus. Governments sometimes are fighting. Private sector is competing. I never met the CEO of a public development bank for the last 6 years I do not agree with. So you have in between this layer of trust, consensus, cooperation, willingness to work together and to help find solutions with the other actors, stakeholders. This is what Finance in Common is about from the start. That was the intuition back in 2019, 2020. But of course, an intuition is not, and a pro domo manifestation is not enough. It's never been that from the start. And that's where it's so important to kick off this third summit with you and with a research conference. This is what we did the first 2 years. And so give the floor, the voice, initially at the start to academics, think tanks, policymakers, all those willing to pay attention and help us best position and understand the role of public development banks in their political economy, in their financial systems, so that we can play the most useful role. I want to thank all of you, of course, especially Jiajun, dear Stephanie, Regis, and all the colleagues from so many institutions that have prepared the program today, the research program. See the momentum here as well. I think back in 2019, this issue of the role of public development banks was not that big in academia, and I see these 18 new fascinating research papers that you've prepared to be discussed and released today on a wide array of topics, from the political economy of national development banks to artificial intelligence, to better understand what we are doing collectively, to the issue, heated issue of channeling SDRs through multilateral development banks, I mean, many things happening, and we are very proud with Ambroise and with all colleagues to have you here today. 4 questions will be addressed. To what extent PDBs can be instrumental for governments to serve public policy? So really the question of the mandates. Second, how can public development banks measure and report on their alignment with the 2030 agenda, a key issue that goes beyond public and also means a lot for private banking. Then this issue I referred to of the global financial architecture fit for the SDGs. And last, of course, a specific focus on Africa. We are here in Abidjan with very interesting case studies in Tunisia, Rwanda, Egypt, Côte d'Ivoire. We have le Forum des Caisses des Dépôts also happening here, many side events during this Finance in Common Summit to continue grow the momentum. So I stop here and thank you all. And we will carefully listen to the conclusions of this research day to feed in the summit itself that will start tomorrow morning. Thanks a lot.
Thank you, Mr. Ryu. Thank you for setting the scene. This is indeed a great momentum, and for that I would like to welcome Mr. Ambroise Fayol, Vice President of the European Investment Bank, co-organizer of the summit this year together with the African Development Bank. Welcome.
Thank you very much. Thank you all. Merci, Rémi. We, as you said, very pleased to be back in person. I would say the first summit was completely virtual. The second summit was half virtual. And now we are in a physical, much more than virtual. Let's hope that the move will continue. Very happy to be back also to Abidjan. First time in, I would say, at least pre-COVID. Now you divide time between pre and post-COVID. So it was pre-COVID for me. As you said, Rémi, we are just back from Washington, where the mood on economic situation was not particularly optimistic, including as far as developing and emerging countries is concerned. You see that the impact of COVID continues. The impact of the Russian invasion in Ukraine is also quite considerable. All this has created fresh economic problems, including lower growth, higher inflation, increased poverty, and turmoil on financial markets. Rémi, I think it's excellent that we start the Finance in Common Summit with 1 day of research, and that there have been so many papers that have been presented by our researchers, because we need to have some fresh air, some new ideas, some provocative ideas on which we can try to improve the work of public development banks. And actually, when you look at the program, I mean, I'm sure that the people here or online will be really interested by the way how public development banks can try to manage to be useful tools, how we can try to do a better job in terms of contributing to the transition, or as Rémi said, to set a new database of development banks and institutions. And really, this I hope that we'll be able to have some conclusions that will also be followed by internal thinking in our institutions about what we can do better and how we can learn from each other. And this is also the great thing with this big event, that we are not only among bilateral banks or multilateral development banks. We are all about institutions where the government has the share to see how we can learn from each other and do collectively a better job. In the final session, EIB also is going to present our EIB Finance in Africa 22 report. Let me just make a few teasing here, which will be launched formally tomorrow at the FIC. This is our annual report on the state of the financial sector in Africa, drawing on a survey of commercial banks. The survey is a crucial tool for EIB to understand the financing and investment challenges facing Africa banking partners, and to understand how to maximize our impact on the continent. And as you know, we have been very active for decades, but especially in the last 2 years to support more the economy through intermediate lending, through the support to climate and health projects. And we have lent last year 2.5 billion euros in sub-Saharan Africa. The report shows this year that while African banks have shown considerable resilience in dealing with the use of the pandemic, the war is creating new worries in areas such as the local bank funding costs. The rapid growth of fintech is also a source of concern, and that's something that will be developed later today, I guess, by Barbara. So a lot of things that are going to happen today. I'm not going to be longer. Let's listen to what researchers have to tell us. And like Rémi, I would like to wish you a very good day, and happy to launch this conference here. Thank you.
Great. Many thanks to Mr. Rieu and Mr. Fayol for the introductory remarks. As they just both emphasized, this event is particularly important as it will inform and enrich the Financing Common Summit and provide evidence on how to implement some of the recommendations that emerged from the previous sessions in Paris and Roma. Our agenda of the day will be as follows. Just to have a quick look at it, we will start just now with an introductory session that will focus on presenting the new database of public development banks. The session will be followed by the panel session on how public development banks can serve public policies. Then we'll break for 30 minutes to allow you to further the conversation, and then reconvene on a second panel on aligning development banking models with SDGs. The second panel will be followed by a lunch break, a very well-deserved one, I hope so. The third panel session in the afternoon will address the role of public development banks in the global finance architecture, and will again be followed by a break and networking session. I'm sure if it's your first time in Abidjan, you will also want to have a look at the facilities in the hotel. And then we will end up with a fourth panel session on African public development banks. Now, before going any further, allow me to share some of the house rules. Please note that the breaks and lunch will be happening in the room right next door. Each session will allow for Q&A at the end, if time allows, so please be patient. And for the people who are following us online, we are really happy to have you, and we hope that you will enjoy the session as much as we will do. Now, without further ado, please join me in welcoming on stage Mr. Rémi Smarodon, PhD in economics and expert in development financing, sustainable advisor for the French Development Agency. He will be leading the first introductory session on the database, as well as with Jiajun Soon. She's joining us online. She is the assistant professor and the executive dean of the Institute of New Structural Economics at Peking University. She will be joining online. Regis, welcome on stage.
Thank you very much, Carol. Thank you very much. Well, okay, so now we are going to enter into few details on the first data bank that we built together with an excellent partnership with the University of Beijing. and also the participations of some colleagues of AFD. I want to salute Lucas, Jean-Baptiste, and the whole team also, Wenchen, Beina in China, that also put a lot of efforts and contribution so that we get the data that we have today. Our roadmap for the presentation, well, first, do we have Jajun online? Is it working? Jajun, I want to salute you if you are here. Excellent, excellent. Most welcome. So, yes, I will need that, very likely. So the presentation will have 5 parts, really. First, we will, without detailing it, explain the motivation of why are we working so intensively for building up this database. And we'll present the foundation of what is a public development bank, a DFI, etc. What is this community of finance in common? How do we define them? Then we will present some facts and figures to you so that we can share with you the content of the database, some of it at least. Then we will present the last advancement of the base for 2022 and also some indicators that are coming out of that. And then we will present the future plans of the project that we have together again with INSEE, and to see how we can use this original research also to help researchers going further in the knowledge of public development banks. So, Jajun, probably I turn to you for the first part before taking over with the figures. So the floor is yours.
Well, thank you, Hedges. It's great to join the conference online. Let's start with the motivation for building the first database on different banks. So recently, the world is witnessing a renaissance of different banks worldwide. At the international level, to fill the vast financing gaps, China and other emerging economies have initiated the Asian Infrastructure Investment Bank and New Development Bank. And at the national level, both developed countries and developing countries have established or are planned to establish national development banks to achieve economic, social, and environmental goals. Indeed, development banks are potentially potent instrument for fixing market failures, incubating frontier market, and achieving economic structural transformation in a more equitable and sustainable manner. And the time is ripe to unleash their full potential for achieving sustainable development goals. However, in sharp contrast with the renaissance of development banks worldwide, in practice, there's a lack of in-depth academic research on their roles, governance, and effectiveness. A major reason behind the paucity of research is a lack of data. Few have systematically identified development banks worldwide, let alone collecting the first-hand data on their operations and development outcomes. So to fill the gap, the Institute of New Structural Economics at Peking University initiated the database project in September 2017, and then collaborated with AFD to devote tremendous effort to build this first global database on development banks. We hope that our pilot effort can lay a solid foundation for original research on development banks to unleash their full development potential, and to encourage more researchers with shared vision to join hands to claim the field. We have built this data visualization website to make the full data set available for both academia and practitioners for free. And in the past years, we have published a series of flagship database reports to share the latest progress in the database building. And we are very glad to see that our open source data has enabled experts from international organizations such as World Bank, the United Nations, to explore the role of development banks in tackling the COVID-19 pandemic and in driving the gender equality. Meanwhile, our original data has enabled researchers to rigorously examine important research questions, such as whether and how national development banks can provide long-term finance and has published their research in the top academic journals. So now let's move to the next part on the conceptual foundations on what are development banks. To build a credible list of development banks worldwide, we need to answer the fundamental questions. What are the key features that has to help to distinguish development banks from other similar institutional arrangements? After very intensive discussions and consultations with experts and practitioners, we have proposed a set of 5 qualification criteria to capture the identity of development banks. Only when an entity simultaneously meets all the 5 criteria can it be qualified as a development bank. So first, being a standalone entity is a prerequisite criteria. We operationalize this criteria by examining whether an entity has a separate legal status, dedicated personnel, separate financial statement, or whether it is not set up to achieve short-term specific goals. And these criteria help us to distinguish development banks from government credit programs, trust funds, and special purpose vehicles. And then criteria 2 and 3 take a step further to highlight the feature, what it takes to be a financial institution, which is a basic feature of development banks. So criteria 2 highlight that on the asset side, financial institutions need to use fund reflow-seeking financial instruments rather than pure grants as their main products and services. So what do I mean by being fund reflow-seeking? It means that an entity needs to deploy financial instruments such as loans, equity investment, or guarantees, whose business model must allow some form of repayment, capital dividends, or risk premium. This would help to ensure financial discipline upon their clients. And this criteria helps to distinguish development banks from grant executing agencies, such as foundations. And on the liability side, as shown in criteria 3, being a financial institution means its funding source needs to go beyond periodic budgetary transfers. In other words, development banks need to have financial liability on their balance sheet. For instance, development banks can rely on the sovereign creditworthiness to issue bonds on the capital market. And this criteria helps to distinguish development banks from aid agencies, who primarily rely on the budgetary transfer from the government to sustain its operation. And finally, criteria 4 and criteria 5 focus on the core and essential features of development banks, being development-oriented public financial institutions. So criteria 4 highlights, unlike profit-maximizing commercial banks, development banks have explicit official mandate to proactively pursue public policy objectives. Even though in practice, state-owned commercial banks may sometimes undertake policy lending, but these are not their proactive effort. These are the policy burden imposed by their government. And furthermore, criteria 5 maintain that to ensure that development banks are development-oriented, government need to play a steering role in setting their corporate strategies. The most straightforward operational indicator is for the government to act as the majority shareholder. And government steering can also be achieved with other means. For instance, guaranteeing bond issuance of development banks or offering interest-free loans. And this criteria for government steering helps to make distinction between development banks and the grassroots initiatives, such as microfinance institutions. So by consistently applying the above 5 qualification criteria, we have been able to identify public development banks, public investment funds, and public guarantee funds worldwide. And in addition, we plan to systematically identify the dual-module public financial institutions, which have official mandate to pursue public policy objectives, but behave like commercial banks by taking household deposit. We hope that our consistent efforts would help to identify the right institution to form the Finance in Common coalition. Well, now I would like to hand it over to Hedges to introduce the stylized facts of different banks based on first-hand data collection. Hedges, back it over to you.
Thank you very much, Jejun. Thank you. So now we have the definitions. We are capable of counting the banks. We can count our animals. And so that's the first surprise that we had. If you can put next slide. If there are only 4 figures that you want to take out of our presentation, these are the ones. I mean, doing this account and this systematic search all over the world, in all countries, we were able to identify 522 development banks fitting with the definition. And this is not counting yet the banks with a commercial mandate that are still performing also development mandates. So more than 154 countries, so they're virtually everywhere. Then computing the size of the bank, this is by just adding, arithmetically, the size of their assets, we reached the incredible number of 23 trillion. I'll come back to that. I mean, this is just a huge figure representing somehow 10 to 12% of global investment every year. So it's very meaningful. And it was barely known 3 years ago. I mean, everybody was having its own definition. There was some guess on the number of banks in the world. Now we have something solid based on a shared definition that permits us to identify the communities. And so one can say that they are not sleeping beauties anymore. They are to be revived and participate fully in the transition. Now, once we have identified development banks, they're very different in essence. And so how do you differentiate a community where you will find the World Bank, you will find the Cassa dei Depositi Prestiti, and you will find a national bank like the Rwanda Development Bank with us at the conference today? How do you differentiate that? So we also gave some thought, and we proposed a typology based on 4 criteria. And we are going to visit that. The first question was, who is the owner of the bank? That's the first criteria. The second, where do they operate? The third, how big their operation? And the fourth, what do they aim at? What's their mandate? So having these 4 criteria permits us to have a multidimensional vision on the banks and therefore assess their potential much better in their specificity. So let's start with the distribution ownership. And there are a few surprises, again, here out of the database. Well, the first one to us was that multinationals are 55. I mean, it's a big figure. We did not anticipate that there were so many. Of course, everybody have the World Bank, the EIB in mind, but there are many others. I mean, a lot of countries in their sub-regions have created their own multilateral bank at a smaller size, and it's proving to be a very efficient model to share risks, strengthen the quality of the emissions, and therefore their prices. And this is a model which is very common even in the regions. Just to quote some of the well-known banks of that kind, we have the CAF in Latin America. We have a Trade Development Bank in East Africa. You have the Black Sea Trade and Development Bank also for the Black Sea region. And somehow gathering countries that otherwise would not have many institutions in common. Another striking point, I think, here is the number of subnational banks. I mean, 111. 21% of all. I mean, this is a big figure that we did not anticipate either. So it means that even within the countries, a lot of governments, local governments, are deciding to have their own development bank, and this is usually below the line. I mean, a lot of these banks are not coming to international communities or whatever, and they have a crucial role to play at the level of territories. But then, of course, the dominant is that most PDBs are national banks. 356 of them, 70% almost of the total. So they're really the one taking the most place in the landscape. If we switch now to the second criteria, which is the geographical scope, this is only a portion of what you can see in the database, just an extract, because we've been cross-checking the banks with only a national mandate in their own economies, the one with dual mandates, the one with only international mandates. Again, here, various possibilities are there. But just to say that 53% of the banks are in fact concentrating on their national. And it tells us something, you know, for the fix in the possibility of cooperations between the multinational, the one that have this international mandate that you see here, only 6% of the total, usually strong, usually big, to team up with the national bank is something very interesting. You will see much more in the database. This just to give you the flavor. Next slide. Now you'll be interested by the asset size that we collected systematically when available, of course. But we see we have 61 banks for which we couldn't find any number because they're not publishing their accounts or their accounts are not available to us. For the rest, it's all blank information that we collected on the website through their published account or through their declarations. And we were able, again here, to have a very interesting typology between the mega banks. There are 11 banks in the world which have more than 500 billion assets. I mean, this is the size of a country normally. I mean, they're very big. Of course, EIB is one of them. But there are others, even at national level. And that's what's interesting because Cassa de Depositi is also one of the mega, KfW. I mean, governments have in hands also this fantastic and very powerful tool. Of course, I should quote the China Development Bank, which is one of the larger animal in our sample. Then you have the large banks, and you see that if you add up the 20 large banks with the 11 mega, you reach 88% of the assets. So it means that the distribution is really not equal. I mean, you have on one side a small bunch of very big banks, and a lot of smaller banks below 100 billion and even 20 billion assets, and the micro banks, you see almost 200 of them below 500 million US dollar assets. So that's also an interesting result out of the base and something that researchers can also appropriate now that we have all these figures. We'll come back to that with Jiajun in the new features of the database. Now we can change. The last criteria is to try to identify the mandate that they have. A lot of them have a flexible mandate, in fact. Mandate is not well defined. They are development banks, so they are multi-sectoral. But quite a few, you know, are concentrated on SME finance or international finance. It's the case of AFD, obviously. And you see also what is interesting out of the database. Very few are declaring themselves, only 3%, as, you know, banks specialized in financing local governments, municipalities, or you know, at grassroots levels of that kind. Then, and I go rapidly on it as the presentation is moving, and we have a few things to show still. We also calculated the distribution by continent. Well, it's distributed according what one would expect. It's basically equal. So one have to dig into the sub-region to really see where you have high concentrations of development banks and other regions where they are less numerous. So, Jiajun, now I propose to turn back to you for presenting the other features of 2022, what is completely new in the base that we have added and that causes us so much work and so much trouble this year. Jiajun, please.
Yeah, so in the past year of 2022, we have made consistent efforts to build our database on two fronts. First, we have systematically identified specific public policy areas pursued by donor banks in practice and completed a draft report entitled Arts is in the Doing, Public Donor Banks Serving Public Policies. So I will present the key findings in the first panel. So I welcome you to join for more details. And secondly, we have rigorously collected 7 quantitative indicators, including financial efficiency indicators such as profit before tax and net income from the year of 2018 to the year of 2020. So we plan to further conduct the quality control to ensure the accuracy of data. We also plan to conduct analysis to examine whether the financial efficiency of donor banks is statistically different from that of commercial banks, and whether and why financial efficiency may differ across different types of donor banks. So these are the new updates. And regarding the future plan of our database building project, we plan to focus on the following 3 aspects. First, we will update the list of donor banks on a quarterly basis by incorporating new qualified ones and deleting those that have been commercialized or abolished. And second, we will continue to use multiple data collection methods, including digital technology, manual data collection, and expert verification to collect and triangulate financial indicators. And last but not the least, we plan to conduct a questionnaire survey to collect the thematically focused data to make the original research feasible. And finally, to build a community of donor banks researchers, the Institute of New Structural Economics at Peking University has collaborated with AFD and the Research Institute of China Donor Bank to launch an international research initiative of PDB working groups back in the year of 2019. And we are very glad to hold the 3 successive research conferences in the past 3 years. And Professor Stephanie Griffin-Jones and Dr. Hedges Maradon and I have acted as co-coordinators to set up 5 thematically focused working groups. And we really want to become the knowledge pillar of this Finance in Common coalition. We hope that we can create synergies between this international research initiative and the Finance in Common coalition by setting parallel working groups among practitioners to foster policy dialogues and to turn the research into policy impact, to unleash the full potential of donor banks. And we really welcome your participation to make the research initiative as open as possible. If you are researchers that are keen to study donor banks, you can join us as co-researchers. And if you are practitioners from donor banks and would like to share your first-hand professional experience and provide feedback on research, you can join us in the policy dialogues. And if you are leading figures from either academia or industry, I would like to provide advice on setting the research agenda. We welcome you to join as advisors. We are very much looking forward to your feedback on our pilot global database on donor banks worldwide. Thank you very much.
Okay, thank you very much, Jajun. Thank you very much. Thank you to all for your attention. I hope you gathered few striking figures or interesting features, and we will now continue with the program. So, Carol, I leave the floor to you for the continuation.
Thank you, Regis. Thank you, Jajun. I did capture one of the figures, 522 development banks with cumulative assets of USD 23 trillion. That's a lot of money. And that is not bad at all. And I'm pretty sure it also reinforces the importance of public development banks and the role that they can play, provided they overcome the challenges that stand against their effectiveness. And this leads us to our first panel session this morning that is going to be moderated by Hélène Joffelkit, PhD in economics and director of the research department of the French Development Agency. Please be seated. Hélène will be joined this morning in the conversation by Diana Borocro, Eva Gutierrez, that I will also call to join on stage, as well as Florian Leon, as Mrs. Stephanie Griffith-Jones and Jejun, again, are going to join online. So, Hélène, I would leave the floor to you to add on this panel that is going to address the lessons to be learned on ensuring that public development banks can serve public policies. Thank you.
Thank you, Carol. Good morning, everyone in the room and online. I know that you are a lot of you online. As Carol mentioned, we will now be discussing the role of the PDBs serving public policies in a very specific agenda and time, because we are almost midway from the 2030 agenda to its SDGs, and the time is not as rosy as we could expected. Actually, the world has been hit by several crises. Of course, we had the COVID-19, the food crisis, the worsening climate and the biodiversity crisis, and more recently, the crisis led by the Russian invasion in Ukraine, which impacted a lot the developing countries. Those crises had a very important impact and setbacks in poverty and inequality reduction, as well as in development and human rights progress. The pre-pandemic 2.5 trillion investment gap for financing the SDGs has increased by 1.7 trillion due to the crisis. So in this context, we need really a big investment push from a quantitative and qualitative standpoints to drive the recovery and transformation needed to address the global challenges and contribute to the SDGs. So in that context, the public development banks have a paramount role to play since they are considered to be a strong policy tool for serving public policies in three main ranges of action. As mentioned already, the first one is to catalyze long-term finance for development goals. The second is to fill market gaps by reaching underserved sector or beneficiaries. And finally is to act countercyclically. So in this session, we will be addressing four main questions, drawing from this original database just presented, which allows researchers to extensively work on it, but also to original data collection or interviews led within the PDBs. So those four questions, the first one is, what are the main public policy areas in which the PDBs engage in practice according to their main characteristic? The second, what does a counter-cyclical response means and how PDBs played a key role in helping countries, beneficiaries, and households in coping with the COVID-19 crisis? The third question will address the lessons which can be learned from efficient national DFIs to inform policymakers opting to establish new DFIs or expand the existing one in the aftermath of the COVID-19 pandemic. And finally, we will close the panel with a focus on Africa and how public banks are lending in time of the crisis, but also afterwards. So to tackle all this issue, I have the pleasure to introduce the distinguished panel. First, Jajun, just online and with us precedently. We start addressing the first question. So just a reminder, Jajun is Executive Deputy Dean and Assistant Professor at the Institute for New Structural Economics of Peking University. And she has been involved from scratch in this fixed story with us. The second question will be addressed by Diana Barolo here, a senior economist at UNCTAD Globalization and Development Division. She's co-authoring the flagship Trade and Development Report, and she's managing research on development finance, South-South integration, and structural transformation and development. And Stephanie Griffith-Jones will take over the discussion as well on this second question. So Stephanie Griffith-Jones is an economist specializing in international finance and development. She is currently the member at the Central Bank of board member at the Central Bank of Chile, and she has been coordinated, as mentioned by Jajun, this extensive work with Regis and Jajun, this major research program on network and development banks. The third question will be addressed by Eva Gutierrez. She is the lead financial economist in the Latin American and Caribbean region of the World Bank. Eva is co-chairing the state-owned enterprise community of practice, and she has worked on state-owned bank reform in many countries through advisory and lending operation. And finally, Florian Léon will have the focus on Africa. So Florian is an economist research officer at the Foundation for Studies and Research on International Development and the lecturer at the University Clermont-Auvergne. So without any transition, I will give the floor to Jajun to first address the first question on the main public area where the PDBs are engaged. Jajun, the floor is yours.
So I'm very delighted to have the opportunity to present the latest flagship database report entitled Art is in the Doing, Public-Driven Banks Serving Public Policies. And this report is a joint effort between the Institute of New Structural Economics at the university and the French Donor Agency, and it is based on the first-hand data collection of the specific public policy areas engaged by UN banks worldwide. So let me start with the motivation behind the present database report. So in our last joint database report entitled Mapping 500 plus UN banks worldwide, we presented the stylized fact on the official mandate claimed by UN banks. In total, we identified 8 official mandates, and in the descending order of frequency, they are the flexible mandate, micro and small medium-sized enterprise, international trade, rural and agricultural development, social housing, international financing of private sector development, infrastructure, and local government. It is worth noting that about 1/3 of UN banks worldwide have a flexible mandate without confining their activities to specific clients or specific sectors. Yet little is known what specific public policy areas engaged by these UN banks with a flexible mandate, and whether UN banks with a specific mandate may engage in other public policy areas. And this is a gap that our team aimed to fill. So it is very important to go beyond the official mandate, that is what they say on the Articles of Agreement, to examine what they actually do in practice. So the core research questions that our report aims to answer are threefold. First, what are the main public policy areas in which public UN banks engage in practice? And second, what is the frequency of public policy areas pursued by UN banks? And finally, what types of UN banks are more likely to engage in a specific public policy area? So first of all, let's try to answer the first question. What are the main public policy areas undertaken by UN banks? So we have conducted a systematic review of official mandate and operating activities that PDB undertake. And we have been able to identify 3 broad categories of the public policy areas, namely clients, beneficiaries, economic sectors, and cross-cutting goals. Under the category of clients and beneficiaries, 5 public policy areas have been identified, namely rural smallholders, small and medium-sized enterprises, financial inclusion, that is unbanked and marginalized population, local government, international development financing, that is financing government or private sectors in developing countries. And the rationale behind financing of these clients by UN banks is that they are often credit rationed, unable to get access to finance from commercial banks or capital markets. And then under the category of economic sectors, we have identified 5 public policy areas, namely education, health, infrastructure, social housing, and industry sector development. Taking infrastructure financing as an example, it entails long-term and high-risk investment with positive externalities. As a result, financing public infrastructure often goes beyond the risk appetite of private sectors. And these market failures call for the bank to step in to fill the financing gap. And the third category of public policy area is cross-cutting goals, in the sense that different banks aim to contribute to economic, social, and environmental goals with various channels, such as serving a specific client or investing in a certain economic sector. We have identified 7 public policy areas falling into this category, namely trade finance, gender equality, climate, biodiversity, food security, innovation, and regional integration. Finally, it's worth noting that even though within each category, the identified public policy areas are mutually exclusive, the 3 broad categories may be overlapping with each other. For instance, achieving regional integration, this is a cross-cutting goal, may be done through financing infrastructure in developing countries. So to ensure the rigor and accuracy of data collection, we have designed a code book where we clearly define the concept of each public policy area and providing specific operational indicators on how to identify them empirically. And we also manually verify each data point with supporting evidence to ensure the accuracy. And now let's move to the key findings of our data collection. So regarding the question, what is the frequency of public policy areas pursued by different banks? From the figure, we can see that small and medium-sized enterprise is the most prevalent public policy area, followed by infrastructure and industry sector development. And climate is gaining prominence, as over half of different banks have engaged in combating climate change. By contrast, less than 1/5 of different banks have devoted efforts to protect biodiversity. So these are the key findings. And then after examining the overall landscape of the frequency of public policy areas engaged by different banks, we then take a step further to explore what types of different banks are more likely to engage in a specific public policy area. Here we classify different banks according to their ownership level, size category, income levels of their home countries, and geographical scope of their operations. In the interest of time, I have chosen 4 public policy areas to have a closer look. In terms of industry sector development, this figure shows that developed banks from developing countries tend to focus more on industry sector development. The reason behind it may be that as latecomers in global economy, developing country government have greater incentive to deploy development banks as a tool of industry policy to climb up the industrial ladder and to speed up their industrialization process. And then let's move to the next policy area, that is innovation. So this figure shows that the larger the development bank is, the more likely it engages in financing innovation. The reason may be that large banks are better able to take risks than small ones, and with greater risk appetite, large banks are more willing to venture into innovation financing. And the next one, international development financing. So this comes as no surprise. Developed banks from advanced economies are more likely to provide international development financing, and this mission is mainly implemented by development finance institutions established by central government from high-income countries, and their geographical scope of operation is primarily international. And it will be very interesting to explore how this type of specialized development finance institution has been structured in a way that enables them to better fulfill the mission of international development financing in the future. And then next, the climate. So this figure shows that development banks of larger size and from more advanced economies are more likely to provide climate financing. It also shows that multilateral development banks, on average, are more keen to combat climate change than development banks at the national or subnational level. So moving forward, it will be very useful to explore how MDBs can join hands with natural development banks by providing own lending to combat climate change together, and how development banks from developed countries can collaborate with those from developing countries through triangular cooperation to tackle the common challenge of climate change that go beyond the national boundaries. And then based on the key findings of our first-hand data collection, we have drawn 3 policy implications. First, development banks are potentially useful policy instrument for serving public policy objectives worldwide. And second, it is important for government to justify the niche of development banks in addressing specific public policy area so as to maximize their development effectiveness. And finally, it's also crucial to adapt the role of development banks to the changing development needs at different stages of development. And to conclude, our joint database report is our first effort to answer the important question of why do we need development banks. And for the first time, we are able to identify the specific public policy areas engaged by development banks in practice. And this is a core contribution of our joint database. This is the end of my presentation. Back to you, Helen.
Thank you, Jajun, for this very interesting and original presentation and drawing from this database and these new addings you have presented before, and which leads to very interesting picture and potentially recommendation you've mentioned. Thank you, Jajun. I will turn now to Diana for the second case question. Thank you.
Thank you, everybody. My telephone is my timer. I'm allowed 4 minutes, so I'm not here taking calls, just in case you're wondering. So first of all, thank you very much for welcoming us here to present our work with you. I'm bringing together today some research that's been conducted by Stephanie Griffiths-Jones with the FIC, and also a rapid review of public banks and COVID that I'd been conducting with Thomas Marawas and David McDonald at the Municipal Services Project. So together, our findings made us very aware that we need to know more about the counter-cyclical role of public banks. This is not their traditional role, but it's an increasingly important one. So my job over the next 4 minutes is to try and share with you some of our findings, and then my colleague Stephanie Griffiths-Jones will take the next 4 minutes. So it's really a very fast tour de force. I hope you'll read our report. We have put a lot of information in that, and we really welcome your feedback and your comments. So the approach. Okay, this is a research seminar. You want to know, how do we start? How do we do the work? We started by examining the loan approvals and disbursements for development banks, national development banks, regional, global development banks, from 2020 compared to 2019. And so our first starting point was, of course, this excellent database that we've just been learning about this morning. And thank you, Jajun, for that wonderful introduction to the next steps with that. But so we start with the AFD INC-based database, but then we went further by interviewing banks and looking at their annual reports and their websites. And from this, we gained really a more qualitative picture about what banks were doing in response to COVID. Stephanie and I then dug deeper with semi-structured interviews with senior officials in public banks. And in the end, we covered all the regions of the world. We had 3 development banks in Asia, 2 in Latin America, 3 in Europe, and 4 in Africa. And we had long, very detailed, very intense conversations with senior executives at these banks. And I have to say, we are very grateful that these banks were super enthusiastic and forthcoming, sharing their stories with us. For this great reception, we thank Régie, and we thank the Rémi and the colleagues at ADF who in some cases helped set up these interviews. Anyway, with the interviews, we started with a standard set of questions, but we soon moved off-piste and had much more specialized conversation depending on the particular situation of those banks. So at the end of the story, we had a huge database to call upon and a huge learning. So the first finding is that virtually every single bank that we interviewed tried their hardest to respond significantly to COVID-19. They were a powerful policy tool of their governments. And this is a new finding, and it's important that public banks were important counter-cyclical tool that governments could call upon. And there was increasing support and consensus that they should play this role. So that's a very important finding. Over 3/4 of the banks increased their commitments significantly, some by more than 100%. And even the smaller banks, maybe to a smaller degree, but they still were pushing the boat out to do what they could to provide breathing space and liquidity and working capital and all different sorts of mechanisms to try and support the economic shock. Also, the health shock, the shock to government revenues and public sector revenues as well. So in the report, we discussed very much what they did and how they did it, what kind of mechanisms. But I think maybe the most important finding that we came together, because I see that I'm running out of time, is that there are 3 really dimensions we want to emphasize. That the scale needed to be big to be impactful, and it needed to be fast. In this regard, banks that had already performed counter-cyclical operations during the 2007-2008 crisis, they could really move fast because they no longer had to discuss whether it was, there's my timer, excuse me, I'm going to take just a few more minutes. I'm going to take 1 more minute. Okay, thank you, thank you. So the banks that had gone through this before, they did not have to debate, is this our appropriate role? They knew already, yes, it's our role and we're going to do it fast. A bank that had not been in this experience before, a newer bank, was able to roll out very, very fast because they had spare capacity. They had extra capital that was in abeyance, waiting to be rolled out some years down the line. But they said in February 2020, so this is even just 1 or 2 months after COVID is really striking in Asia, they say, we can say that we are an infrastructure bank with a focused mandate, and we can stick to that. But if we do that, we'll suffer a decline in our business, and we miss the opportunity to help our members. So they changed in a dime. They changed what they were doing, but they could do it because they had spare capital. So one of the important lessons that came out of all of our research is this implications that if banks are going to be counter-cyclical, responding quickly and urgently when private capital is drying up, if they're going to do this, they need to be well capitalized. Now, this might sound obvious, but actually it's a point that really bears making because many of the public banks were already stretched to capacity before COVID-19. So one CEO of a major bank said how ideal it would be if development banks could have some spare capacity built into the system so they could respond quickly and at scale when crisis struck without having to negotiate additional capital. Some banks were able to negotiate additional capital. Some of the banks in Africa that we interviewed benefited by the fact they had just been able to get fresh capital from their government shareholders. But for many, this was a major, major stumbling block, especially banks that were not by law able to apply for funds in other markets. So I'm going to stop here. I'm going to turn to my colleague Stephanie, who is online here. And Stephanie's going to pick up the second messages about where can we find some new capital for these country banks, and especially to help developing countries. So, Stephanie, are you there?
I hope so. Can you hear me?
Yes. Super. I'm
you hear
leaving
me?
the podium. Yes.
Thank you very much. I'm delighted to be speaking at this important conference. We are continuing this process, I think, of renaissance of development banks, public development banks, and this important fixed process which started in Paris, went to Rome, and now is in Abidjan. I want to also stress the importance of counter-cyclical responses, and I think it's well illustrated by what Ambroise Fayol, who spoke at the beginning of this meeting, told us when we interviewed him. And he said that when the Eurozone debt crisis happened in 2010, there was a long discussion at the EIB whether they should be counter-cyclical or just focus on long-term. But then when the COVID crisis happened, there was no discussion. It was the need to be counter-cyclical became so evident. And as Diana said, this was the general attitude, I think, in many developing banks. I just want to talk briefly about the new circumstances that we're facing now, also from my experiences on the board of the Central Bank of Chile, and why I think development banks are even more important today. I mean, with the emergence of COVID, from COVID, we seem to have a new breathing space, but we had a remaining problem, which was inflation. As governments all over the world had increased spending on such a large scale, and monetary authorities had decreased interest rates. And so this led to a big inflation problem all over the world. But when this began to be fought by cuts in government spending and increases in interest rates, a new shock came, which was the Russian invasion of Ukraine, which hit all the world economy very badly and further accelerated inflation. And now, of course, with the US and other developed countries fighting inflation, they have started to increase interest rates significantly, and particularly impactful is the increase of interest rates by the Fed. This has started affecting emerging markets and developing economies further via, for example, putting pressure on their exchange rates, which further accelerates inflation. Thus, many of them have growing current account deficits. And a response to this, the traditional orthodox response, but the economics profession hasn't found a clear alternative answer fully, is to have fiscal tightening and monetary tightening, which of course lowers levels of growth, may lead to recession next year, or is beginning to lead to recession, and increased poverty, as chair of the session clearly pointed out. And also is discouraging both public and private investment. And this is happening at a time when we urgently need more investment for recovery, but also for the essential structural transformation to greener and more inclusive economy. We know that whatever the problems of inflation and others, the planet cannot wait. And we have only one planet. So we need really quite urgently to address the issue of inflation. And that's why I think the role of public development banks, multilateral, national, regional, and sub-regional, is even more important to help support this essential investment. I want to reiterate the point that my co-author, Diana, made about the significance of scale of the response. We saw that the response to COVID, the countercyclical response, was very strong. And as she pointed out, the banks that had large capital, and we interviewed, for example, the Asia Infrastructure Bank, Investment Infrastructure Bank, which had very large capital because it had been capitalized for the whole decade, was able to anticipate use of that capital and increased its lending commitments by 120% the first year of COVID, 120%. And it was able to do so, and that's the second element which I think is very important in countercyclical responses, because it had a very close collaboration, in this case, particularly with the World Bank, the Asia Development Bank. So it was a combination of having enough capital available, having the willingness to do it, but also the collaboration which allowed it to fund projects and programs that had already been studied by and evaluated by these system institutions.
You have 2 minutes left, Stephanie.
Development banks increased their lending very, very significantly. We have KfW, but we have the European Investment Bank itself, but we also have some African development banks, like the Uganda one and the Nigeria one, which increased their funding very, very quickly. I want to say that for some development banks in poorer economies, in BRICS and LMICs, especially in sub-Saharan Africa, it is very difficult to capitalize their development banks because their fiscal space is so restricted. And therefore, I think it's very valuable if governments from developed economies or their own development banks, like the EIB, like the KfW, like AFD, can support the funding provided to national development banks, for example, in Africa, which they have done during COVID times, but if they can continue doing that. But also, if they can use SDRs to facilitate, which have already been allocated, and where developed countries are not using their shares of SDRs because they don't need them, if they can use them to channel them, particularly to MDBs, like the World Bank and the African Development Bank, so that they can increase lending, particularly to the poorer countries.
You have 1 minute left, Stephanie.
Thank you. Because they are authorized holders of SDRs, so it would be ideal mechanism to capitalize these multilateral development banks, and they could then leverage their lending to the poorer countries. I want to finish by giving some good news, because it's always nice to have some good news in difficult times. I think we have the story that we have just had the creation by the US Congress, ratified by President Biden, of a new federal green development bank of $27 billion of capital. It has been a long effort, and it has resulted in a bank that will be committed to lending mainly for greening the US economy, and particularly in disadvantaged and poorer areas. And I think this will be a very good experience within the US, but will also provide a leading example to be followed by the rest of the world. And finally, I want to say from the Chilean perspective that where I've been participating in a commission that is trying to think of a future of development banking in Chile. And Chile is a country that has a lot of resources, is blessed with resources like copper, lithium, and green hydrogen potential, which are crucial for a green transition. And I think that there is a very deep commitment of current authorities to try and use development banks, national ones, but also hopefully attracting international finance to help support the green transition, not just in Chile, but also to export these key resources to the rest of the world to facilitate green transition. Thank you very much.
Thank you very much, Diana and Stephanie, for your presentation, which highlighted the effective role of countercyclical role of the public development banks, highlighting the importance of scale and capital ratio, and calling for new use of SDR. And it echoes a session we will have in the afternoon on the financial architecture. Now I turn to Eva. She will be talking of the lessons of the efficient DFIs.
Well, thank you very much for the invitation to participate in this conference. I have 8 minutes and a lot of things to say. Fortunately, I'm from Spain and we are quick speakers, so we will try to do it in the allotted time. I'm going to present a report that it was published last year, co-authored with my colleague Tatiana Klitsova, and I have been said that this is provocative, so let's see if I can provoke your reaction. Next slide, please. Just very briefly, in our report, we look at the countercyclical activities of development banks during the COVID crisis. Just to complement a little bit what Diana and Stephanie said, one thing that we saw, like in the global financial crisis, it was a lot of countercyclical activity. They went big. They went with lending at many times at subsidized rates and very generous warranties provided either by development banks or partial credit guarantee funds. And when I say generous, I mean up to 100% in some cases, for example, in Germany. What was different this time around, and that was surprising and perhaps related to the fact that there's some issues with putting capital in the banks, is that we saw the governments taking an unprecedented amount of risk on their balance sheet. So many governments, what they did is they passed liquidity to the banks, And the banks operated these funds off balance sheet. The government really took the risk, and the banks, they were really using their expertise to intermediate this funding. And we see this in many countries, in Germany, for example, but also in many other countries. And also we saw development banks lending using public credit guarantee to cover the credit risk. So basically the banks, they were not taking the risk. The partial credit guarantee grants responded by the government was taking the risk, and we saw that again in Germany and in Korea. So an impressive amount of risk taken by governments. I think this is a good thing in the sense that it protected the balance sheet of the development banks. It separated the war activities, so the crisis activities, from the normal operation of the banks. And it also increases accountability of the countercyclical activities, no? Because you have it on a separate balance sheet and you can identify better the impact. So, you know, we continue innovation. When a crisis comes, every time we think about new ways of how to intervene. Next slide. But, you know, Development Bank will continue to see the demand for activities, for support now in the post-COVID resilient recovery. And I think it's very important to ensure that the development banks learn from mistakes of the past and that they address the criticisms of the challenges of the development bank. I work on a development bank. I'm fully convinced of the need of one and the need of how to do it well. So this research doesn't focus on the why. Why do we need a development bank? I think it's clear, it's unquestionable. The question is how to do it well. And I think that there are three things that we learn from the past and that we need to address in order to ensure the success. The first one is to make sure that the development banks are effective. What does it mean? We are additional. It means we provide funding that the private sector is not funding. We need to be efficient. What does it mean? That we leverage our balance sheet. We try to put as little as possible of our money on the table, and we mobilize private finance money to support our development goals. And the third one is that we appropriately evaluate and manage and price the risk to make sure that we don't need to be bailed out constantly by the government and we don't become under criticism. So these are these three sustainable, these important challenges. So what we did in this paper is we look at successful development financial institutions to try to develop, distill some good practice on how they go about it. And what we find is good financial institutions, they are well aligned with the political mandates. They are a tool of the policies, but they have operational independence. And this is very important. So this slide summarizes, I think, the lessons of the paper. The first one is you have to have a mandate that is focused on complementing the private sector and catalyzing private finance. That addresses the efficiency and effectiveness. It's important that you use subsidized lending sparsely. So you make sure that you don't crowd out private sector, you stay innovative, and you limit the scope for corruption. So that speaks to the financial sustainability, so the effectiveness and the efficiency and the financial sustainability. And finally, it's important that you ensure that in your institution there is alignment of incentives with objectives, and that you do that through effective corporate governance, risk management, monitoring and evaluation. And with all of this, you have an efficient development institution. If in the context in which you operate, the situation is not conducive for you to have all of these things, and this is of tall order, then you can still be a successful institution, but then you better operate through financial intermediaries. You lend to other financial intermediaries, so you provide credit guarantees. You try not to operate directly. And now let me show you some examples of what I think are good financial institutions. First one is KDB. I love KDB. It's the most innovative bank that I know. It's a bank that is a key instrument of Korean policymaking, but it has superb risk management capabilities, industry know-how. Some people think that it's a think tank more than a bank. One thing that is very surprising about KDB is that the law that creates KDB, specifies that it's under the supervision of the Financial Services Committee, and if the KDB doesn't comply with the instructions of the Financial Services Committee, the Financial Services Committee has to take a series of actions that are detailed on the KDB law. So it's very subject to very intrusive supervision. by the Financial Supervisory Authority. And by the way, KDB is supervised under Basel III and large exposure, so international standards. KDB is a bank that takes a lot of risk. Corporate restructuring, startups, they are positioned in the frontier of risk, financing innovation. 2% NPL and financially sustainable. Why? Superb risk management capabilities. They don't receive subsidized lending. They fund themselves on the capital markets. What they do is they do some cross-subsidization, no? So from some commercial activities, they have high margins and they use it to subsidize some other products. They have two types of employees. The general employees that are hired under public contracts, public employment contracts, and the technical employees that they have particular contracts with payment and remuneration depending on the activities that they perform. And that allows them to have superb risk managers and experts on industry. And finally, as in all the state-owned enterprises in Korea, CEOs of the banks are subject to performance management contracts. The next is KDB, BB, British Business Bank. Created in 2014, so even development banks, very sophisticated financial markets, find that they need development banks in the last decade. And in UK, they created a bank because they identified that they have 3 problems with financing SMEs. They did a study and they thought these are the 3 market gaps that we find in the UK, and this is where our development bank has to be positioned. So they found is startups, is diversification of financial offering, and counter-cyclical activities. I'm not going to make it. Well, 1 minute. And then they say, well, we are going to create a bank that has 3 products. The bank is financially sustainable. They target a ROA that is the 5-year 10-year yield. They have key performance indicators that are used to determine the salaries and the promotion. They operate on second tier because they want to leverage private finance, and they are subject to the review of the National Audit Committee that publishes value for money reports on the BBB. And finally, just to show that in emerging countries you can also have effective financial institutions, Mexico, the case of FIRA, is an agricultural development bank, is a fideicomiso. They operate on second-tier bank, but they have a crew of agronomists, which are engineers, that structure the projects, and then they take the project and they send it to the private sector for financing. Why? Because they don't want that the great decision is influenced by political interference. So if it is financed by the private sector, it passed the market test. They are very innovative, first social gender in Latin America. They don't receive subsidies, and it's a great example to look at. And with that, thank you very much.
Thank you, Eva. Thank you, Eva, for showing that it's not sufficient to be a public bank and to be counter-cyclical to have an optimal action, and that prerequisite exists. Finally, let's focusing on Africa with Florian. And the final presentation before questions.
Okay, thank you. I'm glad to be here with you to discuss my new research about public bank lending in Africa in time of crisis. I would like to thank the organizers for inviting me and IFD, especially Regis, for financial support during this study, and Helen, obviously. So, next slide, please. This paper is an empirical paper, contrary to previous paper, about the behavior of public banks during crises in Africa. Why this paper? Because there are a lot of empirical papers about how public banks behave during crises in many continents, but not in Africa. The existing studies are focused on Latin America, global international data set, but not in Africa. The main reason is simply just the lack of data. So what I do in this paper, I study the behavior of public and private banks, and I compare the behavior of both during crises in Africa using a novel database. And I think it's important because Africa is different than other continents in both the environmental context. Africa suffers from many different shocks, but also because governance of banks, of public banks, of institutions is different in Africa. A second contribution to this paper is to distinguish between crisis and post-crisis period. Indeed, in existing studies, the authors focus exclusively on crisis period, but they don't see what's happened after the crisis is over. So that's why I try to distinguish between both periods. Next slide, please. So because we are in a research session, I briefly discuss the research approach. So it's an empirical paper. I uncollected financial information on the universe of private and public banks in 8 West African countries. Countries are all members of West African Economic and Monetary Union. I use the data from diverse sources, but mainly from Banking Commission and the Central Bank of the West African Economic and Monetary Union. And the advantage of this dataset is the full coverage of all banks in the 8 countries, contrary to international databases such as Orbis Bank or Fitch or the former Bankscope that covers between 1/2 and 70% of banks, and this international dataset often covers exclusively the larger banks and neglect many small banks and many public banks. So I then identify public banks using the information on ownership of banks each year by year, and I define a public banks. Just a brief word, I focus in this paper on public banks, not on public development banks. I group together commercial and development banks because the sample is too small to distinguish between both. So I define public banks as a bank where the main shareholder is a public entities, both local or national or regional. So my final samples after applying some filters is 112 banks over a period of 20 years. I don't have information on the COVID because it's an empirical data, it's an empirical approach, so I cannot get access to financial information in 2022 and 2020 in the post-COVID period. But I have among the all banks, 24 are public banks, and they manage over the whole period 15% of assets, and even 1/4 of deposits. My empirical approach is very simple. I first identify crisis period using GDP per capita growth, and I define a crisis period if growth of GDP is decline, significantly decline. And then I study the behavior of public and private banks during crisis and 3 years after a crisis. So the next slide from my main result. My 2 main results are the following. First, I don't see a difference between public and private banks during a crisis year. We don't see a difference between both, and we don't see a decline of lending during a crisis year. Okay? But that's very interesting is the post-crisis period. In the post-crisis period, we see that the public banks continue to lend at the same level, at the same, the growth of lending is the same before and after the crisis, but meanwhile, the private bank restrict their lending at the post-crisis period. And it's the main difference between public and private banks in the 8 countries under investigation. So I then try to understand by which channel explain the fact that public banks continue to lend after a crisis, and I prove that the main channel, one of the main channels, is the stability of resources of public banks. We see that the resources of public banks don't change during a crisis, while the resources of private banks decline after a crisis. And it's mainly due to the deposit in the private banks. I cannot test additional channels such as mandate because it's very complex to have information on mandate and it's impossible. And asset portfolio, I can't have precise information on the portfolio of lendings of both public and private banks. So finally, I try to understand if this counter-cyclical activity of public banks has a cost after the crisis. And therefore, if we observe a decline in public health or a decline in the financial ratio of public banks. And once again, I don't see a difference between public and private banks after a crisis when I focus on provision, for example, on return on assets. We don't see a difference. Just to briefly provide some recommendation based on this study, some of them are converged with a previous presentation. The first one is to provide public with the tools and incentives to have a counter-cyclical action, and one of the main important tools is the stability of resources, and we try to provide stable resources for public banks, and especially we can try to favor capital accumulation during normal time or during boom, to use this buffer in period of crisis, okay? Another possibility is to provide transfer from multinational or regional banks to national public development banks, especially during a idiosyncratic crisis, if one country suffers from a specific country. And another way to improve the stability of resources could be to create the new instrument of funding, such as cat bonds, that may take into account the impact of shocks in the resources. A second point is to create incentives to stimulate counter-cyclicality action. The first point is in relation with Eva's presentation, is the importance of employees and their incentives. We have to provide incentives to the employees to have a counter-cyclical action, so it's internal organization of public banks. A second one is more about authorities. There is a lot of discussion about the public support during crises, and it's the example of the COVID crisis, when different government transfer resources to public banks. Another one is a huge question about regulation. Should we change the regulation for public banks or not? I don't have the answer, but it's a question. Finally, I would like to move slightly the discussion.
Quickly, Florent, you are out of time. You are out of time.
Okay.
Very quickly.
Very quickly. So in this discussion, we focus on resilience. So it's a return to the ex-ante situation. But the question is, how can we continue to provide a counter-cyclical activity in a future with a multiplication of shocks? Because the time is too short to accumulate resources to use for the next shock. So mainly we have to think about beyond resilience to a view to fight vulnerability, okay, and especially structural vulnerability. And I believe that public development banks are very useful for this action because they are able to have patient capital, so to invest in the very long run. So thank you very much for your attention.
Thank you very much, Florent. We are a little bit late, but I think we have time for a few questions. 10 minutes, okay. So please, if you want to react, if you have any question, please don't hesitate. In between, so thank you all for your presentation. Maybe I will start with you, Florent, because you finished. So I would have a question. You mentioned that you don't see any difference during a crisis between the private and public profiles in lending, and that afterwards, you know, the public banks lending is not decreasing. The question is that against this background, can we consider that the action were sufficiently counter-cyclical? Because it's quite surprising.
Thank you for this question. Is a good question. It's very hard to provide an answer because I don't have some information about this. The optimal, I don't know if there is an optimal level of counter-cyclical activity. I think the question is not only about the volumes of lendings, it's also about the allocation of lendings. We have to support viable firms, households, to maintain economic activity. And beyond the volume, I think it's important to think about the composition of loans.
Thank you. Yes, please.
Hi, Yunan Chen from ODI. I have a question for Ava, but may also apply to the rest of the panel. And it was an interesting comment that you made about the business model of banks when you don't have all of the right kind of environment and conditions that you should then through financial intermediaries. So I wonder if you could elaborate on that, and in the context of a second best development bank model, and in the context of many developing countries where governance issues are present, what kind of best practices can we offer to new development banks or reforming PDBs?
No, thank you for the question. So in countries where we see governance conditions being an issue, lack of independence of financial institutions, the bank has been supporting the establishment of second-tier institutions. So development banks that operate providing either credit guarantees or financing to other financial intermediaries. Here, the key point is the point that I was making when I was presenting the case of FIRA. Credit decisions are taken by the private sector. And when that happens, although the banks can assume part of the risk through guarantees, when that happens, you ensure that the project passed the test of the market. To give you an example, FIRA is a very successful institution. There is another institution in Mexico that lends to the rural sector. Currently, it has 25% non-performing loans. There is a discussion of closing this institution. In first tier, they operate second tier, 10 creditors are 40% of the NPLs. There was something, and it's supposed to cater to the bottom of the pyramid. So you can imagine, the institution might not survive. It's an institution which in the World Bank, we operated with that institution in the past. It functioned very well. Institutions can go wrong very quickly. What we did in Nigeria and in Uganda, here in Africa, we helped set up Development Bank of Nigeria and Development Bank of Uganda. Both of them operate through second tier. We are working with them also to operate through platforms of platforms for financial intermediation. We thought that in these two cases, having the projects pass the market test will be conducive to the sustainability of the institutions. After all, if you are not credible and if you are not sustainable, it's very unlikely that you will survive.
Thank you. Maybe I would just add to that, or put a different view slightly, which is that private banks also have many faults, and we have many examples where private banks have not passed the market test. So I feel that we are sometimes holding the public bank to a sort of a higher level of performance than the private banks. One of the issues that is important, I think, is that, and we've sort of touched on this before, is how do we monitor and make sure that the banks are actually performing in the way that is expected of them. And this is obviously something that's important for all the banks. That we do see that the funds are used in the way that is needed. But the idea that public banks should just exist to carry the burden of the risk for a private bank and let the market decide that, I don't find that that's very compelling for the long term, because the public bank is taking the risk but not sharing the profit. And then at the time when they are suffering, somehow there's nobody helping them. So I would just like to say that the public bank also needs to be given the space and the support to be able to do its role well, and we certainly see that in the countries where the governments are really behind their public banks, they are able to do that, whether it's by guarantees or by the sense that credit rating agencies know those banks are supported, so they can continue to access the funds that they need. Maybe Stephanie wants to add something to this. I see you there, Stephanie.
Shortly, yeah. Stephanie, please. Yeah.
Yeah, I agree with what Diana said, and I think that when development banks don't work well, which is the case sometimes, I think the solution may be to try and improve them. Improve their governance, improve the general economy, and I think that it's important to have a full battery of instruments for development banks. Of course, second-tier lending can play an important role. Of course, co-financing with private sector can play an important role. But I think direct credit is also very valuable, especially if you have sort of modern industrial strategy, industrial policy, where you want to target certain sectors, for example, in the green transition, and you want to channel resources, both public and private, towards that. I think direct lending is a valuable instrument. And as Diana very clearly said, private banks are by no means perfect. So I think we have to always look where the smaller imperfections are. And in many cases, that may be public banks. So in other cases, it's private banks. So we, I think, have to be pragmatic and have a full range of instruments. Thank you.
Thank you, Stephanie. I will maybe, if you allow me, take 3 questions. Here.
So let me go then.
Thank you, San Bilal from ECDPM. I had a question for Diana and Stephanie. You mentioned that collaboration among PDBs could help them to be countercyclical. Could you explain a bit why? Is it because they do syndication and help reduce the risk, or are there other characteristics that collaboration helps them be more countercyclical?
I've got the mic. Oh, thank you so much. My name is Odwa. I'm from the Development Bank of Southern Africa. The question is directed to Diana. I just wanted to get a sense of your definition of counter-cyclical role, because you mentioned that you started, you mentioned that you started seeing the banks lending more, so it was more volume, speed. How about them, working towards more higher risk curve? Did you notice that they started to take more risk, going outside their mandates in some cases? Thanks.
I take a final question. Here. Yeah. Thank you.
Well, thank you, Prince Ajay, Development Bank Ghana. And my question will go to Eva on the, utilizing PFIs as a model for development banks. I wonder if you have some insight as to how the private sector decisions by the PFIs actually drove the activity of the development bank in crisis times.
Thank you very much for the questions. I'll have a first bash, and then maybe Stephanie, if you have something else to add. So the question about the collaboration between the public banks. So one of the banks, we've talked before about the Asian Infrastructure Bank. That was notable because even though it's one of the newest on the block, it had scaled up really enormously, 120%, and it was fast. And what they said when we interviewed them was that one of the ways they were able to do this was because they could benefit from collaboration with other banks. So this enabled them to scale up and spread out fast. So the AIIB sometimes provided the money, whereas the National Public Bank, or indeed even the World Bank, they would provide the expertise. By bringing the two together, they could roll things out very fast and very broadly. And by collaborating with national banks, they also started to operate in different countries outside their normal zone. So the AIIB had quite a few other countries that they weren't working in before, but they spread there because of COVID, because there was a need, because there was another bank providing the contacts, the connections, and the knowledge, and the AIIB had the money. So I think this is a very important example about how we need a diverse landscape of lots of different banks, all offering something different, but also, you know, collaborating together to use the synergies of their skills. And there were a lot of examples like that. Then the question about what is counter-cyclical, well, we were a bit rough and ready. I think we just compared commitments and disbursements the year before COVID and the year of COVID. Because as I said, we were doing this work very, very fast, you know, over the last year, using the data that we had to hand, and then trying to flesh that out with the interviews. But so we defined it as being an increase over and above what had been done the year before. Now, actually, that led to some quite interesting, some discrepancies, I would say, where we would speak to some banks that had the impression that they had been counter-cyclical in the sense that they had beefed up lending in different ways from what they normally did. And so they thought they were really increasing their offer to their clients and their countries. But in fact, when you looked at the aggregate data, they hadn't increased at all. They had just moved spending within the bank. So the people working on the COVID side of operations, they had the sense of, oh, you know, we're really pushing the boat out here. But when you looked at the bank as a whole, in fact, what had just happened was that spending had been moved from one activity to another. So that meant that things that had been necessary were now maybe not being done. And that's why we get back to this point about it's terribly important that they have the capacity and the capitalization, whether through direct capital or other ways, but, you know, this scope needs to be there. Then someone asked about taking on more risk or changing mandates. Yes, we did have examples where banks said, look, we're an infrastructure bank. No government wants to do infrastructure in the middle of COVID. Everybody is just scrambling to not drown here. So if we insist only on lending for infrastructure, we're going to have no customers and no clients, and we miss the chance to serve you know, the people who need us. So many of them changed direction. The New Development Bank, they did some initial loans for COVID that required special approval processes to be able to go through because it was different from what they were mandated to do. And after they'd done one or two of those, they realized that actually we need to formalize this. So they formally changed the expectation of what they were supposed to do. So then the subsequent loans didn't need to have that special approvals. With the AIIB, as I said, they made a change. They shifted, and they did it very, very fast. They did it by February, so that's only 2 months after COVID has been declared. You know, I don't judge me on the World Health Organization dates now, but it was very fast. But they have completely changed their direction very, very quickly. And they've even changed some definitions about what actually, what is an emergency. People used to think of emergencies or disasters as being related to natural disaster, like extreme weather events or conflict, but now we realize that actually liquidity crisis caused by a health crisis was also an emergency. So,
very briefly, to answer to the question posed by the Development Bank of Uganda, what we have seen on the way that private sector intermediaries were conditioning the activities of development banks. The private banks at the time of COVID, they needed liquidity in some cases because they were experiencing deposit flows, but also they needed to have more flexible liquidity. So what we saw is that many development banks, they were providing funding to financial intermediaries, but for example, with 1 year repayment grace period, that in that way, that flexibility could be passed by the banks to their final borrowers. Also, increased risk aversion, as we see in all the crises. So the ones that they were providing private credit guarantees, increased the guarantee. We saw many programs that normally offer 50% credit guarantee go up to 80%, 85% credit guarantee because they increased risk aversion. So through financial intermediaries, operating through financial intermediaries, you really can provide flexible instruments that allow to pass the benefits to the final borrowers.
Thank you very much. So we are at the closing this conversation. Stephanie, you wanted to add a word? No.
Just a quick word on the collaboration aspect, which Diana covered very nicely.
Sure.
I think there is a lot of collaboration between MDBs, regional development banks, NDBs, and even sub-regional ones, subnational ones. As a researcher, I think there is a problem that there isn't enough data on this collaboration, which is so important and which is particularly essential, I think, in the context of poorer countries like in Africa, where banks like the European Investment Bank, World Bank can provide, KfW, AFD, can provide vital support. And I think we need more research on that. And I think one aspect that I'd like to stress on collaboration is the sharing of expertise, which is actually what this conference today and the rest of it is about. It's a very interesting phenomena for me always, how much development banks share experience. When you go and interview a commercial bank, they're very reluctant to give you data because they're afraid you might share it with one of their competitors. Whereas development banks are always delighted to give as much data as possible to each other or to showcase what they're doing to others. And I think this is a great strength of collaboration. One thing that we were slightly concerned when we studied, when we wrote our paper with Diana and we did the research, is how much increase of risk that development banks have taken during the COVID crisis. A lot of it, as Eva rightly said, was taken by governments, but some are on the books of development banks. And to what extent are there risks that they may not be paid sufficiently, and how that should be evaluated? Perhaps also a further study, and whether governments should think about possible capitalization or support for non-performing loans. Thank you very much.
Thank you, Stephanie. So thanks to our distinguished panelists, thanks to Jajun, Eva, Diana, Florence, for this extremely interesting and Stephanie session. So we have learned a lot, and this database, the new one, has showed where were the public policy areas where the public banks were involved in, and with discrepancies. So this kind of taking stock helps the government to have a global picture of where we are and the push to be done in certain areas. The good news is that all the panelists have showed that the banks had a countercyclical role during the crisis. And the notion of countercyclicity has been asked. What is a good countercyclical role for the SDBs? And it has been showed that the capitalization was very important, and some call have been done upon changing the global architecture, and we will have a session this afternoon on this issue. We had a special focus on Africa lending, and here the public banks, the regional data show that the public banks were very countercyclical. And I have to say that we had a kind of view that public banks were not sufficient. The mandate of being public was not sufficient. What is important is to really be efficient, to have good governance, and to be driven by sustainability, financial sustainability, in order to have an effective action. So thank you for all these results. I think the discussion can be pursued at the coffee break if you want. Thank you for all the questions and the discussion.
Thank you, Elaine, and the speaker. Thank you. You can get back to your seat. Thank you very much for this great session. It's time for our first break. We are a little bit behind our schedule, so instead of a 30-minute break, we will take a 10-minute break. So we are resuming here at 11:15. Thank you very much, and I'm sure the speakers will be open to further discussions during the break. Thanks. We are going to resume now with our session. We're moving towards the second session of the day, which is a panel that is going to be shared by Sébastien Treyer, Executive Director of the Institute for Sustainable Development and International Relations. He is also the chairman of the Scientific and Technical Committee of the French Global Environment Facility and a member of the lead faculty of the Earth System Governance Network. This session will explore how feasible it is to align development banking models with the SDGs. I'm going to hand over to Sébastien, who is going to kick off with the session and also introduce the speakers. Thank you, Sébastien. The floor is yours.
An hour and a half, I hope. Thank you very much. It's good to see you all. I know that some of our panelists are online, and I'm really happy to, I hope that they are online. I can't see them for the moment. I think this is a very important session on the aligning of development banking models with the SDGs. And we have a very provocative question, that is it simply feasible? I did not choose the question, but I think it's very relevant to have quite a provocative question, because in the research conference, we are not there to say that everything is functioning very well. We also have to look at where progress needs to be made. I just wanted to stress, while people are still joining, we are currently in a very interesting, very problematic, but very interesting political and economic context. It's very critical because we are in a perfect storm that is also a long and perfect storm for major, a very important part of the developing countries, but also for the rest of the world. And I think we need to also look at this long and perfect storm as an opportunity for major changes. I mean, we all have heard last week in Washington discussions about an overhaul of the MDBs, of the multilateral development banks, the push by Mia Mottley from Barbados, even by Janet Yellen. And I think that's very interesting. I hear that it's both about taking more risks, pushing MDBs and the PDBs to take more risks, but also at the same time to finance more global public goods, climate, health, biodiversity. And I think what we need to discuss with this issue of alignment in this session is that we need to discuss to what extent there might be a trade-off between aligning with the agenda, with the 2030 agenda, aligning with the production, the provision of global public goods, aligning with the Paris Agreement and the SDGs. If this is only through an exclusion list, there might be a trade-off between that and delivering the financial flows that are needed in the countries most at need. So my first question, I think, overall is not just if it's feasible to align with SDGs, but also to discuss to what extent the fact to align with SDGs and to align with the climate objectives might be actually having detrimental effects somewhere. I don't believe it's the case, personally, and at IDRI we publish papers showing that it's not the case, but I think this is a very important question. So SDG alignment is not about excluding, and can we show this? I think this is very important. The other point that I wanted to raise as an introductory point is that it's now the third FIX and the third research conference. I remember 2 years ago, we had a starting point saying PDBs, and in particular the multilateral development banks, are not aligned yet with the 2030 agenda and its transformative nature. And the proof is that they are not aligned with the climate objectives. So we always use the climate proof to show that there is no alignment with the transformative nature. But we were lacking 2 years ago a global assessment of alignment or misalignment with the 2030 agenda. And I think this is something on which we need to look at if we have progressed in the two last years. The other thing that we already said 2 years ago was that there was a lot of innovative practices about what alignment with 2030 agenda could mean. And again, how have these practices prospered? Have they spread? Have they scaled up? This is probably also something we need to look at. So today the questions are, do we know more about the current state of SDG alignment? Have the PDBs, the Public Development Bank, progressed? And what are their current practices and how could they continue to do better? We have 6 speakers, and it's really showing the wealth of institutions that are looking at this question of SDG alignment, so that's very good. I think the moderator of the whole day told me I have 1 hour, and I hope that was 1 hour and a half, because that's on the program. Thanks a lot. No, I was just joking to ensure that we are on the right track. So we have proposed to structure these 6 speeches along three pairs of speakers. The first is about what is the state of play and how can we monitor these progresses. The second is really focusing on the discussion between, or how can we progress from looking at climate alignment towards looking at SDG alignment. And the third one is about processes and principles to continue progressing on what we understand and what we can do in terms of SDG alignment. And I hope at the end of the session we will say, yes, it's feasible. That's the question we were asked, but also how can we ensure that this is going to be possible. So I will first introduce the 2 first speakers that we have proposed to give the floor to. And it's about what do we know about the current status of SDG alignment in this ecosystem of public development banks, and what are the methodologies that could robustly help us to measure progress in this alignment. So I will give the floor first to Jean-Baptiste Jacouton. Jean-Baptiste is a research officer on sustainable finance at AFD, and he's also involved in coordinating the research initiative that we are discussing today, that in the framework of which we are discussing today. I think what is interesting is to see what innovative tools we can have to measure SDG alignment. And then we will have a specific Zoom by Martina Colombo. Martina is a seconded expert to the EU Commission, but she's initially from the Cassa dei Depositi Prestiti, CDP Italy, and she will zoom at how aligned or how could we monitor the alignment of the European Union public development banks and how they really are practicing this alignment with SDGs. So Jean-Baptiste, the floor is yours for 8 minutes.
Well, thank you very much, Mr. Treyer. So, as you have rightly recalled, during the 2 previous Finance and Commons summits, researchers have acknowledged that the Sustainable Development Goals are an increasing and daily concern for public development banks. But where do they stand collectively in achieving the 2030 Agenda? Well, if we want to have a comprehensive overview of the way they harness and they tackle the SDGs, practitioners and researchers alike are facing 2 main hurdles. Next slide, please. So the first one is that they do not share common methodologies when it comes to SDG reporting. Usually they use in-house methods that are based on qualitative assessments of their own projects, but the lack of common methodology is, according to a UNDP study that will be presented later, one of the 3 biggest challenges that public development banks face in supporting SDG investment. And second, the papers that focus on SDG alignment usually focus on a limited number of institutions because collecting the data demands expert knowledge and is very time-consuming. And it is true that as practitioners or researchers, we're faced with a flow of information, just like the flow of a river, while we would like to focus on what really matters, and that is SDG alignment. So our aim with my 2 colleagues from the French Development Agency, so Régis Maraudon and Aline Lolanier, was to explore one possible solution which would ensure a consistent, robust, and reproducible analysis of the way public development banks report against the SDGs. Next slide, please. So as such, we tried to analyze systematically public development banks' activity and sustainability reports with artificial intelligence. So I know that this can be a very frightful word, but you will see that the method is quite simple. So the SDG prospector, which is the name that we gave to our tool, is able to identify in any written text the paragraphs that are referring to one or several SDGs. So for this presentation, I will not dive too much into the technicalities, but what you need to remember is that the SDG prospector is not about keywords analysis. We are not counting keywords. We have been using the most recent available methods using deep neural networks to identify the SDGs in any written text in English. So for example, if a bank mentions the business climate in which it operates, the SDG prospector will understand that this has nothing to do with the bank's activities regarding the fight of climate change. So the tool is really able to understand the context of the sentences that it reads. So, as I will be showing in a few moments, our AI-based methodology allowed us to quantify the degree with which public development banks tackle each sustainable development goals. And thus, we were able to reveal, in a sense, the preferences in terms of SDG alignment, the preferences of public development banks. So in the end, we were able to map how 237 public development banks integrate the SDGs within the strategies over a 5-year period, so between 2016 and 2020. So we have been looking at different SDG narratives across several PDB typologies. And without further ado, I will present our main findings. Next slide, please. So the first thing that we see is that the narrative of public development banks is mainly structured around what we call the productive SDGs, meaning SDG 8 on economic growth and decent job creation, and SDG 9 on infrastructure, industry, and innovation. So this may result from the historical raison d'etre of public development banks in supporting SMEs and essential infrastructure to support economic development. But this may also stem from the fact that even though they're not intended to maximize the profits, PDBs tend to favor sectors with financially sound counterparties that are able to repay the loans. So the second striking fact with this graph is that we see that the biodiversity SDGs, so SDG 14 and SDG 15, represent a very low share of public development banks' narrative, and it's even close to zero. So, of course, there are differences across public development banks, with some having a higher focus on these objectives. But unfortunately, we might think that if these banks do not mention these objectives in their institutional documentation, then there is a high risk that they do not contribute much to these objectives, or at least these objectives do not seem to be the priority. And unfortunately, we see that with biodiversity, but we can see that other key sustainable development goals, such as the eradication of poverty or gender equality, also are very low in the narratives. Next slide, please. So then, if we focus on SDG 13 on climate action, we saw on the previous graph that it was about 5% of public development banks' institutional documentation. But we see that that is a growing concern for public development banks, and especially for the largest ones. So this result is consistent with other studies on SDG alignment, and this also confirms the strengths of our approach. So even though we cannot exclude a positive communication effect, this is a very encouraging signal that public development banks are progressively integrating the climate crisis into the strategies, and that there is a shift of the mandate towards greener investments. Next slide, please. So to complete this result, we found a positive and significant correlation between the size of assets of public development banks and their SDG narrative, which is targeted towards environmental-related SDGs. So it seems that the larger the bank, the stronger it is asked to diversify its activities. And investing in climate change adaptation requires a long time horizon with more risks than investing in short-term in productive sectors. So it is therefore likely that the small banks face higher difficulties in diversifying their mandates, their activities. So, well, for the sake of time, I only limited the presentation on the main results, but you can find many other insights directly in our paper, which is already published. But I hope that these main results will provide food for thought, first for today's conference, for other researchers in the future, but most importantly, for public development banks themselves as a reflection of their own activities. Next slide, please. Yes, thank you. So, to conclude, I'd like to say that the aim of our paper was not so much about qualifying the degree with which public development banks tackle the SDGs, rather than to demonstrate that artificial intelligence could be an efficient method to track SDG alignment. And I think the SDG prospector is a very effective and robust application of AI in that sense. And by the way, in early 2023, we will release an online application which will be publicly available and which would allow anyone wishing to obtain an SDG mapping of any written document in English. So you will be allowed to upload the document and get this SDG mapping. So that will be available early 2023. So to conclude, to monitor the SDGs, we need robust, reproducible, and objective methodologies. Our belief is that the use of frontier technologies is likely to accompany the rise and the quality of information that decision makers need to promote the necessary transitions. And for that, look, for example, at what is happening in the private sector. There are a growing number of factors which are integrating sustainable technologies in the financial system. And on our side at AFD, we're already working on future operational solutions to systematically analyze projects' portfolios. So we hope this will inspire the Finance in Common Coalition, its stakeholders, and that other projects, other innovative projects will emerge in the future. Thank you very much.
Thank you very much, Jean-Baptiste. So I will pass the floor directly to Martina Colombo. I hope Martina is online. Martina is a... Yes. Yes, we can hear you. Oh, yeah, and now we can see you with the beautiful Berlaymont behind you. Floor is yours, Martina.
Thank you very much. And apologies that I cannot be there with you in person. I am certainly in spirit, and I want to give you the perspective from Europe about you. In fact, the scope of our research paper is precisely including here based on the data that has been collected by the Finance and Common Coalition so far. On what is European is doing, is that Europe is doing this stuff, because I represent the community today, and our commissioner, in the last commission, is responsible for the alignment across the EU 27, and I participated last year.
Excuse me, Martina. We have. Excuse me, Martina, to interrupt. We have just a little sound problem. I mean, myself, I can't really hear you very well. I hope. I don't know if this is the same for the audience. Yeah. Maybe I don't know if you have a microphone that you could speak to closer. I don't know if that would help.
Yeah. Let's try. Can you hear me better like this?
Yes, it's better. Thank you very much, Martina.
Okay. Very good. So I was saying I will try to bring you the perspective of what Europe is doing vis-à-vis the alignment as well as European PDBs within the broader spectrum of all the 500 plus PDBs that operate around the world. Next slide, please. So my colleague Matteo Cuda, who is a PhD student at Business Economics Department of Brasilia University in France, we have investigated the behavior of the subset of all the 500 plus PDBs mapped by far within the research conference group. And we will be presenting the results that, not surprisingly, are in line with what Jean-Baptiste has just presented. We investigated in a more traditional way, kind of scanned the website one by one and see what the PDBs are doing in terms of SDG disclosure within their non-financial reports, if they have it. But then let's go in order. So, first of all, Europe has been monitoring, Eurostat has been monitoring progress of Europe vis-à-vis the SDGs since 2015. And in the year report that you see here portrayed in this arrow, we can see what's been happening over the past 7 years. So Europe has been performing relatively well on SDG number 1, on poverty and social exclusion, SDG number 7, on clean and affordable energy, number 8, on the economy and the labor market, and SDG 9 on innovation and infrastructure. It's actually not performing very well. Actually, it's going behind on SDG 6 on clean water and sanitation, and 15, life on land. Do you hear me? Just to check. Yes. Okay. And is moderately progressing on SDG number 2, number 4, 13, action was just mentioned, and 17, environment. Next slide, please. So, out of the 500 plus PDBs in the database, we concentrated, first of all, on 115 of them, operating the European-based PDBs, but we actually then zoomed in to the 59 PDBs that operate in Europe, either at local, regional, or national level. So we excluded the ones that operate primarily international. Out of these 59 PPIs, we investigated what we do in terms of SDG alignment. With the detection based on 4 criteria: no disclosure, low disclosure, so we simply mention SDGs in the website that do not really have a non-financial full report disclosing performance against the SDGs. Average disclosure, meaning that they're doing okay, they do it, but maybe not so systematically. And high disclosure, the ones that comply 100% with what we would consider full SDG alignment report. Out of these 59, 42% show some level of disclosure, and the bigger ones, so the mega ones, large ones, the medium ones, 100% comply with a high disclosure requirement criteria. 34 PDBs, so 58% of the sample, do not disclose SDGs. What does this mean? Next slide, please. This is what, in aggregate, the performance looks like. So, compared to the performance of Europe, how are these PDBs that operate in Europe respond to the alignment? We see something interesting, actually. We see that SDGs related to the Green Deal, so affordability in energy and climate action, are counter-cyclical. So Europe, we saw, was performing not so well under climate action, quite well under SDG 7, but the PDBs somehow push alignment towards these two institutions. Whereas they do not really shine vis-a-vis SDG number 2, zero after, and life below. The rest is more or less in line with the performance of the new member state, the new 37 member state. Next slide, please. So we saw that out of the 59, more than 50% was not disclosing SDGs, and 42% was instead contributing to the graph that we have just seen. So, in our view, we have 3 main big findings of this research. First of all, the size matters. So there is a positive correlation between the size of the PPI and the level of sustainability disclosure that they provide. The preparation and disclosure is costly, of course. So bigger ones have become more organized to present full disclosure of the data. And also, another point that we would like to make is that the non-financial reporting directive that was issued by the European Commission does actually, as of now, apply only to large output-just companies and output movements. As a second finding of the research, we would like to present the fact that the PDBs disclose the SDGs that actively contribute to the climate objectives. So this is good news. So SDG 7 and SDG 13 are the most disclosed. So PDBs are really making an effort to try to contribute to the climate objectives. And SDG 8, 9, 11, and 12 all closely, but this is pretty much in the nature of these texts that support the local economies. And as a third finding, we'd like to point out that there are a couple of SDGs that are really left behind. One is SDG number 2, as we saw, is hunger, and the other one is life underwater. And if SDG 2 can be excused somehow in a European context where the per capita income is relatively high, SDG 13 really should draw the attention of the policymakers. So to sum up, and to reply to the question, do PPIs align to SDGs? Is it feasible? Is it divided? Actually, we can tell that PPIs in Europe are actually trying to do their best to cooperate with these requirements, try to show what they're doing to the SDGs. They're well aligned with the European policy targets. They promote growth and intervention in the classical policy areas like focus on automation, infrastructure investment, innovation, social and human capital development. And they play the counter-cyclical role by also pushing the economy to the sprint of the business cycle and trying to really create an impact where we see that Europe sometimes is lagging behind. As future development of this research, next slide please, we will be investigating more in detail how our single EU member states, so we presented the overall picture at European level, but not what each single member state is doing, are performing vis-à-vis the SDG alignment, and how their national promotion events contribute to such performance. And to give you just a taste of what we're working on, I show you the Italian case. So we see that essentially what we're planning to do is to map the behavior of the single member state within the European context, and what the PDBI is going to contribute to the alignment. So the graph on the left represents how Italy is performing vis-à-vis the European average, and we see quite a number of SDGs where Italy is lagging behind, SDG 10, 17, 8, 9 as well, 15, 4, 2, to give you some examples. And once the Italian PDBI, that in this case is one that is disclosure of the SDGs, so now we map as high level of disclosure of research, is contributing. Yeah, not certain counter-cyclical of PDBI vis-à-vis the low performance of Italy. One thing again, this is that even in this case, it could be put in for some reason of neglected. I kind of teach the 0 to 400 my associates and season. We would like SDG 14 to be mapped by PDBIs as much as possible. Thank you very much.
Thank you, Martina.
Next slide if you want.
Thank you for. Thank you very much, Martina. I think now we will take 10 minutes for questions to these two first speakers. You've seen a lot of convergences between the conclusions of the two papers. In particular, I think what is extremely interesting is to see how different tools can tell us about the disclosure, but also not just the disclosure about, so behind disclosure, I see not only the issue about how PDBs talk about their strategies, but also about their outcomes and impacts. And I think this is really something that we need also to differentiate. It's not because they say they integrate SDGs in their strategies that it's actually delivering on the ground. And I think this is one of the key discussions we might have. I see also that both show that the largest PDBs are the ones that disclose most about SDGs. And the last finding that is very convergent is that biodiversity is, for instance, is one of the SDGs that is not very much talked about. And I see, to some extent, no wonder behind that, particularly on oceans, because it's not sure that many of the PDBs are actually investing in ocean-related activities, or at least maybe marginally. But it's, I think this is very, very interesting to see to what extent we could dig inside that to look also at how behind these disclosures, you might also look at the potentiality that there are harms to biodiversity that are not taken on board, so the trade-offs between economic development and biodiversity, or positive nature that are not accounted of. So net biodiversity positive development is maybe not accounted for because it's accounted for under development. So these types of things might also be interesting to discuss. I don't want you to answer my question. I was just showing the lot of the convergences, and I'm looking into the audience to see if there are any questions. Yes, please. Could you bring a microphone? Okay.
So thank you, very interesting. Let me ask a question. To what extent are we measuring PDB alignment with, so let me rephrase the question. To what extent are the results measuring PDB alignment with SDGs or national policies alignments with SDGs? Because, for example, while all the European countries have subscribed to the SDGs, when you look at the national development programs, you don't see that the documents mention all the SDGs in particular. So I think that it might be that European policies, the PDBs are perfectly aligned with the national development programs. It's the national development programs which are not perfectly aligned with the PDBs. So I wonder if you had explored matching up the PDBs SDG alignment with the documents to see how well they reflect the policy priorities at the country level.
Thank you very much. Just seeing if there is another question. I don't see one. So Jean-Baptiste first. And, oh, yes, sorry. Another question just behind you. The microphone is coming.
Thank you. My question goes to the gentleman that presented on the app or the AI presentation. I was just wondering, in the sample size used, were there African PDGs that were used as part of that sample? Because it would be interesting. Well, you said they didn't, in terms of SDG 1 on poverty, that wasn't high. And I was just wondering if, what was that sample size? Just because I think for Africa, those sort of indicators would actually score highly. But if they weren't taken into account, then that would explain their non-appearance or their quite low appearance.
Thanks for these two questions. Jean-Baptiste first, and Martina, if you want to comment afterwards.
Yes, thank you. So thank you very much for the questions. So on the first one, on national policies, I think you're right, Eva, to recall that SDG alignment can really be assessed regarding national policies. And in fact, we do not expect all public development banks to be fully aligned on the 17 SDGs. And so this is something indeed that we had in mind. Now, comparing each public development banks or maybe the complementarity across national development banks or some national development banks in a given country, this is something that we haven't done yet, but this is an ongoing project, and this is something that we want to explore indeed to see whether there is complementarity across institutions. And I think that's also an interesting subject, an important subject regarding governance, to avoid maybe double action in a country or to have specialized institutions in a given field or in given SDGs. Now we also have to take into account interactions. This is something that we haven't been looking at yet, but it's a project for the future. Thank you.
And on the question about African development banks in your sample?
Yes, and the question about African public development banks. So indeed, we looked at geographical differences across public development banks. So we have some African development banks in our sample. But what we've seen is that there are not that many differences, from one continent to the other. So we see, for example, that in Africa, we also see at the top of the SDG pyramid, SDG 8 on economic growth, is SDG 9 on infrastructure, industry, and innovation. Now, what we see for African PDBs, indeed, we see that poverty is a bit higher in the narrative than for other public development banks in other continents, but it's not overwhelming. You see, it's still very modest, below 5%. But the SDG that we see most prominently in African PDBs is also SDG 2 on food security, and that one ranks higher in African PDBs.
Thanks a lot. Martina, maybe you want to comment on this issue of what do we measure? Do we measure SDG alignment of PDBs or of the national policies and programs that are driving the PDBs?
Indeed. Because precisely the idea would be to try to also see if there is a convergence from European to national and PDB level. So maybe the second part of our research, we will be digging more at single member state to see what is actually working and not working in terms of also convergence of the messages that in this case the European Commission would pass on to the member states and so national government, national plans, and then to the PDBIs. What we can say is that since the European Resilience Facility regulation was passed, there is a bit more alignment, at least in more recent years, between what the European Commission is asking member states to do and what they are doing at national level with their national recovery and resilience plans. So to be further investigated for sure.
Thank you very much, Martina, Jean-Baptiste. We will move to the second pair of speakers. I think your statement of what we know about SDG alignment is still in progress. Our capacity to monitor that is still in progress. What we did already 2 years ago was to have a look at climate alignment. Why is it important? I said it in the introduction. Climate misalignment is the proof of not taking into account the transformative nature of SDGs. But that would not be completely sufficient. What I think is really interesting is to see at how alignment with the Paris Agreement is how public development banks manage to have co-benefits on development and climate. And so kind of a small-scale experiment of how to align with 17 objectives by trying to be at least aligned with 2 at the same time. And so this idea of multi-objectives is, I think, at the heart of what we try to look at when we look at climate or Paris Agreement alignment of PDBs, climate being an integral part of the 2030 agenda. So we first will listen to Nicole Pinko. Nicole is a senior economist at Climate Policy Initiative. And what Nicole does is to evaluate the real economic impact of financial sector net zero commitments. Which is, of course, a central question today that is at the heart of the credibility of the results of all what we discuss in climate in Glasgow, etc., etc. What Nicole has been doing is do a focus on the PDBs of this community of PDBs, the Finance in Common community. And so, Nicole, what do they actually do in terms of climate alignment? And I'm going to give the microphone to to Nicole. Thank you very much.
No, Nicole, she's online.
She's online. Yeah, okay, sorry. That was my... Nicole, please. Are you with us?
Thank you. Yes, can you hear me all right?
Yes.
Perfect, thank you. So apologies for any background airport music, and I look forward to seeing you all in person in just a few hours. If I have connectivity issues, I'll just turn my camera off and hopefully that will help a little bit. So if you could bring the slides up, please. Great. So we really took a look at what public financial institutions were doing on climate commitments, including investment tracking and divestment exclusion activities. And we really undertook this goal to better understand the current state of public financial institutions since they play such an important part in reaching our climate goals. And we've also had so many public and private financial institutions in the last couple of years announce climate commitments, but it's so difficult to tell who's making meaningful commitments, whether the announcements are actually leading to real action, and ultimately how it all adds up to a real economy impact. We also did explore the private sector commitments earlier this year, and that's published in a separate report. But for tracking the public sector commitments, so CPI used primary and secondary data on the climate commitments and strategies of the 70 largest public development finance institutions in the Finance in Common data set. So again, this includes DFIs, multilateral, bilateral, national, and subnational development banks, mortgage and securitization, and public housing agencies, policy banks, and export credit agencies. So together, these 70 entities represent 95% of the total assets held in the Finance in Common data set and are equivalent to about $20.4 trillion in US dollars in assets. And so in the graphics here, you can see the diversity represented by these 70 institutions across location and regional focus on the left, and by size and type of institution on the right. Next slide, please. So as you can see, most of the assets in our sample are in the US and Canada, where there are 6 institutions, but they have significant assets. And then we also have Western Europe with 20 institutions. In East Asia and Pacific, there are 13 institutions that hold a total of $6.2 trillion USD. But most of these assets are actually based in a handful of Chinese banks. We cast a really wide net in categorizing global and trans-regional institutions as well. And so right now, all the MDBs in our data set are categorized as global. Next slide, please. And so to support this work, we created a taxonomy for tracking climate-related finance commitments and strategies that was aligned with the necessary action metrics put forward in our framework for sustainable finance integrity. And the team really developed an automated data scraping and processing pipeline for this collection, using advanced data extraction and machine learning tools to collect primary data from financial institution websites and annual reports, and secondary data from news reports. We also had several key lessons that we learned over the course of this work, since it was such a large undertaking for us. The first is that data collection is only possible where data is disclosed. It's really important to understand what gaps are due to confidentiality issues and what ones are actually because of a lack of commitment or a lack of data. The second is that automation can help with data collection, but the differences in the data disclosures and the quality of those disclosures really means that manual quality checks are still needed. And then finally, again with that desk research, significant desk research was needed to assess the climate commitments of entities outside of the MDB and DFI universe, really trying to dig down into those smaller national and subnational entities. Next slide, please. So overall, our findings show that a lot still needs to be done to increase ambition across nearly all the public financial institutions to be better aligned with the goals of the Paris Agreement. On the slide, we have the percentage of commitments by institution number in red and percentage of commitments by financial holdings in orange. So this graphic does show that some progress is being made, particularly in regards to institutions with large assets or financial holdings. But digging into the details is a bit less exciting and less rosy. So on that first metric, Paris alignment, just 20 of institutions holding 25% of the total tracked assets have set a net zero or Paris alignment target. Outside of the MDBs, only a handful of institutions have set these targets, and where they do exist, they often lack an interim target for that short-term action. For the next metric, within climate finance and sustainability goals, just under 50% of our 70 institutions have made any sort of commitment to increase climate or sustainability finance or investments, and the existing commitments tend to lack details on sectoral and geographical allocation of new financial flows. Then less than a third of our sample have an exclusion or divestment policy for fossil fuel investments, and only 9 institutions in our sample had an exclusion policy without any exceptions or caveats. And then lastly, public financial institutions have also been very slow to adopt an institutional strategy on climate, at least that they make public. And especially this counts for strategies on adaptation finance. Just over half our sample has publicly mentioned a climate strategy, but only 6 have publicly mentioned adaptation as a key part of that strategy. And we were especially generous in our evaluation of this metric, so still finding that only 54% of our sample had any strategy-related commitments is a bit concerning. In general, overall, we found that smaller institutions, particularly outside the development finance institutions, received a lot less scrutiny from civil society and appeared to have some less incentives from climate action. We also found that there was a slight disconnect between national policies and national subnational development banks, at least on the climate side. So in our sample, 33 national public institutions operate in a country with a net zero policy, but only 4 have a net zero or Paris target. And so this kind of is a significant and surprising gap between national policies and PDBs that seems like an easy gap to close. So that's one I want to focus on. And in total, for public financial institutions, we're only 24% of total public FI assets, at least captured in our sample, have made a net zero or Paris alignment commitment. And this is actually falling behind what we found in the private sector, where 32% of global assets under management had a Paris alignment or net zero target. Next slide, please. So we came away from our analysis with a number of recommendations for public financial institutions, governments, and global financial coalitions. And there are a number of more detailed recommendations outlined in the report, but I just want to hit the key ones here. So public financial institutions need to commit to Paris alignment or net zero, and they need to create interim targets to help them meet those strategies and commitments. So this includes developing a strategic approach to Paris alignment and a strategy to mainstream climate change throughout an institution to better identify and manage risks and opportunities. Governments need to engage with public financial institutions and support them in centering climate action. This includes helping them implement the recommended changes and helping them increase resources for climate action. And in global financial coalitions, and what could be our most controversial recommendation here, we really do want to see something that's similar to GFAM sector side. There definitely have been a few coalitions in the past, but they tend to lack, teeth to them. Like there's no accountability metrics there. So we really want to help create an organization that can help define and recognize ambitious commitments from public development institutions, provide benchmarks, guidance, technical expertise, and really foster knowledge sharing and capacity building. And we think that particularly because we've seen so much action from the MDBs, as other people have mentioned.
Nicole, I think we just lost you.
Oh, apologies.
You're back, you're back.
All right. I've turned off my video. Hopefully that will help a little bit. But mostly saying that, you know, we've talked to a lot of financial institutions, and as others people have mentioned, we've seen some aggressive and ambitious action from the multilateral development banks, and we think that there are some great ways for that ambition to trickle down into some of the more national or subnational banks as well, to create sort of a knowledge building and best practice sharing opportunities. So just to wrap up, we did find that in our research, there were just so many other areas that we felt really had an opportunity for further research here. So as people have mentioned, really trying to dig down and define the role of subnational financial institutions. You know, what is their role on climate, and what can we reasonably expect from them on climate? Also, how do we define, you know, the role for emerging markets, developing economies, and some of these really specific banks like import-export banks and policy banks. So looking forward to working with everyone on that in the future. Thank you.
Thank you very much, Nicole. That was really clear and just on time. Thank you very much for that. I think we have not a similar, but a very interesting parallel speech by Laura. Laura Sabogal is policy advisor for sustainable finance at E3G, particularly in the public bank teams, and you operate public bank climate tracker matrix. So what's your assessment of Paris alignment and how it relates also to SDG alignment?
Thanks a lot. Let me just very quickly adjust this. Yes, so very interesting question. So I'm very happy to be here to share some insights of E3G's Public Bank Climate Tracker Matrix, which originally started as a report and is now an online living tool on our website. So yeah, to the question about how we can actually find balance and how we can tackle both goals of SDGs and public and climate action, I would like to first state the reasoning behind this work that we have been conducting since 2018. As we face the climate crisis, public and development banks have the opportunity and the imperative to lead the climate transition and to deliver the Paris Agreement goals. In line with this, most multilateral development banks, as well as bilateral development finance institutions, have pledged full alignment of all new investments before 2025. However, there is still no common alignment methodology, as some of my co-speakers just mentioned, and most institutions that have come forward with such pledges are currently in the process of establishing their own internal processes for this purpose. Against this background, E3G's Public Bank Climate Tracker Matrix aims to make transparent the extent to which these public banks are mainstreaming climate change, but also sustainable development goals in their work, whilst also providing evidence-based recommendations and identifying areas of best practice amongst institutions. So the tool provides greater granularity to the Paris alignment approaches proposed by the European Development Finance Institution Group, the International Development Finance Club, and the Joint Multilateral Development Bank Group. This results in a framework constituted by 15 metrics, which have been broadly categorized using the 6 building blocks of Paris alignment, which were defined and proposed by the Joint MDV Group, namely climate finance, climate risk, resilience and adaptation, internal activities, mitigation, engagement and policy support, and reporting. So within each of these metrics that E3G has further broken down, each public bank is scored as either unaligned or some progress, or Paris aligned, or if they reach and are really doing wonderfully, transformational, depending on their performance. So specific details regarding how these benchmarks and how the banks fare are then available in our website. So it's very clear how this assessment was actually reached. So now that was a little bit of the background, and here in the screen you can see at the left you see the different building blocks proposed by the different groups of banks that I just mentioned, and at the very right you can see how E3G has broken all of those metrics into these 15 more granular factors that we take into consideration when assessing these banks in their level of alignment. So that was a little bit of the background. Next slide, please. And next slide, because this is where you can see, how we divide and what are the benchmarks. So some of the main results of this ongoing work, as I mentioned, this started in 2018. By now we have assessed more than 15 banks are in the currently updating and adding new banks. I'm very happy to share with you that AFD will be uploaded in our website by COP27. So if you're keen to see how AFD is faring in this way, please head there. Some of the results. So what we see is the alignment of public banks with the Paris Agreement and, of course, with Sustainable Development Goals is an ongoing process, which is unfortunately not necessarily linear. Since 2018, when this tool was established, there has been massive progress towards alignment. However, this progress still remains mixed. Some institutions have very strong performance on a specific issue. So, for example, the African Development Bank, the Japanese International Cooperation Agency on Adaptation, also worth highlighting AFD and their very innovative tool on sustainable development mechanism, an opinion mechanism, which they use in their assessment of the process of the projects to both factor in sustainable development considerations, but also climate action and how it is mainstreamed. Other examples of these are, for example, the European Bank for Reconstruction and Development on energy efficiency, which they have extraordinary policies in this regard, or the European Investment Bank, and again, the French Development Agency on fossil fuel exclusions. Nonetheless, the current geopolitical context has challenged public banks in terms of what some perceive as competing mandates, and this was already highlighted in the opening remarks, namely climate action and development. This has further aggravated a key area which needs rapid commitment and it needs rapid improvement, and that is the phasing out of fossil fuels. Before the invasion of Ukraine, we had seen several banks come forward with intentions or plans of actually phasing out in the very near future fossil fuels. This has already been compromised. Some other institutions, such as, for example, the World Bank, continue to finance these other projects, and some other institutions that had already actually pledged to phase out this type of financing are currently under pressure to backslide on that commitment, for example, the European Investment Bank. So that's a little bit of the main results, and now I would like to share with you our main recommendations. The next slide, please. Yeah, so very briefly. MDBs can leverage considerable capital even in challenging periods, and it's especially important that this is done in the poly-crisis scenario that we're seeing. This ability can be further enhanced if the recommendation posed by the Capital Adequacy Framework Review, which was recently published, are followed. This will help unlock the resources which are key for the transition of emerging economies and developing countries. Secondly, decisive shareholder action is a precondition for achieving the necessary changes within MDBs and other public banks so that these institutions can become fit for purpose to deal with the poly-crisis scenario that we're living and to implement the CAF review recommendations in the case of multilateral development banks. Thirdly, given that each MDB, as well as other public banks, rely on their own methodology to account for climate finance, third-party auditing should be required, particularly considering non-disclosed activities like trade finance and direct finance, and so that it is clear how these interact with sustainable development goals and to make sure these are not at odds, but that are rather tackled in tandem. And finally, perhaps the most important recommendation for this panel discussion is that MDBs and other public banks require very strong leadership to tackle both climate change and developmental aspirations. This needs to be done in tandem. This means that we cannot sacrifice climate action or SDGs when we take decisions right now for the longer future. So thank you.
Thank you very much, Laura. I think we have with Nicole and Laura's presentations a very complementary and a very strong discussion point on how the alignment with the Paris Agreement should not be considered as something that drives away from the development objectives. I mean, Laura, you made that point very clear at the end, that this needs particular leadership in the period. I'd be interested to see if that raises some questions from the audience about what we can learn from the level of climate alignment of the public development banks. Yes, please. Oh, merci, Jean-Baptiste.
Thank you, everybody. Sam Attridge from ODI. A couple of questions for Nicole, actually. I was just wondering to what extent the study was able to consider, if you like, the broader environment in which PDBs and many national PDBs operate. And by that, I mean the regulatory kind of environment, and whether or not you touched upon, for example, the TCFD and how that might be driving or change in kind of the state of development in the markets with regard to green finance? Because I wonder if that's going to be a bigger driver of things. And out of that, you would be looking at the risks in your portfolio, but also the opportunities. And then I was just curious about the recommendations, which were kind of the institutions themselves, the government, and I think it was a network of actors. But one thing we've observed in our work at ODI is a capture of international climate finance by the multilateral system, and whether or not there should be a recommendation that much more of that should be channeled through these institutions. Thanks.
Thanks a lot, Samantha. Any other questions? Just behind you, if you could pass the microphone to Sam, just behind you, Sam. Thank you very much.
Yes, thank you. San Bilal from ECDPM and also from the European think tank group where ODI and IDRI and some other institutions are part of. I had a question, in fact, just following up on what Sam was mentioning. And I was wondering if you also looked at the synergy that there are between the PDBs and the more traditional donors type of engagement along the SDGs. It seems to us also in our research that sometimes the PDBs have a tendency to work too much on their own, and that to achieve more effectively some of the SDGs, they should work more together with some of the donors, and in particular perhaps on climate adaptation, where we see many of the PDBs have difficulties to engage on. And so I was wondering if it's something you have seen in your study as well.
Thank you very much, Sam. I would propose that, Nicole, if you are with us, could you maybe pick on some of Sam's question, and then I will give the floor also to Laura to give complementary remarks.
Yeah, absolutely. So great questions. And I think in terms of looking at the broader environment to which they operate, we absolutely did so to the extent possible. But we kind of took an opposite approach that some of the other studies presented here today did, in which we didn't take a national policy and bring it down to the public finance institutions. So again, like if a country has a net zero policy or if they have a particular SDG focus, we did not automatically assume that the public financial institution had that same focus unless they particularly commented on it or referenced back to it. In terms of the broader environment, particularly for sort of smaller development banks, national and subnationals, that's something we didn't get to touch on in the study, but we really are hoping to in future work, because I think there's just such a sort of such a strong focus on the larger development institutions that some of the smaller development finance institutions and public finance institutions get a little bit lost. And so I think that having a bigger study looking at some of the smaller institutions, their environment, would be really interesting. In terms of the TCFD, we're finding that the TCFD probably has driven some action within the private sector to be net zero. We also did find that there's been so many private financial institutions that have made a commitment and have committed to disclosing along the TCFD disclosure lines. But we're really in a period where right now all those same financial institutions need to come out with their interim targets and their strategies for reaching them. And I think that's going to be a big test of whether or not the GFANs and the private sector coalitions have staying power. So in terms of TCFD on the public side, we're definitely seeing some additional reporting, but it's just not taking off the same way, perhaps because of shareholders or civil society action, but we're not seeing that same pressure to disclose along lines of the TCFD. For, I think, multilateral financial institutions and the capture of climate finance by those, I think that we'd absolutely love to see that dispersed more and for more intermediary banks to be involved in it. And I think that that would actually go really nicely hand in hand with the knowledge sharing and capacity building aspects as well. And I think that also goes to the last question a little bit, which is, PDBs have a tendency to work by themselves. Absolutely. I think that in general, across the public sector, we do have sort of coalitions that pop up and, have sort of shared goals and shared commitments within them. But I think that particularly among the broader financial institutions, ways to bring in those smaller financial institutions and really leverage the capacity and best practices of the larger ones. There's a real potential there, and even bringing donors into that conversation could have a huge impact. So thank you. Hope that answers your questions.
Thanks a lot, Nicole. Laura, do you have a microphone?
Yes, thank you so much for your question, and that's actually, it's very important. So the use of blended finance and how multilateral development banks and other public development banks can actually allocate and channel funds to both subnational and national banks, it is really key. And then I also think the example that you mentioned is a clear case of that, because as of now, what we have seen is, especially in the AFOLU, agriculture, forestry, and other land use and adaptation sectors, it's been very much artificially separated. And so we need that these institutions not only channel those funds, but that also help to crowd in both private finance, but also do that with the help of other donors that are more focused on development. I'm thinking here, for example, the German Development Agency, GIZ, through their different facilities. So it is important that there is collaboration. What we're seeing is that there is increasingly more interest of this happening, but of course, we need to do more in order for these institutions to not just work alone, but rather create those networks to develop the pertinent capacities, allocate the corresponding finance, leverage the balance sheets, like one of the previous speakers of the previous sessions said, in order to have a more holistic result in which we actually see ownership of this money entering the country and being scaled up to transform the different sectors.
Thank you very much, Laura. I actually wanted to use the microphone for asking you both a question. One of the criteria for Nicole to assess if a PDB is aligned with Paris is to see if there is a divestment or an exclusion policy. And to some extent, Laura, you were saying we need to be very cautious about reconciling climate objectives and development. And as you clearly stated, Laura, in the current context, President Macky Sall of Senegal and of the African Union is stating very clearly that for him, investing in gas is necessary for industrialization in Senegal. So this is a very heavy controversy. How do you see, Laura, from your side, the possibility to continue assessing the alignment with the Paris Agreement through a policy of divestment, of the exclusion lists? And I would ask the same to Nicole. At IDRI, we've developed an initiative called Deep Decarbonization Pathways, where we try to look at individual countries and how, in their specific situation, getting out of fossil fuel needs to be considered specifically. And so to some extent, it's not exactly an alternative, but it's a way to look at specific circumstances of countries first, without having, and trying not to have overall norms and standards about when and how to get out of fossil fuel. So I don't know if you have any specific comment on that, Laura, and then Nicole.
Yes, yes, and this is, and we are seeing that this is a very tricky question in the last time, but I think you already answered it yourself. I think that when E3G does, or we do our assessment through this matrix, context matters. So it's not the same as to look to the European Investment Bank and the countries that it caters to, whereas when we're looking to other geographies, then we understand that there are different considerations that need to be taken into account. So we believe that exclusion lists are definitely very important. However, they are one of many instruments that can be taken, and it's never a one-size-fits-all kind of solution. We also believe that public development banks, through their mandate of development, should use their policy-based lending and their technical assistance engagements to help countries create the robust policy framework that will allow them to jump out of fossil fuels without compromising their shorter, immediate needs of development. Because like we said, and what I mentioned before, and you just echoed, we cannot sacrifice one for the other, but we need to be mindful of both. So to answer your question, I think exclusion lists are something that are very important, that are necessary. It's a matter of understanding how those would fit in the different contexts, and that public development institutions help countries get ownership of their decarbonization plans so that they can develop their NDCs, their national determined contributions, their long-term strategies in a way that will allow them to do that without sacrificing short-term development.
Thank you very much, Laura. Nicole?
I just want to echo what Laura said. I think that's entirely accurate. This is a tool that can be used by the public development institutions rather than a sort of necessity that needs to be included.
As well, one of the things that we're also looking at CPI is ways that public financial institutions can actually invest in sort of things like coal plants and high-emitting assets with the intention to retire them early and with a focus on just transition and ensuring that there's no energy loss for local communities. So I absolutely think there's a country context that needs to be taken into account, and there's no one-size-fits-all solution on divestment and exclusion. But I do think that it's an important part of the discussion, and that because we have found so many public financial institutions are making those sort of comments, we felt it was really important to include in our study as a key finding. Thanks.
It's very clear, Nicole. Thanks very much for that. We need to get to the last pair of speakers. Thank you very much, Laura and Nicole, for this. So the last pair of speakers will present studies about the practices of SDG alignment, and actually we're very interested to also hear how we can foster them. So I will first give the floor to Marcos Mancini. Marcos is Senior Sustainable Finance Advisor at UNDP. You also managed the Secretariat of, you managed, I think, the Secretariat of UNEP, of the G20 Sustainable Finance Study Group, but, and you were also active at the UNEP Financial Inquiry. So you've been at the heart of these questions for a long time. In your study, how do you see the role of PDBs in scaling financing for SDGs? And what are the findings and the recommendations of your study?
Thank you very much, Sebastian. And yeah, allow me to start by congratulating the Financing Commons for putting together this amazing agenda for today and the summit. We are at a climate and biodiversity crisis, and the role that PDBs can play and should play as game changers to align their portfolios to Paris and the SDGs more broadly will be fundamental. Thanks to AFD and the Financing Commons for the partnership, helping us put together this amazing report, the role of public development banks in scaling up sustainable finance, which we're launching today. And thanks, Sebastian, for bringing us here today. In terms of the research and the stock take and the case studies that you'll see in the report, I would like to highlight a couple of things. One is the purpose of the report is to highlight the role of PDBs through a series of successful case studies. If you are in a PDB and you find another PDB case study interesting, there's an email. Please do reach out. There's also my two colleagues from UNDP, Sally, Emily, raise your hand. Please do reach out to us. The other one was to really focus on national and subnational PDBs. Not so many times, or I would say regularly, it is MDBs who are the focus of attention in international economic and financial cooperation forums. So it was about raising the important role that PDBs also play, and obviously present a series of recommendations, some of which obviously geared to G20 and other international policymaking forums. In terms of three key messages that I would like you to take out of here is, yes, there's some progress, as previous panelists have mentioned, but there's still a lot of challenges. We saw a bit of a disconnect when you ask front forward PDBs, are these topics integrated into your strategy? And the answer was broadly yes, was broadly positive. Obviously, there's a mismatch with the research that we're seeing, and it's if anything, it's a concerning mismatch, because if you think you're doing stuff and research points otherwise, it would likely mean that you're not going to be moving as fast as I would say the SDGs point out that we should be moving in this decade of action. The second point is please count us UNDP as a platform for solutions. I think there are many initiatives that we are working on that relate to the progress that PDBs can make, in some related to this national versus strategy disconnect. Here I would point to the national integrated financing frameworks, which are country-owned SDG financing strategies. We're currently working in 86 countries to develop these strategies. 40 strategies will be done by the end of the year. There needs to be a clear connection there between national financing strategies and the role that PDBs play in informing and delivering on those national financing strategies. The OECD UNDP impact standards on financing sustainable development, which were already mentioned in the FIX communiqué, in the first FIX communiqué. The final point, which I think was also mentioned by our previous speakers, the role that SDG 17 plays within this context, which is collaboration for SDGs. The main challenge mentioned by all PDBs was on technical assistance around IMM, impact management and monitoring. I would add impact and risk management and monitoring. There needs to be, if I may, more of a global concerted effort by development partners in advancing technical assistance on these fronts with PDBs and broadly national financial institutions. Now, moving into the specific recommendations, as you can imagine, there's a stress on the call to align PDBs' mandates, governance, strategies, activities and incentives to the SDGs. Some PDBs had, all PDBs are in different stages in their SDG journey, and you'll see some case studies where PDB from Rwanda comes to mind, that they've changed sort of governance to facilitate the further integration of the SDGs into their strategy and mandate. Many PDBs mentioned that they had innovated in terms of developing new financing instruments, but not surprisingly, the cost of financing, the lower cost and the longer term of financing was mentioned as a barrier. This is a topic that the SFWG took on this year. So there needs to be sort of continued work around that in terms of provision of lower cost financing and incentives for PDBs, incentives for PDBs to provide better pricing, tenor, and offset currency risk of their loans. Third recommendation on technical assistance, as I was mentioning before, several topics came out during our conversations with PDBs and as part of the survey. Strengthening the use of data, clearer definitions, taxonomies, and common impact measurement standards. Here I already mentioned the OECD UNDP impact standards. And finally, last but not least, I would say enhanced collaboration at all levels. Here I think that the main point is shining a light of the amazing work that the Financing Commons is doing in international fora, be it G7, G20, APEC, ASEAN, and others, and really make a push for a concerted effort by development partners in technical assistance provision. If I may, one particular example where we are, I would say, catalyzing this is in Latin America. We're working in the development of a regional framework for a sustainable finance taxonomy, together with the bank, together with the IMF, together with the IDB, with CAF, ECLAC, FAO, so really bringing all development partners together. We keep talking about interoperability. Interoperability is great, but insofar development partners don't align in some way or form in the provision of that technical assistance, we won't be able to achieve that. So that would be all. Thank you very much.
Thank you very much, Marcos. And as I was saying, it's really interesting to see all the different types of institutions that are around the table doing studies from UNDP to think tanks to AFD and now to Natixis. So I'm very pleased to welcome Oris Azoulay. Oris, you're Global Head of Natixis CIB, Green and Sustainable Finance Hub. And you've also been doing a study for IDFC, the International Development Funders Club. So what are your findings on their alignment with SDGs?
Thank you very much. We're actually quite of an unusual type of institution in this type of form, being an investment bank on the private sector. And we were very, very honored to be awarded a research and advisory mission by the IDFC with the intent to research, but also develop tools and see how we can share our own experience at implementing impact monitoring tools in our operational day-to-day as a bank. So what we did is, we went through a review of SDG integration and alignment practices around PDBs. We added an interesting point of view, which was the investor base point of view through their opinion of PDB sustainable financing frameworks and impact demonstration practices. And then we had a number of bilateral interviews with IDFC members, workshops to fine-tune our tools and discuss with impact data providers, alternative data collectors, etc. First short series of observation, I guess. The first one is, and a reminder, SDGs have been designed by countries for countries. And I think it's an extremely important element to bear in mind with the notion of time, geography, and quantitative targets at the heart of what we're seeing. Now, when we look at what's happening in the PDB market, in the PDB sector, but even a bit more extensively in the private sector with regards to SDGs, it's a lot of mapping, sector mapping, very few actual attention to geographical SDG gaps. So where do we need to bridge those gaps? Very extensive ESG due diligence that embed SDG-related topics, of course, with a very risk-oriented approach, but not necessarily a contribution-oriented approach. A lot of go, no-goes and exclusion approaches. Now, it's not a simple task. We were lacking a simple, traceable, benchmarkable performance and means metrics. And most of the work, in the end, remains around exposure to various SDGs, and in some instances, micro impact exposed assessment. Exclusion approaches have a lot of merits, and especially the one of preventing some dramatic engagement, but they're not fit for target setting and for developing a strategic action. And all in all, SDGs have so far very rarely penetrated operational business monitoring, financial technical capital allocation, and very often stuck in that reporting angle in what we're seeing, or at least in the intention. So of course the challenges are numerous. The first one is the causality chain. How do you actually attribute the impact and the contribution? The fact that you need ex ante and ex post assessment. And as opposed to climate, there is no SDG accounting. There is no SDG budget nowadays, and we're lacking the the powerful and simple ability to set targets for such a diverse set of objectives. It's on the basis of all of these observations that we, with a great amount of humility, have worked on a couple of tools that we thought would help operationalize, strategize the monitoring of SDG contribution by PDBs. So what we did, it's very small, so I'm not going to ask you to kill your eyes by looking at this scheme, but it's a good summary of our results. So we started by setting a few principles. They're very simple, but I have to say they helped us a lot framing our own approach to SDGs that we had the opportunity to use in accompanying sovereigns in their SDG financing framework, such as the Mexican sovereign or Benin. The where, and I think it's the crucial element, the geographical mapping, link the SDG approaches to country roadmaps, NDCs, useful local granular statistical data, and SDG gaps assessment as granular as they can be. The who, ability to segment the beneficiaries. The what, which SDG, and how do we prioritize them between the where and the who. The claim, how do we build accountability and do no significant harm, if I'm allowing myself to steal European taxonomy semantics, the ESG risk management. The second step of our approach is again a very schematic framework, which we call this SAAU. Stop. What do we exit? Adjust. What do we do differently? Amplify. What do we do more? And undertake. What do we do new? And then the last, but not least, of the development we've done is what we've called the SART for a sustainable adjustment return tool. This is very much this tool is very much inherited from an experience we've built within our CIB, which is a tool called the green weighting factor, which is a live tool in our own way of doing business. The green weighting factor is a systematic, mandatory step of the credit process, whereby there is no ability for business lines to access credit decision and credit committees without going through an assessment. In this case, it's a climate-centric tool, a climate assessment, and that climate assessment translates into a coefficient that impacts and alters our perception of risk-weighted assets, our own capital allocation and capital consumption indicator, meaning that what we've tried to do is build an alternative perception of performance, meaning that when a credit is submitted to approval, it has a risk-weighted asset and an adjusted risk-weighted asset, a return on equity and an adjusted return on equity. And for the first 2 years of implementation in our systems of this tool, this was an acculturation tool and an incremental decision-making tool. After 2 years, we've designed targets. Those targets are based on that color rating, which is an assessment, and on the green weighting factor, on the color mix, and in a temperature assessment. The reason why I'm mentioning this is that based on that extremely transformative experience, we thought for PDBs, how could we adapt this? And the reasoning was twofold. We thought that there is a need for a tool to be embedded in operational credit processes that could alter capital allocation, but also optimize intervention instrument mix. And that's what we've tried to work on. Starting with an impact coefficient, which is an assessment, of course, building on granular SDG taxonomy, which is here what we need, with various axes around what I mentioned, where, what, who, and interlinkages and do no significant harm. Assessing the level of SDG contribution, I know. It's not a go-no-go tool. It's bottom-up by construction, but top-down with the intent of target setting, and we introduce cap and floors in the way you could assess a given project. The cap and floors being the SDG gaps. So trying to maximize impact where it's actually the most needed, and then similarly to what we've done for ourselves, the adjustment return tool is adjusting the financial return with that sustainable impact coefficient. And you're just building a matrix by which you would have that alternative vision of performance, and that is embedding local and sector impacts and trying to influence the decisions. And on the basis of those tools, what we suggest to explore is how we can make them systematically and mandatory and integrated in credit decision processes, how we would alter the intervention mix, cooperation, technical assistance, or the concessionality level according to that more holistic perception of performance. And that could be adapted at a project by project level, but also at a portfolio, i.e. an entity, or why not at a country of intervention. So it's something you could use, and of course define targets, define incentives for the operationals. So there's no magical answer. What I can say is that having implemented something similar in a private environment is highly challenging, highly transformative, but is bringing incredible effect in terms of the way the businesses look at these matters. And if I have to finish with key success factors, as cheesy as it may be, the top management ownership of these type of initiative is crucial. And the strong decision to make it mandatory and to embed it in strategic plan has changed a lot. There is an element of IT implementation, which is crucial as well. And the fact that it's a business as usual, it's not a reporting project, it's not a sustainable development team project, it has to be an operational core project to really make the change happen. It's bottom-up by design, but top-down in the strategic allocation and motive and purpose. That's all.
Thank you very much, Arif. Extremely interesting to see how your experience as a private player gets into the picture for us to also learn from that. I think we've got 10 minutes that I have not negotiated, but I sovereignly take from the lunch break for us to at least have questions to Marcos and Arif, but also more globally. I see Sam Attridge, and that would be great. And Jean-Baptiste also wants to ask a question. So first, Sam, and then I'm coming back to you, Jean-Baptiste.
Sorry, it's just super interesting to ask questions. Really fascinated about this SART tool, and I was just wondering, how have you seen that influence the allocation of capital in terms of investment? Would be quite interesting just to see. And then the second question related to that is, how have the kind of how do those kind of weighted risk-adjusted rates of return compared to the non-weighted risk-adjusted rates of return? And here I'm getting that kind of, do you see kind of like positive correlations between kind of like impact and SDG alignment and return? Thanks.
So the first question, I'm afraid I don't have an experience beyond the case studies and the workshops we've done with the members on the tool, but the idea really is to action the various levers of intervention. So if I take the partially comparable example of what we do as a commercial bank. The capital allocation has drastically evolved for the very simple reason that there is now a target, official target, that is using our internal tools and taxonomies, and that target is altering sector allocation, so how much capital do we put in various activities. It's altering our client mix, so who do we back as a bank, and that is based on their current climate performance, but also on their forward-looking ones. And that is also altering the mix of products we do with them. So in terms of type of technologies, type of financing, type of maturities as well, is also something that is extremely present. We're more than eager to see the application of this and the implementation of this within the PDB environment, where I believe that the product aspect is also extremely interesting in terms of the type of levers you could action on the basis of that SDG performance.
Thank you very much. So I will give the floor for Jean-Baptiste, and please also the colleagues who are on the panel or online, if you want also to discuss with the other panelists, that's also more than welcome. Jean-Baptiste.
Well, thank you, Celestia. So this is a question for you, Orith. So we see that the private sector is providing a lot of financial products such as ETFs or life insurance that are centered around the ESG, which is more about a risk-based approach. And my question is, to your knowledge, are there any SDG-related products? If not, is it something that you see emerging in the future? And to what extent could they imply PDBs as end beneficiaries, and especially PDBs in emerging and developing economies?
So there are a few funds that have been created under the SDG lens with various levels of sophistication in the SDG embedment in the investment processes. Those could be equity or fixed income funds. What we've also seen, and where we also as an institution have been involved, is instruments, especially bond issuances by some PDBs, but also by some sovereigns that were totally focused on addressing the SDGs. So one of the feedbacks we had from investors is that the appetite is here. There is a very strong desire to climb that causality chain, as I called it. So being really able to attribute impact and measure contribution, but definitely a trend that we've been identifying already for a couple of years.
Thank you very much. I'm not desperately looking for questions because their lunch is also waiting, but I think that was a very interesting and very rich session. So here we have a question. Please, go ahead.
Thank you. I have a question that really relates to all the speakers, and it's been excellent. Thank you so much. I've learned such a lot. I wanted to think about...
Could you speak a little bit closer to the microphone, please? No, it's on, but it's just a little bit closer.
Thank you. So I wanted to ask about industrial sectors and transformation in terms of industry. And I'm particularly interested in all of your presentations have touched on the way that fossil fuel intensive industrial activities, how do we transform them? Whether it's through, for example, my own research on petrochemicals industry, I found that the multilateral development banks had really significantly pulled out of financing petrochemicals. It starts from Copenhagen and Paris, and the MDBs have really gone down in the finance they give to that, whereas the private sector, private bonds, have just skyrocketed. It's hundreds of billions of dollars. And yet these bonds are not green. So when we investigated the bonds, we found only a handful that were green. So who is going to bring the change in that sector? Is it the MDBs that need to go back into that sector and change from inside? Or is it the private bonds that need to somehow be different so that they can do it? Because at the moment, I don't see anybody financing that change. And it's a big change, and it's a risky change, and lots of people will lose making that change. the winners will be it will be a long time before you see those benefits. So how do we navigate that? Thank you.
Thank you very much for that question. I think this is the last one we can take, and I would like all the panelists who want to take the floor on that to really have something to say. I know for the contacts we have in the private financial sector that this issue of how do we not abandon the sectors that have stranded assets, but rather help them transition, is a key question about can we account for that we're doing good by doing that rather than divesting. What would be your take?
Of course. I think one of the key motto we as an institution have had is that if you look at transition by just looking on the other side, it's just never going to happen. So I'm completely aligned with the idea. What we are saying is investing and financing transition requires investing in the highly exposed sector, i.e. the highly intensive sector, including fossil fuel related, with a few boundaries. And the boundaries are those that are already stranded, and also that they have the actual investment plan and capex. And I have to say that the example of petrochemicals is a good one, because there is an extremely strong heterogeneity between the players. And there are winners and losers already in that sector, with transition plans that are more or less convincing, if I'm being a bit blunt. So the point, the role of the financing industry is to identify those that are actually transitioning and to provide those access to capital, be it bank capital or investor capital through bonds, which is exactly what we're building. Through transition or green bonds, knowing that there are two ways of addressing this. Funding what I would call green assets, so the specific green investments, and also supporting change. So funding, identifying ways of incentivizing the entities that are on a pathway to actually reach their targets at the pace, at the necessary pace. So it's very strong development of instruments whereby the margin, the coupon, or any other structural financial element of the mechanism is linked to the achievement of transition targets.
Thank you very much, Arith. Yes, Marcos, please.
We could have an entire conference on with that question. I think it's a great question. I would point out to some of the work that the G20, the SFWG, Sustainable Finance Working Group, has done this year. A big part was on developing a transition finance framework. The report is just out a couple of days ago, so I would point you to that. Among the international organizations that contributed substantively was the ILO. I think your question was mainly around stranded human capital and how one does consider that in this whole equation. There's a beautiful paper from the ILO in the group repository, in Sustainable Finance Working Group repository website. So just those two resources that probably can help bring further clarity to your question. And there's a big piece also on transparency, credibility, and accountability of financial sector pledges. CPI contributed to that with its research along other civil society organizations. I think that complements what you were saying in terms of also the role of the private sector.
Thank you very much. I think we need to stop there. Just a few words. Thank you very much to all panelists, because I think your diversity of speeches were really interesting. And a few conclusion points, because I think, yes, we have progressed, and in particular with progress in how we measure progress. That's what you showed. There are still issues of data collection, because we depend a lot on disclosures, and we depend a lot on impact assessment already being done by the PDBs. And I see to the answer, is it feasible to align with SDGs? I think you answered mostly, yes, it's feasible, but we are really not there yet. I think that's also an important message to be conveyed to the PDBs of tomorrow, that are meeting tomorrow. We are still assessing that they are not aligned, the progress is there, but it's very slow, and that there are lots of beautiful tools or measurement possibilities that you've been presenting that they could be inspired by. And I think this is really an important message that we need to convey back. Thanks a lot to you all, and I give the floor back to you.
Thank you, Sebastian, and thank you all for this great conversation. I think we are now moving to our very well-deserved lunch. I hope you all enjoyed the sessions this morning. We're closing the first part of our research conference. We will be resuming here in 1 hour and 15 minutes, so at 1:45 here to start with the next part of our conference. Thank you very much, and I wish you a good appétit. Bon appétit. Great. Good afternoon, good morning, or good evening if you're following us online, wherever the place you are joining us from. Welcome back again to the third edition of the Finance in Common Summit Research Conference. We had a great session this morning, and we're resuming with the second part of our conference. We will resume our conversation on exploring how public development banks can further contribute to a green and just transition for a sustainable recovery. This morning, if you recall, we explored the role of public development banks in supporting public policies. We also discussed the hard work of aligning development banking models with the SDGs. We had a lot of learnings. Now, we will be moving towards a third panel session where we're going to discuss how to enhance the role of the public development banks in the global finance architecture. This panel is going to be led by Mrs. Kampeta Saing-Zoga. She's the Chief Executive Officer of the Development Bank of Rwanda and former Director General of the National Industrial Research and Development Agency. Mrs. Kampeta, please join me on stage. And she will be joined by Thomas Marois, who is a Reader and Director of the Public Banking Project at the SOAS University of London. Can you please join us on stage as well? A few other people are going to be joining the panel online. We will be having Mr. Chandrasekhar, Mr. Alfredo Schlarek, and Valerie Laxton. So if you're ready, over to you, Mrs. Kampeta.
Thank you very much, and thank you for the introduction. Thank you for having us for this panel. After lunch is always the hardest panel, so we'll do our best to keep you awake. And greetings to everybody online. So this is a very interesting panel. As mentioned, I am actually the CEO of a national development bank. So I'm probably one of the few in these rooms who are not researchers, but who plan to use the outcome of this research and see how best to make use of them. So today we're having a panel that is going to ask itself some, I would say, fundamental questions when we think about the future of the global financial architecture. We often think about the world in a different way rather than the role of the different, I would say, shades or layers of development banks, some of them being multilateral, others being regional, some of us being national, and at the end of the day, we all play a very big part in the global financial architecture. So today we want to be a little bit forward-looking and say if we project ourselves in the future, what should be our role coming forward? One of the research papers will definitely look at how can we be fit to deliver more on the SDGs. The reason why most development banks exist is to deliver on policy agenda. Today we'll focus on the SDGs. What should be our mandate? Should our mandate or the features of the banks change a little bit? How does our policy focus actually help in having instruments that will help us to be more relevant? Are they financial and non-financial links as we think of a common goal? And we'll have all these questions answered by one research paper. The second, I'm trying to create a bit of how can I say, suspense about who's going to answer these questions. The second research paper is around the cooperation between multi-national development banks and national development banks. Is there an opportunity, as we look at climate finance, to deal with each other differently, to deepen our relationships, to do better transactions together? Should we think about an ecosystem approach or continue to think about individual transactions? A third paper will look at something that is very close to our hearts as national development banks, which is the local currency discussion in development finance. Right now, we know there's a mismatch between our assets and liabilities. We tend to borrow in foreign currency and we tend to lend out in local currency. Is this going to be an impediment going forward? Is there an opportunity to unlock some of the challenges when it comes to this mismatch? What could potentially be the impact for credit rating as we think of scaling up the financing, especially for climate finance? And then the last paper will look at how do we align policy-based finance instruments with the Paris Agreement. We've all heard about the role of development banks. We've heard about Paris alignment. Is there Is there an intersection in our Venn diagram? And if there's an intersection, what is that intersection going to look like? Can we think about mainstreaming the do not harm principle? What would it require? And what kind of changes do we need to be able to support the climate change agenda? So without further ado, I get to tell you who's going to answer each of these questions. And we have online Professor Chandrasekhar from India, who's going to answer the questions around public development and SDGs, a global architecture for the global good. We can give him 5 to 7 minutes and ask him to present his paper, after which we'll have the rest of the papers, and at the end we'll try to keep the panel discussion short so that we have more time for Q&A. Hopefully you'll have many questions for the panelists. So can we go online? Professor, can you hear us? Chandrasekhar?
Yeah, can you hear me?
Yes. Kindly go ahead.
Okay. Yeah, thank you. Thanks, person. Thanks also to PDB and I'm sorry, to the organizers of the Finance and Commons Summit and to AFD and the others who invited me to make this presentation, and of course to AFD and GDN for having supported the work on the basis of which this 7-minute presentation is going to be based. Coming after lunch, I suppose, is not merely a problem because people might be feeling sleepy, but it's also because much has been said over the morning session. We've had a lot of references to the information and data that we have on public development banks, both from the INSEE AFD database and from other sources. So I won't be, putting in much here by way of information, additional data, etc., other than some minor references. What I'll try and really do is to sort of highlight 3 or 4 points which maybe help contribute to the discussion. First, I think the first point I'd like to make is that when we speak of a global architecture of PDBs, which of course are public development banks which exist, we're talking about a process of long-term evolution in which multiple factors have played a role to necessitate the emergence of these public development banks. And we must note that these banks only emerge in market economies, that you don't have in what were the erstwhile centrally planned economies the need for special financial institutions to undertake financing of the kind that the PDBs do, because much of the allocations actually came from the budgets and went straight to public operation targeted investment. But if you look at it conceptually, we are saying that in some sense these banks took a leaf out of the history of banking as far back as in the period of industrialization in Germany, where we know from work of people like Piero Sraffa, etc., that you essentially had a situation in which even though you had large private banks, you had a financial architecture at the apex of which sat the central bank, which essentially ensured that at any point of time, if there was an absence of liquidity in the banking system, which was called upon to finance large projects, building railroads, building the city of Paris maybe, doing all sorts of things which would be considered not proper for commercial banks to do because of the liquidity and maturity mismatches involved. But you had a central bank which basically created a window which said that as and when it became difficult for these banks to generate the liquidity to be able to sustain operations of this kind, where they took short-term funding, which is supposed to be low risk and low maturity, and actually financed large-scale capital-intensive projects with relatively higher risk and longer maturities, that if they're not in a position to be able to ensure the transformations needed, that central bank will, through its window, offer the liquidity to be able to ensure that system to work. So you basically had an idea right from the beginning, in some sense, in late industrializing market economies, that you needed specialized financial institutions, not because markets fail, because the term market fail seems to suggest that there is some kind of an ideal market which can resolve all problems. It basically is that there are certain kinds of things markets and private initiative based on profits just cannot do, and therefore you need specialized institutions. Now, if we take the 3 sort of, among the many most important elements which we look to when we or look at when we turn to public development banks, First, of course, is what I mentioned. It is a need to close the gap for long-term finance which existed in market economies, and which really meant that you try and close maturity and liquidity mismatches. Now, in the evolution of public development banking, we know that this has occurred in a context in which much has changed in the world of finance in general, particularly after the great liberalization of the post-1970s era. So you've had financial innovation, which actually allows other kinds of financial institutions in the private sector to actually go to try and ensure a certain degree of maturity and liquidity transformation. So you could say that to a certain extent, a part of the role of public development banks began to shift because of financial innovation to the private financial sector. But there was a second component of this, which was a sub-component, which really was the need to finance extremely large capital-intensive projects, particularly infrastructural projects, where we know that the economy-wide positive externalities are so large that we must put them in place and find the finance for it. And sometimes it became difficult even for financial innovations to generate this, and therefore you had public banks moving in to a certain extent into a larger degree of infrastructural financing. But finally, what we find increasingly, and this was mentioned even in the morning in the context of climate finance, etc., that what we've seen is that public banks increasingly were called upon because of the fact that it's not only that they dealt with the problem of the need for maturity and liquidity mismatches to be covered, the need for lump sum investments and covering long gestation lags, but you had to finance low or near zero projects which had huge positive externalities. And for that, it was realized that you actually needed public banks, and you needed public banks which were willing to be able, either through cross-subsidization or otherwise, to be able to finance these kinds of activities. And the first point I'd like to make is that once we recognize this, we are basically saying that public banks are here to stay, our development banks are here to stay. The notion that you can de-risk low return or zero return projects by bringing in the private sector is basically to say that, listen, you'll subsidize profitability in the private sector, which essentially means that the public sector takes the losses, and that is not necessarily the best way to go. So we need this architecture, and that architecture has evolved over a period of time, as I said, as a result of these multiple requirements in market economies. Now, if that be said, what do we have at the end of this process? We have what was mentioned this morning, 500 plus national public development banks, some are supranational institutions like the World Bank and the World Bank and so on. And then you have regional development banks and subnational banks besides the national development banks. Now, given the fact that they came as a result of this process of evolution, where finally their importance for financing low return or near zero profit projects which have huge positive externalities became important, we are really saying that we need to we need to see them as being specifically institutions which constitute this global architecture, which are fit for purpose, which is the purpose of SDG financing and the financing of climate requirements. Now, I only want to say that if once we recognize this, and we recognize that this is an extremely useful prefab architecture, as it were, because so many of these are national development banks, a majority in terms of numbers is national development banks, we have to confront 2 or 3 challenges, which is what I'll sort of put on the table. And the first challenge, of course, is the extreme unevenness which exists in the global development financing architecture. That if you take something like the largest 15 of the 480 DFIs for which we have asset size information in the INSEE database, the AFD INSEE database, they account for something like 75% of the assets of this universe. And the overall global architecture is dominated by just a small number of very large public development banks. About 78 of them, or about 1/6 of them, account for assets of more than 20 billion each. They account for almost 96% of total assets. Now, if you have an uneven structure of this kind, and you're looking for the flow of finance to occur in order to be able to finance these projects, which are crucial from the point of view of realizing the SDGs or of realizing climate goals in particular, then we're obviously saying that we have, in some sense, the institutions, we have the architecture which has come out of long process of evolution, but we don't have the kind of asset distribution, because we know that something like, the increase in spending or required for SDG financing and climate, etc., will be in the range of about 6 to 8 or 10 times what is currently occurring every year. Now, the second problem, of course, is that this kind of an unevenness is highly related to income distribution. By income distribution, I mean country-wise income distribution. And you basically say that if you take something like 433 of these public development banks for which information is available, about 159 of them, or 37%, were located in high-income countries, okay? And they had 71% of the total assets. About 61% or 263 in middle-income countries, some of which, like China, account for a very large chunk of the assets, which is, and they had about, they had about 27% of the total assets. And just in the low-income countries, you had just 3% of these institutions with a negligible share of assets. Now, if you actually have a problem of dealing, I mean, we know from pandemic, for example, is that, if you have vaccine nationalism and you don't vaccinate across the globe, then you don't address a problem. That's true of all of these kinds of public goods, that you therefore need to find a way of moving assets. You might have an institutional architecture which is fit for purpose, but because of the unevenness that we have, you have to move these assets. And the moment you begin to think of moving these assets, linked, of course, to the whole debate on climate finance and SDG financing, you have the last issue which we have to confront, which is that we need to be able to ensure that there exists measurements or metrics which will allow those who are going to accede or agree to the movement of these assets, movement of this finance, that it's actually going to finance a set of projects which they think is in keeping with the goals that they now, as the international community, are willing to take on. And if they're going to do that, obviously, things like the Finance in Common Summit, which bring together public development banks, must also create a global institutional architecture to be able to prevent greenwashing, to prevent the utilization of resources in ways which are inefficient, to prevent the utilization of resources in the name of SDGs for projects which don't actually make much difference to international inequality or social deprivation. So there is need to tweak this architecture in multiple senses to deal with unevenness, both in terms of just size and richness, linked to the international distribution of income, and place it in a context where we can actually generate a consensus for this flow. Thank you.
Thank you very much, Professor, for setting the scene and the context of this conversation and reminding us about the particular features of development banks and their role in actually allowing us or enabling us to implement the SDG agenda. You spoke about a very important point, which is moving assets from a concentration linked to income capacity. And I think one way of moving these assets is actually through the relationship between the multinational development banks and the national banks. So I'd like to now turn to Mr. Thomas Marois from SOAS, University of London, and ask him to give us an overview of the relationship between the multilateral systems and the national banks. Hopefully you can answer that question that has been posed by the professor, partly or entirely. Over to you.
Good afternoon, everyone. You might be surprised, but we had originally thought of doing an interpretive dance in the afternoon session on multilateral development banks and national development banks to ensure everyone was moving. But since Alfredo and Professor Chandakar couldn't join us, we decided to abandon that and go with more traditional presentation. So that's what you're going to get this afternoon. I'm a scholar of development banks and public development banks, and I feel like a fish in water here. I'm very pleased to be here, and thank you to AFD and to Rajiv for the invitation. I'm going to talk about a paper that we worked on over the summer, and particularly I'd like to give a word of thanks to my researcher, master's student Jacob Stewart at SOAS University of London. The project was really about fact-finding, and I think much of that, has sort of gone over today, but it was a survey that we conducted of 10 multilateral development banks. I'll go into the next slide, sure. That was circulated over the summer, and then we checked the results of that survey in terms of mapping out the relationships between the bigger multilateral development banks, the 10 you see here, and trying to understand their relationships with national development banks that are in their region. and to sort of give some flavor to that. We checked those surveys against a 5-year review of the annual reports of each of the multilateral development banks, and then checked those against about a 3-year review of the national development banks that were mentioned either in the survey or in the review of the national, the multilateral development banks' annual reports. The premise for the study, the terms of reference, if you will, is that public development banks must play a new leading role in financing green and just transition. So that was the premise of the study. And we really wanted to know, are public development banks doing enough, and can they do more? And that was really, mostly answered through the surveys, and I should give a word of thanks to the multilateral development banks for responding to the survey and responding over summer. I'm sure many of you hate me very deeply for requesting it and constantly emailing you in July and August, but thank you for returning them to us nonetheless. Next. The results, I'm going to go over fairly quickly because I think these are things that have been said today, and I don't think they are all that controversial. And that will leave me a few more minutes, I hope, to speak more about the recommendations. So the results, first and foremost, are yes, multilateral development banks are lending to national development banks, but very unevenly so. There is really no global ecosystem of public financing that we could identify. Relatedly, thank you, Jean-Baptiste, you read my mind. Reporting is uneven between multilateral development banks. We'll come back to that later. Next. But among all of these surveys, there was universal agreement that there are multiple barriers to MDBs lending or engaging with NDBs. For example, currency mismatches, varying market conditions, fiscal barriers. But clearly, these vary depending on the region. Currency mismatch is not an issue within Europe, but clearly that's an issue in Latin America or Africa, Asia, and so on. And these results have largely been affirmed. But fortunately, Alfredo will be giving us the answer in terms of overcoming these barriers in the next presentation, I believe he's doing. And the final finding or result is that there, at the same time, and again, we know this from today, that there's no systematic alignment or tracking of SDG financing between the multilateral development banks and the NDBs. Next. So this brings us to the importance of this study, I think. And it is also important to, as a scholar and as an academic, to premise that the interpretation of results are never inherently neutral or natural, that we always bring our own normative aspirations and the terms of reference of this study, which is looking at public development banks taking a new and leading role in green and just transitions. And so out of this, we've come with the question of what's to be done, the recommendations. And the first recommendation is for MDBs and national development banks to begin to co-develop. And for me, that's an important word, co-develop. That they work together to co-develop a set or a framework, a clear, simple, standardized template or set of metrics to quite simply track already existing financial cooperations. We need to know where we are, and we need to know where these banks are universally. So once we know, then we can begin, asking some deeper questions on that. But it's simply not being done right now. In essence, we need to create metrics that matter. The second one, and this is really a question of agency, and it's about pushing forward with these public development banks that are owned and controlled by governing authorities at the national level, at international levels, subnational levels, and I'm really glad today that the question of subnational development banks and smaller have been raised, and I'll come back to that again in a moment. But this is a question of agency in terms of the governing boards of the multilateral development banks and the national development banks, in fact, need to demand, in conversation, that their public banks meaningfully, and that's an important word, meaningfully and transparently report on SDG-related financing. We're all very, very familiar with the ESG mirage, as has been reported in the news, or the gaming of the ESG system, the gaming of the SDG system. And so it is important that if we're going to report on SDGs, that we do so meaningfully, that the metrics matter, and that they are accountable and transparent to the societies which own those banks and the societies that are dependent on those banks in many ways. So this is an important conversation that has to be had not only at the level of governments, even though the governing boards will be the agents of that change. They must happen within the banks themselves, the ones who know, who are experts on those banks, but also with those banks linked to the sort of subnational development banks and national development banks, and the societies in which they impact and which they engage. And by creating those meaningful metrics, that's when you can really see change. And they're, getting away, in a sense, from an imposition of this is what really matters, now go apply it. It's creating those metrics, those co-development ones. Next. And as a researcher, just to keep my job, we have to put a call out there for further research, but it's true, in fact, that we need further research on the existing barriers. And we know they exist, and all the reports came back, and that was probably one of the most filled out parts of the survey, was on the various barriers that there are between lending, between MDBs and NDBs, but also expertise, capacity, and so on. There's a whole range of barriers that perhaps are falsely erected between these levels of public development banks. And so we need to know more about them. And for that, it is both a mapping exercise, but then taking that mapping and really digging into the case studies to understand where there is promise between MDBs and NDBs. Certain regions are tracking better than others presently. Certain regions are reporting in more depth. So what about specific relationships between MDBs and NDBs? What kind of promising lessons can we learn from those, and pitfalls? There are some problems. Clearly, public banks are not, for the simple fact that they're public, inherently better or worse than private banks. They have their own problems, and they need to be treated as such in their own terms. Next. Oh, no, we're there already. And finally, the recommendation is I think probably the contribution that I think is most unique about this study and what I would like to put forward, and I think that we've heard through different presentations in different ways today. But basically, this recommendation is that leaders, regulators, public bankers, and civil society need to start thinking and acting according to a public financial ecosystem approach. So the AFD has done an amazing job tracing out public development banks, 522 presently, $23 trillion in assets. But if and I was very glad to see Jean-Baptiste is talking about expanding that now to include the commercial banks that are public, the universal banks that are public, the smaller, sub-regional banks. Because when you start doing that, and you start adding in central bank assets, multilateral assets, and so on, commercial bank assets, you're looking to double, triple, and in some cases quadruple that 23 trillion if you include public pension funds, for example. There is an absolutely enormous pool of public financial funds in the world, but we don't know that, and we're not tracing it, and we're not making use of that financial ecosystem. And if you want to move forward at the pace, the scale, the intensity needed to reach the SDGs, and to do so in a way that is green and is just, we need to make use of that financial ecosystem. It is low-hanging fruit. It is a matter of policy, simply, of in essence asking the MDBs, the NDBs, the subnational banks, the local banks, the municipal banks, the credit, small development finance institutions, cities, rotating savings and credit associations. It is about aligning them and creating a policy of public-public collaboration. And that is perhaps one of the most important lessons that we can take out of this mapping exercise, is that we've only scratched the surface, that there are significantly more opportunities for collaboration, and that if we align them in a public way that premises SDGs, green and just transitions, then we can make significantly more progress on SDGs in a meaningful and transparent way. Thank you.
Thank you very much, Thomas. I guess the dancing will be later tonight. We'd like now to circle back on one of the obstacles that have been raised by Thomas regarding the mismatch of currency. As he's rightly mentioned, there's tremendous potential in the relationship between the MDBs and the national development banks. But one of the issues is a mismatch between assets and liabilities. And as we think about scaling up these relationships by implementing the recommendation that he's very clearly put forward, we cannot avoid to think about the additional opportunities that could be unlocked if we addressed this mismatch. So I'd like to invite Mr. Alfredo Schlarek, who's joining us somewhere in the world, I'm told in Morocco, on his way here, but we're glad that he's with us today, and invite him to actually present his paper on local currency denominated loans in the global development financial architecture. The link between with the IMF post-crisis SDR allocation. So Alfredo, I hope you can hear us, and over to you.
So thank you very much. I'm really happy to be here. Well, I made it to Casablanca. Hopefully tomorrow I will be able to meet you in person. So that will be really nice. So let's go to the paper. This is a joint paper with me from the National University of Córdoba, Argentina, and Jasmine Xu from the INSE, Peking University, China. And what we are looking at here are local currency denominated loans in the global development finance architecture. Can I get the slides? Yes? Okay, great. So first I will just very briefly tell you how do multilateral development banks finance themselves. Then I will talk about what types of projects are financed in host countries. And then what is the problem that arises here that we have already said it, is this currency mismatch. Here is where my expertise as a banking and microeconomist expert is able to provide some ideas and new thoughts and analysis. And then finally I will propose what I think is the best way of solving these issues. So first, how do multilateral development banks finance themselves? So basically, they are issuing bonds in the international bond market. That means that multilateral development banks have liabilities in US dollars or in euros, and they are subject to credit rating agency evaluation, which determines the interest rate which provide the cost of this multilateral development bank. Then there is the capitalization by the owners. This means that the MDBs don't have any liabilities on the capital and no interest payments. So that has some positive things that we'll talk about later on. Then they could issue bonds in the local bond market. So in that case, the multilateral development bank would have liabilities in local currency. I will just talk about this, the problem with this idea. And finally, multilateral development banks don't finance themselves with bank deposits because they are not in the payment system. So let's talk about now what type of projects are financed in host countries. Well, I came up with this idea of thinking in terms of macroeconomics and the currency mismatches that happen, that investment projects in host countries may be export enhancing, exits. This means that they generate US dollars, for example, building a port or developing export agriculture. But they could also be domestic oriented, DOIPs, and that means that they don't generate US dollars. They generate local currency, but not US dollars. So, for example, a solar or a wind farm or a sewage system. These are projects that have a very high value, social value, but they are not producing dollars. So let's go. So exits, they if the MDB loan is in US dollars, there is no foreign exchange risk because they are generating dollars. But for DOIPs, if the loan is in dollars, then there is this FX risk, and this is a big problem with a currency crisis, and I think we are seeing that now happening in Africa, in Argentina, where I'm coming from, etc. So this is not a theoretical idea, it's a concrete problem that we are facing right now. If if the loan from the multilateral development bank would be in local currency, there would be no FX risk. So that would be the best for the host country. So what is the problem here? The problem is that, I mean, of course, we want MDBs to lend in local currency, but they cannot. And the problem is the following. If MDBs are issuing US bonds, so they are financing themselves in US dollars or in euros, this means that if then the MDB is lending in US dollars, well, then that's not a problem for them because they don't have any currency mismatch between assets and liabilities. They have liabilities in US dollars, but they have also assets in US dollars, so they have no problem with the credit rating agency downgrading. But if they are lending to DOIPs, domestic-oriented investment projects, then there is this FX risk. And that is a huge problem, as I said, with the ability of these host countries to later on pay back those US dollars when they invested in a project that might be socially important, but it's not generating the dollars to pay back, okay? Instead, if the MDB is lending in local currency, this means that the MDB has a currency mismatch because it issued US dollar bonds, but now it has liabilities in US dollars and it has assets in local currency. So there you have a currency mismatch, and the problem there is that it is possible to get this credit rating downgrading, and that means paying a higher interest rate for the bonds that it issued in the international market, and that is something that multilateral development banks don't want to do. So, this is basically the problem. So the problem is that you either have a currency mismatch for the MDB and possibility of downgrading, or you have FX risk for domestic-oriented investment projects, and the risk of having a crisis and no development. Yes. So, what is there are like two solutions. The first solution to this problem is that, okay, why don't MDBs just issue local currency bonds in the host country, so then it would have liabilities in local currency, and there will be no currency mismatch, and there is no FX risk for domestic-oriented investment projects. But what is the problem with that? First of all, it cannot be a major funding source because usually these local financial markets are very small. Another problem is that if the MDB is issuing these bonds in the local market, it is getting local currency and it is lending this local currency. So this host country has no access to US dollars. And that means that it cannot finance imported supplies for these domestic-oriented investment projects. And many of these development countries, they don't have a home production, so they need to import certain supplies. And the third problem is that there is no, MDBs would not have any advantage over national development banks, because national development banks could just issue bonds in their market and provide those loans. So there is no role for MDBs there. So what is the solution I am proposing? What I am proposing is that, first of all, you should, the owners of the multilateral development banks should recapitalize these MDBs with dollars, or maybe with these SDRs that they are not using. And once the multilateral development bank gets these SDRs or the US dollars, then it can buy local currency from the local central bank. So this means that the MDB is giving the central bank dollars and it is receiving local currency. And then the third step is now with this local currency, the MDB can lend to the local, a local currency loan to DOIPs. And note here that the MDB has no currency mismatch because it has, because the funding is through recapitalization, it has no US liabilities, so there is no currency mismatch. There is no FX risk for DOIPs, so there is no currency crisis risk, and the third advantage is that the host country gets these US dollars or these SDRs, so it can procure important supplies. Yes? And like I skipped the fourth point above, it's once these DUIPs, these domestic-oriented investment projects, are paying back to the multilateral development bank, this means that the multilateral development bank can create a local currency fund with these repayments. Yes, so it could continue lending in local currency. Let's keep all these tables that are interesting, but will take time, and let's go to the disadvantage of this strategy that I'm proposing. So the disadvantage is that it means if a multilateral development bank is financing itself through recapitalization, it is not using all the leverage it could use, because the multilateral development bank could get this capital and use with this capital issuing bonds, putting it as a collateral and issuing bonds in the international bond market, and that is leverage. Yes. So in a sense, what we can say is that there are these trade-offs. Yes. So I think that the best solution is probably a mix of all these different funding strategies and financing strategies. Yes. In my paper that I don't have time to explain more, we are producing like a mathematical model to explain this optimal behavior where the multilateral development banks are lending a certain proportion in US dollars to EXIPs and PDBs through international bond issuance, and certain proportion of local currency lending through recap financing to DUIPs. So that is basically my presentation. Just the conclusions very fast. Multilateral development banks have to consider currency mismatch and FX risk when they are choosing how to fund itself and what type of investment projects to finance and in which currency. And if multilateral development banks want to increase the proportion of lending to DUIPs, let me just say here, DUIPs is, as I said, is solar, wind farms. So all this green transition is basically DUIPs. It's not generating US dollar for these countries, but it's really useful, yes? And it's important, wind farms, etc. So this is very important to have in mind with how we go forward with this green revolution that has to happen. Okay, so thank you very much.
Thank you. Thank you very much, Alfredo, for showing us how we can unlock actually the creation of green assets using local currency denominated loans. This is a very innovative solution, and I hope we'll get more time to discuss it during this panel. Last but not least, we're having a paper by, is Valérie online? I hope she is, yes? So,
yes, I'm here.
Excellent.
Can you hear me?
Yes, we can hear you very clearly, Valérie. And we're counting on you to answer the question around the Glasgow Climate Pact that actually called for MDBs to play a bigger role in terms of alignment with the Paris Agenda or the Paris Agreement. And this seems to be an opportunity to actually drive more reforms using an instrument that was extremely popular at the beginning of this century. Budget support has become less popular over time, but it looks like this is a good opportunity to actually have discussions with different countries around alignment. So I'd like to invite you to present your paper around aligning policy-based finance with the Paris Agreement, a potential to bolster cooperation with governments and PDBs. Over to you, Valérie.
Good afternoon, and thank you so much for the invitation to present in this conference. The WRI, World Resources Institute, German Watch, and the New Climate Institute have been working together on Paris alignment of multilateral development banks for a number of years now. And I'm bringing a part of this body of research to you here. Many elements have already come up today in various sessions, and I'll make some complementary points, some of which are based on our case studies for this paper. So in this paper, we examined policy-based operations, PBOs, as a specific mode, which is a specific mode of lending by a multilateral development bank. It was also mentioned briefly in a previous panel, thank you for the slides, and the policy actions that they include. So policy-based operations typically provide budget support, mostly as loans to sovereigns, and support policy and institutional reforms or policy actions. And we observed that most governments that request PBOs do so to improve macroeconomic stability and deliver reforms to achieve their development goals. So how does Paris alignment feature therein, or are there opportunities to do more there? Through research and many interviews, we defined a policy-based operation as Paris-aligned if its policy actions do not increase macroeconomic, fiscal, or social exposure to climate risks, and wherever possible, the reforms support long-term resilience and promote a just transition to climate neutrality, notably. Policy actions should and can avoid creating path dependency in economic activities that tend to increase countries' exposure to climate risks and delay urgent climate expenditures for resilience and a just transition. Next slide please. So how relevant and urgent is it to align policy-based finance with the Paris Agreement? Well, after pledging to align with the Paris Agreement in 2017, most MDBs will operationalize approaches in 2023 and 2024. They actually presented joint frameworks for direct and some intermediated finance at COP26 last year, and an approach for policy-based finance is expected at COP27 next month. 4 MDBs design PBOs, those are the ones on this chart: the African Development Bank, the Asian Development Bank, the Inter-American Development Bank, and the World Bank. And in the 5 years from 2015 to 2020, budget support accounted for around $140 billion US, and that is 38% of new commitments by the banks. They're represented on this slide using the red bars, and not surprisingly, this has tended to increase during the COVID pandemic. Next slide, please. So we find that there's potential to bolster analysis, dialogue, and coordination between multiple partners and governments. And this is related to the process of the PBO, which we designed in a flowchart here. And it goes to the question about the international financial architecture to some extent. Aligning PBOs with the Paris Agreement is increasingly urgent because climate change continues adding costs in already debt-laden economies. And macro-financial stability is an eligibility requirement to access PBOs. So MDBs really need to mainstream climate considerations into their diagnostics. So MDBs analysis, dialogue with the government ministries, and coordination with the development partners are the main inputs that determine a PBO's objective and which policy actions will facilitate the development outcomes desired on the ground. So in this flow figure, which illustrates parts of the process of a PBO, I'm focusing on 2 elements, namely the partner country dialogue and the development partner coordination. And these 2 elements are essential to a PBO and can be reinforced to coordinate objectives across public development banks and other development finance institutions. Actually, the case studies that we analyzed in this paper show that when these 2 elements are present and objectives are coordinated, when this happens, it makes the Paris alignment opportunities more evident, and policy actions can support their delivery more effectively. In a way, using the PBO process can help focus multiple partners' energies around financing specific transitions in countries and ultimately transform them. Next slide, please. And next slide again. Yeah, thank you. In this vein, public development banks are recognized to play a critical role in economic diversification and fiscal sustainability. For example, take AFDB's lending series to Morocco. It produced a coordinated domestic policy signal for climate action together with development partners. So One policy action supported a framework for new financing products in Morocco's public guarantee fund. In turn, this enabled a policy action which supported the Ministry of Economic and Finance to design a green financing product for small enterprises that would be managed by the fund and support economic diversification. And the AFDB, the African Development Bank, coordinated green economy objectives with the EU, which provided budget support to Morocco in the same period. So engagement or collaboration with national development banks and other multilateral development partners was critical to that PPO. And in another case, we came across the World Bank's IDA support, which was channeled from SDRs, and then the World Bank provided support for Development Bank of Mongolia to restore fiscal stability, so relating that to the previous paper. Next slide, please. There may also be an increased role of PDBs, public development banks, in just transition by looking into country platforms. So we did not fully elaborate on this part in the paper, and it's a relatively new development, but we could extend our research to explore this direction in future. Take the case of South Africa, where the BSA is a partner to prepare large investment projects in telecoms, water, sanitation, transport sectors, and also to support a policy action to increase competition and generation capacity in the energy sector, which involves the GCF, the Green Climate Fund, in a strategic energy infrastructure project. And this was like a segue to enable formulating a policy action in the main PBO to ultimately increase scale in this sector. Next slide, please. So the main takeaways, we found that there's scope for policy-based lending to enhance shareholder support, DFI coordination, and MDB analysis. And takeaway number one is that to maximize impact, shareholder governments can clearly signal support for Paris alignment and help with resources. For example, by using grants and guarantees, shareholders could establish a multi-donor trust fund to co-finance MDB budget support for policy actions that contribute to global public goods, including the just transition to climate neutrality. Takeaway number two, focus multiple development partners' energies. Use MDB's diagnostics and technical assistance to enhance domestic policy coordination for ambitious climate action and support country development plans. And shareholder governments and MDBs can strengthen the coordination, which occurs anyway in a PBO setting, to align reforms and investments with the Paris Agreement, and including public development banks. And number three, country governments could start bringing forward requests to support just transition, but bank and shareholder or government support are both needed to consider climate policies for mitigation and adaptation as an integral step towards macro-fiscal resilience. So these are our three main takeaways from the research and the multiple PBOs and policy actions that we examined in that regard. Thank you very much. Over to you.
Thank you very much. Thank you, Valérie. So we've heard 4 very interesting research papers on various aspects on how we can do more as development banks. Maybe we have time for 1 or 2 burning questions? Yes? Okay. So can we take maybe 2 comments from the floor and or questions? And if you can just stand up and we'll give you the mic and just tell us what you do and make your comment or your question. Or was it so clear? I see the gentleman at the back and then Regis.
Thank you very much, and thank you to the presenters. My name is Leonard Kange. I work for Bank of Industry in Nigeria. I just wanted to share a perspective on our own experience, borrowing in foreign currency, lending in local currency, and how we were able to manage that. Bank of Industry is owned by the federal government of Nigeria. And we are not a deposit money bank, so we have to buy our funds. So what we did was we got the government and our major shareholder, the Central Bank of Nigeria, to help us by providing credit enhancement, as in guarantees, for us to raise funding internationally. And with that help, we were able to raise significant money, over $5 billion, between 2018 and now. This year alone, we raised about $2 billion doing that. Now, that money came in euro and in US dollars. But we lend in local currency. Our customers pay back in local currency. So what we did was we spoke to the central bank, and they agreed to swap the money into Naira. It was both a foreign exchange and interest rate swap. So that took away the exchange risk from us. So the loan repayments and everything were handled by the central bank because the foreign exchange was sterilized with them. They gave us local Naira. We were then able to lend to our customers, and they paid back, and we paid back to the CBN. And so that took care of the foreign exchange risk for us. Locally, it's not a viable option for us to raise money locally and issue bonds because interest rates in Nigeria are high, about 21%, thereabouts. We were lending at single-digit rates because that's the only way a country can industrialize. You cannot industrialize on double-digit interest rates. It's not possible, etc., and all of that. So if you go into the market in Nigeria to raise money, you're looking at about 18, 20, 30%. It didn't make sense. So that's why we had to go out to do that. So I just wanted to share that experience. Thank you.
Thank you very much. Thank you. I think the more solutions we can find, the better. They're all complementary. Thank you for sharing your experience. Régis?
Many thanks. So I'm Régis from the French Development Agency. One question to the panel related to the foreign exchange mismatch. At some point of time, I mean, some international lenders had the idea to come to local markets and be themselves, organize themselves some local emission in local currency, and then use that in a multi-currency sort of balance sheet to be able to propose local currencies to local players. But here we face two problems. The first one is that usually the local market is very tight, and so by doing that, we are also twisting the local conditions of access for local actors to this local currency, because obviously pension funds, insurance, whatever liquidity you have on the local market, they would have a preference to lend to African Development Bank or the AFD or the World Bank than, to their own local banking system. And the second one is that it was also detrimental to the local actors, because then they were confronted to AA or AAA emissions, which they do not benefit themselves even on the local market. And so if in terms they want to go themselves and provide or ask for some bonds in the market, then they lose a lot of money, because the big players are there with their AAA and they mop up the liquidity in the market. And so I wonder what's the reaction of the colleagues and of the development banks to that, and what is it in fact that you would be expecting from international lenders when getting to this very precise question of providing local currencies for your balance sheet? Thank you.
Thank you very much. Would you prefer, Régis, to get an answer from the room or from the panel? You have both options. My choice. Okay. Great. Let's start from the room, since we've heard from the panel. Any views on this? Yes, please.
Hi, my name is Javier Diaz. I represent Bancoldex, Colombia's national business development bank. Players like the Inter-American Development Bank have issued bonds in local currency in Colombia. It's not unusual. I think they should be doing it much more. But that is a factor of how developed your local capital markets are, which in Colombia you could say are relatively developed. So for whatever it's worth, I think that the instrument is there, and there's no crowding out effect. pension funds and insurers have enough of a balance sheet to actually buy into the bonds issued by the multilateral and at the same time buy into the local bonds. But again, I think if something can be taken out of this is you also have to worry about developing your own local capital markets for that to happen. Thank you.
A very important point by Javier. I think in the context of a country that has a very shallow development, local market, what we have experienced, and we had an experience in Rwanda with IFC issuing a local currency bond on the local market, and it was actually priced higher than Treasury because the local players trusted government more than IFC. They didn't know IFC. So it was quite an interesting one to see that it was priced higher. So the crowding out effect did not happen, but what happened is what my colleague from Bank of Industry Nigeria mentioned, which is the cost of fund was so high that it defeated the purpose for the pipeline that it was being raised for. So that's the other side for markets that have shallow, I would say, capital markets. To your question, what could we see happen for a market like Rwanda? It would be to see how do we support the central banks to actually do what they are doing in Nigeria and what they're doing in Rwanda currently. Because right now the central banks are doing it from a development perspective, but when there is a shock, they have to absorb the shock, and that's not their initial mandate. So if you ask the governors of all central banks, they would say, could we have maybe through the SDR, through another mechanism, of way of backing up the central banks to be able to play this role in the market, which is a conversation that hasn't happened yet. Yes.
If I made it something in, I don't know about IFC being more expensive than the market. That seems to be a particular case of Rwanda. But one thing to note, and the World Bank, IBRD directly, for example, in Kazakhstan, issue IBRD a bond to finance a project. When either IFC or IBRD issues in the market, we automatically lose our international AAA rating. So they basically will get the same cost of the sovereign. Not more, it shouldn't be more, but we are AAA local market. So the cost of the funding is the same of the sovereign. But for most of the institutional investors, it goes to a different bucket because although the rating is AAA, they recognize our international. So they go to the bucket of international exposures. So basically, we are not crowding out because typically the institutional investors consider us in a different bucket that they will allocate to a domestic investor. But of course, I think our treasury is very careful not to crowd out the market and to size the impact, not to make sure that they tap that particular bucket.
Thank you very much. I think we've had a very interesting panel. I see the MC is coming on stage, so it's the end of our dance. Thank you very much for your kind attention, your comments. I'd like to take a minute to really thank the panelists for their research papers and accepting to present them today, and the organizers for this session. Have a great rest of your afternoon.
Thank you, Campetta and Thomas in the room. Thank you very much for leading this conversation. Very insightful. I guess, seeing the end, I can sense from the room that there are more questions and you would like to deepen the conversation. You will be pleased to hear that we're moving towards another break. But before breaking up, let me just answer some questions that I got a lot on how to access the papers and maybe some of the materials that were presented today. We just wanted to mention that all the papers, the research papers, are online on the Finance in Common website. You can also scan the barcode outside on the roll-ups. You will get straight to the website where you can download the papers. And if you want to have access to the presentation or maybe the summary papers that were presented to you today, you can get in touch with the organizers. Jean-Baptiste is here and will be happy to send them over to you if that is of interest for you. So as I mentioned, and because we're a little bit behind our schedule, the break is now reduced to 15 minutes. So we're going to go on a break now and resume in 15 minutes at 3:15 here for the last session of the day. Thank you very much.
Thank you. See you around.
1 or 2 minutes for the people who are in the other room to join us. Great. Thank you very much for being back almost on time. We've been quite good on the timing today, so we can be proud of ourselves. We're just 5 minutes behind schedule, which is quite great, given how tight the schedule was. So we're moving toward the last session of the day. We've been having great and insightful conversation from this morning. I feel like the last session is going to be the icing on the cake, as we are going to focus on Africa and how to improve the African Public Development Bank's contribution to the SDGs. For this session, we will be having Barbara Marquito, Head of Country and Financial Sector Analysis at the Economics Department of the European Investment Bank and moderator of the session. I would like to welcome Barbara on stage. And Barbara will be joined in the conversation by Samantha Attridge, Yunan Chen, Jasmine Fouad, and Colin Birmingham. And Charles Odom as well. I'm sorry. It's appeared that you will be joining online, so apparently you made it to the room. That's great. I'm going to hand it over to you, Barbara, to introduce the speaker and lead on the session. Over to you.
Thank you. Thank you very much, and welcome, everyone. I'm really delighted to be here today, moderating this last session of a very rich research agenda. And as it was mentioned, we're going to focus on Africa. We're being kindly hosted here in Abidjan. And we're going to be looking at how African PDBs have coped with the COVID-19 crisis and discuss to what extent they are well equipped to face yet another year of turbulence. Also, PDBs, as we all know, don't operate in isolation, so we're going to also look at how other segments are complementing or competing with development banks, and we're going to give you an anticipation of some of the key results of a report that we're going to launch tomorrow. There is a lot to discuss, so without further ado, I will hand it over to Samantha for a presentation on the resilience and the contribution of development banks to the response to the COVID-19 crisis.
I'm too short. Thank you very much, and really thrilled to be here today and talk about African development banks. I do think there are missing, or I call them, like, don't be offended, the underdog of development finance, and I think it's time for them to kind of be brought in off the sidelines and play their important role. So before I start, I'd like to acknowledge that the paper I'm going to present was co-authored with some colleagues at ODI. Yunan's at the back, but she's today my glamorous assistant because I stupidly put some kind of technology in my slides to kind of flip between things, and I don't have any control here. So apologies, Yunan, but she's co-authored and done a lot of the work with me, as well as my colleague Bianca Getzel, who's listening online. But also I'd like to really thank Cyril and the African Association of Development Finance Institutions, who we partnered with to undertake a survey. And of course, AFD for their generous funding of ODI's work and our interest on national development banks. Okay, so our paper's called Weathering the Storm. If I have the first slide, Yunan, please. I mean, we've heard, I think, about the paucity of kind of evidence on African development banks, and little is known, and there's a huge gap. So this study attempts to kind of continue to develop that evidence base, which I think is really important for informing, more effective policy making, and what we heard in the last session about a much more cohesive architecture and interrelationship between the multilaterals and national banks, especially in Africa. So what did our study look at? 3 key questions, and it's like, did they play a counter-cyclical role, and what did that look like? But also, how did COVID impact the banks operationally and financially? And we looked at that because we wanted to understand how they're positioned to respond and support their kind of recovery going forward, and how well kind of were they utilised and integrated with kind of wider government policy. So those were the 3 questions that or exam questions that we set ourselves the task of answering, hopefully. And our research methods were mixed. Essentially, as I say, we partnered with AADFI, and we undertook a survey of their membership. So they're a continent-wide association of African development finance institutions, and that survey looked at these 3 kind of questions. We also designed a financial template which looked at their kind of P&L and balance sheets and calculated kind of key metrics on kind of profitability, asset quality, capital utilisation, etc., etc. And that was supplemented by some further desk-based research looking into kind of financial accounts. And then we undertook a number of really interesting interviews. I'd like to thank all the banks who took the time to engage with us, and we learned a lot. And there's a lot of exciting stuff happening, which I just don't think is understood. And please read our paper, because there's lots of interesting case studies for some of the things I'm going to mention. So without further ado, what did we find? So I think the key message or takeaway was that we think that African development banks really proved their worth in this crisis. Really underscored that kind of the counter-cyclical role, cushioning the credit crunch. And that was really important as well if we think about the fiscal situation of many African countries, but also their role as kind of agents of industrial kind of change and economic transformation. And we heard a little bit about that we've heard about that this morning. And we think that that role is going to become even more critical because, crisis, I think, is a new normal. They're combining and kind of exacerbating the need and problem. So we think that the role of these banks will become even more important. So the first finding, as I say, is that we found that banks are really adaptable and flexible in their response. The vast majority of them moved to remote working, as one would expect. But also they introduced kind of new technology, for example, to reach kind of customers that they wouldn't have been able to with the kind of closures, for example, but also to facilitate, for example, faster investment approval kind of processes, etc. And they also introduced kind of new streamlined kind of investment due diligence kind of procedures to get money out the door fast. But also we asked the banks, well, what kind of sectors, so we looked at kind of 2019, we looked at 2020, 2021, to see how what were they focused on before the crisis, during the crisis, and after the crisis. And essentially what we found was there was some kind of flexibility in terms of sectoral shift. We heard about that this morning. Really, we see quite a significant increase kind of focus on SMEs, I think, as the backbone to kind of many economies, and that kind of credit crunch, like working liquidity provision, etc. But also, interestingly, you'll see, it's quite small, but you'll see actually in 2020, at least a third of the banks indicated that they stepped in and increased their kind of role in the health sector. And this was including kind of, supporting the the procurement of PPE. In the case of South Africa, kind of supporting the manufacturing of ventilators, for example, and the manufacturing of pharmaceuticals, etc. So that was really interesting, and then it kind of shifted back a little bit in 2021. And some of that was directed by government, as in the case of Ghana. So a number of these banks were quite kind of integrated with the government kind of approach. It was... Interestingly, we saw a slight fall in tourism, and I think that is a representation of the participants in the survey. And some of the banks were very exposed to kind of the tourism sector before the crisis, given the countries that they reside in. And there were some issues, and I'll talk about this kind of with high non-performing loans, and so they didn't want to kind of expose themselves anymore and wanted to diversify their portfolios. But interestingly, going forward, we do see an increased kind of prominence or interest in infrastructure and supporting the kind of green transition going forward. If we can go back to the... Thank you very much. So our second finding, we found that they were counter-cyclical. If we could go to the slide, Yunnan, please. So here, we did some analysis, and as I say, we found that the vast majority were counter-cyclical. The degree of how counter-cyclical they were varied, actually, and it was dependent really or conditioned a little bit on their financial health entering the crisis, as one would expect. So there was a small minority who we've categorised kind of as adopting a more restricted kind of approach, and that was mainly due to their financial health. But actually, COVID, they were undergoing reform efforts kind of as the crisis hit, and that crisis accelerated the need for reform. So they kind of focused a bit more on protecting the bank, but the vast majority of banks actually responded in a counter-cyclical way. And what do we mean by that? So the majority of our banks actually gave some form of debt relief, usually short-term, usually 6 months, slightly longer. And you can see in the analysis that generally was happening in 2020 and 2021. You can see the kind of demand or the provision of debt relief dissipating in 2021. And it was largely in the forms of moratoriums on principal, followed by interest, and then to a more limited extent, some kind of debt restructuring. But there was very little debt write-off that these banks were reporting, and that we see that kind of provision of debt relief, as one would expect, decreasing in 2021. Then the vast majority of banks, you can see in the middle graph, actually increased their lending, their gross loan portfolios. 85% of our survey respondents, I sound like a game show or something, don't I? 85% of our respondents said they actually expanded their lending to new clients, so not just kind of supporting their existing client base, but actually going out and supporting new clients. As I say, we see a significant increase in the loan portfolios. A small minority, in the red you'll see decreased the growing loan portfolios. Those are the banks who, if you like, entered the crisis in a weaker financial position. But not only was it kind of the financial kind of products and response, but they really did change and introduce new kind of products and services. And some notable, really interesting ones we came across was the DBN in Nigeria. They introduced an interest rate rebate product. They changed their strategy as a result of COVID, really to focus kind of on women, for example, and youth, export sectors. And they introduced this interest rate rebate to incentivize the intermediaries to target their lending, and they got a 15% rebate on their product. They introduced something called, I think it was a service ambassador program, so they had people embedded in these banks who were kind of, helping kind of incentivize and direct lending, and that there was a reward scheme kind of going on there. So some quite interesting stuff going on. So if we go back, please, the third finding was that, surprisingly, these banks, actually, the majority of the banks were financially quite resilient to the impact of COVID on their balance sheets and P&Ls. So what do I mean here? So as one would expect, actually, we did see a decrease in profitability in 2020, but then we see that recovered, the bank's profitability is recovered in 2021. But the thing to take away here is that profit levels overall are fairly low, and I think this has implications, which I'll talk about their ability to, if you like, scale their investment going forward, if you like, from returned earnings. They're not hugely profitable, but then development banks don't need to be hugely profitable, but it's an issue about how do we scale investment. And when we looked at kind of what's driving this change in profitability, and what we found was that it was the squeeze on the net interest margin which was driving the change in profitability in 2020, and or changes in the cost base associated with kind of introduction of new technologies, for example, or PPE. The net interest margin squeeze was due to the provision of debt relief and or increased costs of capital. We heard today about a very high cost of capital in Nigeria. But in South Africa, there was exchange rate depreciation, which increased their cost of capital and cost of borrowing, which affected their margins. It wasn't, surprisingly, about a deterioration in asset quality as we look at defined by non-performing loans. And actually what we see in our paper is that the quality of the portfolio remained fairly resilient and actually improved. And again, some of that was down to two factors. One was some of these banks which were undergoing a reform kind of agenda entering into the crisis, but it also leads me on to the next slide, hopefully if I've remembered correctly. And that is the role of central banks, and regulators played a really, really central role in enabling and supporting these banks to respond in the way that they did. And so what did these banks do, these central banks do? Basically what they did was they reduced or relaxed the classification and provisioning for non-performing loans. So if you like, the national banks weren't penalised. And that really kind of like helped these banks respond, and why we don't see this deterioration as well in NPLs. But also things like liquidity, for example. They reduced cash reserve requirements, which enabled the banks to kind of step up their lending because they reduced how much they had to hold kind of like in cash liquid assets. Some banks provided kind of, concessional financing, central banks to the national banks, at 0%, for example, which is very helpful. And those banks which were in a weaker position, the central banks were quite instrumental in engaging with these banks to kind of, if you like, reform, sort out their NPLs and introduce new strengthened kind of risk management processes. A final reflection and finding, which is really important, was these banks are most of them are very, very small. And I'll come back to this. But despite their size, and if you think about the fiscal challenges of many countries, they were able to mount this counter-cyclical response. And it wasn't necessarily financed by public money. So only 4 of the banks actually received a capital injection that we looked at. And that capital injection was part of a recapitalisation programme that was in existence actually before COVID. We don't also see many of these banks. I think earlier on this morning, someone was mentioning that, a number of these banks are managing kind of off-balance sheet funds, and the risk was taken by the government. We didn't see a lot of that. The banks didn't respond that they were utilising kind of public money. What we did find is that the banks actually, how they funded this response was basically they leveraged their balance sheet, they went to commercial banks. The deposit-taking banks, actually, we saw quite a big increase in deposits coming in and, of course, retained earnings. So the message was actually it wasn't public support in the main which enabled this response, which I thought was quite interesting. And if I may just very briefly, so what do we think this means in terms of recommendations? As I say, many of these banks are very small, I think less than, kind of 1.5% of GDP. There's one bank in our sample which is about 10%, I think, in Morocco. So they're very small. Actually, their gearing levels are very, very low. So ADFI has a gearing standard of about 4, and if the banks are, 4 times debt to equity, they're fully compliant with this kind of prudential standard. And actually, Fitch rate that as quite conservative. The majority of our banks were kind of less than 2. So, they're not highly geared. They're small. The profitability is not high. So it's like, well, how on earth are we going to increase their operations to fulfill like the valuable role that they can play. So what do we think? So they definitely need, we've heard that today, increased capitalisation, but also access to affordable capital, because some of the cost of capital is prohibitive. We heard about 20% earlier on, the Bank of Nigeria. I think in Ghana there was an example of a bank, double-digit, 15, 16% cost of capital. You can't do a lot. You can't do a lot with that kind of capital. So they need access to more affordable capital. So some ideas here. I'm no expert on SDRs, to be honest. I'd like to be, and I think that's my next program of work. And there's probably lots of people in here who are, and maybe we can have a discussion about it. But I've heard a lot today about SDRs going through MDBs and then kind of going out. But why could the SDRs be used somehow to kind of recapitalise these banks? And there must be a way to do that. So we've got the 100 billion in the IMF, the two trusts, but, there's also that excess 650 billion kind of floating around. There must be imaginative ways that we can kind of recapitalise these banks in exchange for equity or something. There are a number of banks you mentioned today about DBN, which was created, using with multilateral kind of shareholders, for example. So maybe we need to be a bit more imaginative about what we do with these SDRs to recapitalise them. Increase the borrowing where they can. As I said, their gearing ratios are around 2, so they can at least leverage them till 4 where possible without even kind of breaching these kind of their own internal standards. And then linking to an issue mentioned earlier on about tapping the vast source of kind of local savings. There has to be some interesting stuff that can be done there. Finally, issuance of sovereign guarantees is an interesting issue. Many banks said that they were unable even to access international concessional finance without a sovereign guarantee. And this was an issue, I think it was in Tanzania, because of their issues on the sovereign side on debt distress about the government and central bank not necessarily wanting to issue a guarantee. But I think this issue about the support of the sovereign in terms of guarantees, enabling these banks to leverage and borrow is very, very important. And further, Fitch actually, when they rate the banks, it's actually much more about the willingness and ability of the sovereign to support the bank than actually the bank's financials necessarily itself. Of course, expand the equity base. And we've came across some really innovative balance sheet kind of operations, if you like, the use of callable capital insurance, for example, which TDB uses, if your shareholder, capital credit rating is not particularly high, for example. So there's lots of exciting things that could be done kind of like with insurance products as well. I'm going to stop there. There were some other ones. Maybe just one last one. There were for the importance of regulation. And I think it's incumbent on kind of governments and regulators to look at this issue about, I know in some countries they might be regulated in the same way as commercial banks, and whether or not that's the right thing to do. Because what we've seen is that the differentiated regulatory approach enabled a particular response. And I think these regulators and governments should be looking at the regulation of these banks and just seeing, if there's anything that could be done in terms of the regulation which would enable these banks to fulfill their development mandate. Thank you.
Thank you very much, Sam. And we will zoom in now on some specific cases. And Charles is going to give us a presentation on a number of country cases. So we go from theory to practice.
Okay. Presentation coming up. Okay, so I'd like to thank AFD for inviting us to participate in this conference. Just waiting for the presentation to come up. Yeah.
Do we have a presentation?
Yes.
It's coming?
Okay. Yeah. Mm-hmm. Okay, so before it comes up, I lead a private sector development work in assets, where we working with SMEs to see how we, at the macro level, de-risk that particular sector and driving private capital. And at the micro level, working with them directly to show up their capabilities to make them investment ready so that they can attract suitable private capital. And in doing that, ODI had done an earlier work on governance and performance of public development banks, and became interested that they go deeper to look at the sensitive issues. So this study looked at the political economy and how it affects their performance. And we got support from AFD to look at 4 countries. That's Ghana, Rwanda, Tunisia, and Cote d'Ivoire. And in these countries, altogether we looked at about 6 banks. Ghana, we looked at the Agri Development Bank, and then the National Investment Bank. Rwanda, we looked at the Rwanda Development Board, whose CEO was here earlier. And I hope she was here to listen to some of the interesting, those sensitive issues that popped up. And then in Tunisia and Cote d'Ivoire, we looked at SME financing banks as well as investment banks as well. Please go on. So basically, based on the work that ODI did, we set out to answer 3 questions around the political economy, and these questions are focused on political influence. So what we're looking at was the relationship between the government or the political. Just a second. So we're looking at the relationship between the bank and its national governance and how that had integrated it or insulated it from political influence, either negatively or positively. And then we also looked at the questions around the operations and performance, and then the enabling environment. The main objective was to explore how the development activities and impact of national development banks and the financial governance and business models and reform changes. Can you please go on? Now, the case study was structured around 6 key areas. We looked at the evolution of the bank generally and its history and how its mandate had evolved alongside the business model. We also looked at its political economy and the institutional context where we analyzed its profile and the legal instrument that sets these banks up. We also looked at the corporate governance and the political influence itself. So at the corporate governance level, we're looking at what the appointing authorities, what kind of influence do governments really have on the banks, and how that influence actually impact the performance of these banks. We know that the development banks usually set up to support government around its policy agenda, and therefore most often they're not in countries because funding also comes from government. You see the appointing authority is usually the government itself. And then we looked at some of the major achievements and challenges of these banks. Now, this is a purely qualitative analysis, a qualitative study that we undertook. And like I said, there was some initial work done by ODI, so this work was actually heavily informed by that. And then we did quite a number of DEX research, looking at corporate reports, looking at articles and journals, and also books that have been written on development banks. And then we conducted a number of one-on-one interviews. These one-on-one interviews, we spoke to people, current employees and former employees. We also looked at the senior management and board members, both current and ex. The reason we did this was that because of its political sensitivity, it was very necessary to try and get both sides of the divide when it comes to the bank's governance, especially where in the countries that we found that the senior management and the boards usually change with changes in government. And then we also undertook focus group discussions where we tried to bring these different stakeholders together to speak, and that really helped us to water down exaggerations that we found from the one-on-one interviews. And then we did validation workshops in all the countries to look at. We also took the opportunity to use these validation workshops to look at some of the issues at the time, especially when it comes to AFCFTA, at the time where we're conducting this, that the role of development banks, how could they actually support the actualization of the gains or fortunes of AFCFTA. Now, so what are the outcomes? This, like I said, this is a synthesis report, so we'll try to give you a few synthesized insights that we got. On the evolution of the banks, what we realized was that most of the banks' development mandates, for establishing them, because most of them were established through legal instruments or legislative instruments, remained. But in practice, there's been a lot of evolution. Most of them have moved, some of them have moved away. The only good one example that we found that really evolved to realign itself to its main mandate was the Development Bank of Rwanda. But in countries like Ghana, the two banks that we studied had completely changed their business model to become commercial banks, so they were no more acting as development banks, though they were actually still supporting some government projects and some government policy agenda. In countries like in countries like Tunisia, where we found that there's been a lot of confusion because there's no single instrument really defining the mandate. And so the evolution had happened over time without any specific focus. It's gotten them to really drift from their focus. Now, on corporate governance, and then the institutional context, looking at also from political influence point of view, it is very evident that because the government is the main appointing authority, and it appoints board members, and in some cases, senior management as well, what you see is that government has some very negative influence. That's usually the interference when it comes to lending decisions, investment and financing decisions. To the extent that a case in Ghana where sometimes not only is the senior management as the CEO appointed, but also the CEO is able to come in with his whole set of other supporting executives just to be able to drive a political agenda at the point in time. But we also see that there are some institutional frameworks that try to water down some of these influences. So, for example, the regulatory bodies like the central banks do have prudential requirements for these banks, and that really somewhat helps to check some of these political influence, because at the end of the day, the banks need to meet some of these, especially Basel requirements for them. We also saw that when it comes to, for example, appointment of directors, the central banks do have a requirement that all these directors that are appointed should pass, at least. So they are submitted, and these people pass basic requirements to be able to get them appointed. But nevertheless, governments are still able to...
1 minute to wrap up.
Governments are still able to carry through their agenda in many cases. On the economic context and business model, like I mentioned before, some of the banks evolved, and the good case we saw, like I said, in Rwanda, it evolved, though. At a point in time, it actually even created commercial banks and then spinned it off just to be able to come back to its development mandate, to be able to support government development policy agenda. Now, in terms of major, some of the achievements, we've seen that in these countries, despite the negative impact that we see political influence or undue political influence bringing, we realize that these banks have financed some very important and strategic assets when it comes to, for example, in Ghana, the first modern markets were financed by NIB, and we've also seen a number of agri and rural development projects usually financed by these development banks. Now, let me quickly touch on the conclusions and then the lessons that we've learned from this. And then some recommendations, probably more of the recommendations, because I'd mentioned a lot of the insights. We believe that when it comes to regulations and supervision, these banks these banks could actually go back, or the establishing instrument or legislative instrument that established them could be reviewed, because some of them, none of them have been reviewed over the decades that they've been set. They could be reviewed to really be able to, they could be reviewed to actually realign their operations and make them more profitable or more effective in delivering their agenda. And for countries like Ghana, where we saw that there's been a complete shift from their development mandate, Ghana has established a development bank, which is a wholesale bank, and we actually recommend that the two development banks should be retooled to become retail development banks, because they started as development banks and they do have the DNA to truly support the development agenda of the government. Okay, so I think I'll end here.
Thank you. Thank you very much, Charles. And we continue with another country case. Yasmin Fouad is going to give us an overview of the ecosystem for development banks in Egypt.
And in just 4 minutes.
Thank you.
Good afternoon. It's usually difficult to be among the last ones to present, because everything has been said, but I think you made my job easier because you've said everything, so there is very little that I have to say. This paper has been co-authored by myself, and I have my colleagues, Dr. Shahir Zaki from Cairo University, Dr. Wissam Sharif from the American University, and Mr. Mohib Saeed from the ERF. And I'm also very thankful for the help of AFD and being invited amongst such a very interesting group and a very exciting panel that we shared some good Zoom meetings before coming here. Our paper is titled Public Banks and Development in Egypt, Overview, Issues and the Way Forward. So you can see here that the focus has changed a little bit about what we've been talking all day. Because in the paper, that I'm not going to go through all the details, but it's 7 parts, we mapped the banking sector in Egypt, and then we realized that, like Sam said previously, that the public development banks in Egypt are very, very small, and they are historically, they've been there since the 60s, but they have a very limited role to play, especially in the current economic issues that are very important to Egypt. And therefore, we said who's driving the economic process and who is funding the main economic development projects in Egypt, and we realized that these are the public commercial banks that are actually doing this part. And therefore, our case was based on the 3 main public banks in Egypt. We did in the actual paper a literature review. We did and the mapping. We compared Egypt to other emerging countries. We found that we were quite underbanked with quite high reserve requirement ratio that has also been increased after we did the paper. So still, we came up with several lessons learned that can be interesting in the African context and also globally. When we came to the public development banks, we said it's important for us to discuss this, and we said, okay, who's the driving force, like I said, for the development projects? And we found that, as I said, it's the 3 main banks that are the National Bank of Egypt, Bank Misr, and Bank Jeker. Next slide, please. The methodology that we used was, after that we did the desk review, we decided to go for a survey where we covered the same questions that have been repeated today about the legal context, the governance, who's the owner, what is the mandate of these banks. And then we realized that that the 3 public banks in Egypt, who are the largest bank in Egypt, also they cover depositors from 3 million to nearly 20 million depositors in the National Bank of Egypt, that they were the ones that are really doing the developmental role of funding the major development projects. We also found that after in order to dig deeper after the desk review, we decided to go for a survey of 25 questions to answer these questions. We shared it with the banks in Egypt, and we came back with the results, and then we shared another round of detailed interviews via Zoom with the high-level management in these banks, to also ask several questions that were not very clear from the survey. And then we could reach a number of quite interesting results. Next slide. The main results were that these banks played a very important role as economic stabilizers. And if you look at the data of the macroeconomic data of Egypt, you will find that during COVID-19, Egypt suffered, of course, from a decrease in the GDP growth rate, but not like many other countries. We had quite important financial resilience. And this was due to the really backup of these banks to the initiatives while we are embarking on reforming the infrastructure, we are building a new administrative capital and all that. Still, the funding was there and the projects could continue. We found that these banks also played a very important role in promoting SMEs. We have various projects in the agricultural sector, in the industrial sector. We have projects that are aiming youth. We have projects for the underprivileged that they funded. Housing for the middle class were funded by these banks, etc. What was also very important was the idea about financial inclusion. We said also at the beginning that we are underbanked. We have a low number of bank branches and bank ATMs, etc. But we are, in that sense, moving quite quickly. The National Bank of Egypt said that they aim to open from 10 to 20 new branches per year over the coming period. So they are like trying to overcome these gaps. Digitalization was also accelerated by the fact of COVID-19. So the steps that were undertaking and switching the whole banking into an online platforms and insisting that the depositors should use their online banking, etc., has been very fruitful. In terms of gender equality, the Central Bank of Egypt introduced a law that says that 2 women have to be on the boards of all the banks in Egypt, which has also been implemented and emphasized. And last but not least, we found, okay, what led to this success of these banks, or what were the variables that availed them to have these good results. And we found that this was due to high capital adequacy ratios, good liquidity, and low levels of non-performing loans, and also the regulatory and legal reforms that have been undertaken over the past years. We could benefit from that and reap the fruits of that. So I come to the last part of my presentation, which are the policy recommendations. And here I focus on 4 points. The first thing was that in order to maintain this role and in order for the public banks to play the important role that they do in development, that they have to have 2 main characteristics, which are independence and flexibility. So the banks that were independent and that were flexible, those were the banks that could push the situation forward. The second thing was that the variables that were important, as I mentioned, was the high liquidity and the low non-performing loans. Another important thing that was introduced in the banking sector in Egypt since 2008, but was updated over the past 2 years, was stress testing and insisting that the banks should do that on a very regular basis. Last but not least, while COVID-19 accelerated the introduction of digitalization and the use of platforms, it is very important that we secure these platforms, and therefore we call for laws and regulations by the Central Bank of Egypt so that this is a secure way of allowing depositors to interact. And this has already the Financial Regulatory Authority, which is the regulator of the non-financial sector in Egypt, has already introduced a law. So we hope that the Central Bank of Egypt can follow suit. Thank you very much.
Thank you, Yasmin. Thank you. And then we have one final short presentation by Colin, who's going to give us a short preview of a report that we're actually launching tomorrow. And we're switching the focus a little bit to commercial banks in Africa. And then we can discuss together whether they are complementary or competing. Colin, over to you.
Thank you very much. And I'd also like to thank the organizers for inviting me here to speak today. I'm very happy to be here in Abidjan. As Barbara mentioned, we are formally launching our Finance in Africa report for 2022 tomorrow. It's an annual report. Next slide, please. It's an annual report, and the cornerstone of the report is a survey of the commercial banking sector. So this year we had a survey of 70 banks in sub-Saharan Africa. So all the results I will talk about today in terms of the commercial banking sector will relate to sub-Saharan Africa. And for us, as a bank who are active on the ground with financial sector counterparts, the survey is a kind of a key tool for us to understand how to best engage with financial sector counterparts to maximize the impact of our operations. The survey was in the field this year between April and early June. Most of the results would have come in April and May. So it was after the onset of the war in Ukraine. So the war had already begun to shape banks' perceptions. But of course, the issues that we've seen, the financial spillovers that we've seen from the war, things like advanced country central bank policy tightening, that's accelerated. Since then, it's accelerated in Q3. Similarly, if you look at the impact on sovereign bond spreads in emerging markets, that's continued to kind of ratchet up over the course of the year. So while the survey kind of captures the perception of banks after the onset of the war, no doubt some of the issues that have faced the commercial banking sector have continued to intensify. Now, one of the questions that we ask is, what are the big concerns facing the banking sector? And one thing that emerged this year in particular was the cost of local currency funding. So over half of the banks in the survey were citing that as an issue or as a concern. In comparison, last year in 2022, in 2021, it was barely an issue. There are, of course, the banks still have other concerns. Asset quality remains a concern. I would say it's not quite the dominant concern that was, cited last year following the onset of the pandemic, but it's still a big issue for a lot of banks. And in fact, if you look at the chart on the right there showing the NPL ratios by firm type, you can see that asset quality issues are persisting. They persist in particular for SMEs. More than 4 out of 10 banks in the survey said that more than 10% of their SME loan book was non-performing. And that's not quite double, but not far off double what you see in terms of the NPL rate for the larger corporates. And it's not just NPLs. There's also loans which are subject to moratoria or restructuring. So the NPL issue is still there. We haven't seen it reflected, to a huge extent in terms of official NPL statistics in a lot of countries, but we know that a lot of the, prudential support measures that went in place after the pandemic, which allowed banks to maybe change the classification of NPLs, a lot of those remain in place. And also a lot of the official data for NPLs, they're still kind of dating for a lot of countries, 2020 or early 2021. I suppose the concerns that banks have in terms of asset quality has an impact in terms of their lending standards and their underwriting standards. So last year when we surveyed banks in 2021, what they were broadly expecting was that lending standards would be fairly neutral, in the sense you would have a similar amount of banks tightening and loosening lending standards. Now, in the end, there was actually a net tightening of lending standards last year in 2021. And what banks are saying in the survey this year is they expect another significant net tightening. So we're going to have 3 consecutive years where the commercial banks are going to be tightening their lending standards. But it's not all, it's not all gloomy news. We do see some optimism in the survey. So, for example, 89% of the banks that responded are expecting to expand operations in 2022, and that was up from 81% when we did the survey in 2021. Another issue that's facing the banking sector at the moment is, the issue of loans to government and crowding out of the private sector. We've seen several countries where you have, an increasing exposure of banks to public debt as a percentage of their their total assets, and moreover, the countries where this exposure is greatest tends to be the ones where the sovereigns are the least creditworthy. So, for example, in the chart on the right there, showing some of the countries with the biggest exposures to public debt. With the exception of Egypt, every country on the chart either has a C credit rating, or if it doesn't have market access and doesn't have a credit rating, it's in high debt distress, according to the IMF, or in debt distress. So you have, you have banks which have large exposure to sovereigns where sovereign creditworthiness is declining. We also have some thematic elements to the survey. So we ask questions on, gender, digitalization, and climate. In terms of gender, we see the banks, they're doing more on gender. So this year, 70% of the banks that we surveyed had a gender strategy. That was an increase of 10 percentage points on the survey last year. And we also have nearly 60% of banks which have financial services which are targeted at women. Another question in the survey is whether the NPL rates on loans to female-led businesses differ to those on male-led businesses. So for almost 3 out of 10 banks, they observe no difference, but 4 out of 10 banks report that the NPL rates are lower on female-led businesses compared to male businesses. And this is something which the IFC have also reported in some of their work, where they see lower NPL rates in their loan book. And there are countries also where it's even higher. So, for example, when we see the results from the Nigerian banks in our survey, 70% of them say that the NPL rates are lower on female-led companies, or 50% in Kenya. So it's quite a widespread phenomenon. Finally, if I'm just going to mention some of the climate findings. So we see that, again, despite the challenging conditions, the banks are remaining focused in terms of climate issues. The charts on the left there relate to climate screening. Banks are doing more to screen the climate risks in their existing portfolio. So the first 2 chart bars on the chart on the left there say there hasn't been a huge increase in the amount of banks that are, actively screening the portfolio compared to last year, but there's a very large increase in the banks that are planning to do it, that weren't planning to do it last year. So, we see more intention to do work on climate screening. Similarly, for new projects, there's a little bit of an uptick there as well in terms of banks planning to do more. Banks would also like to get more involved in terms of climate lending and climate funding. 80% of the banks who have a climate strategy, they would list this as a reason they want to take advantage of these opportunities. But we see a huge gap in the survey between the amount of banks who would like to, get involved in these sorts of activities versus the banks that are actually involved. And one of the reasons that the banks haven't been able to do this is 60% of them cite a lack of technical expertise in terms of these climate issues, in terms of identifying the climate issues, climate risks. And similarly, 2/3 of the banks are saying that they think a key way that the IFIs and the development banks could support them is with more technical support, in relation to green lending. So I think that's a kind of a clear, policy takeaway for us. So, like I mentioned, the report will be officially launched tomorrow afternoon. So, please check it out. Thanks.
Thank you, Colin. Okay, my plan was to have a quick round of questions with the panelists, but from myself, but I think the presentations have gone a little bit longer than planned, so maybe we can have a first round of questions from the audience, I don't know, or in the chat. I don't know if we have comments or questions in the chat. I see a gentleman, and please introduce yourself, and then there is somebody also at the back.
Okay. Good afternoon to all of you. Sorry, due to flight difficulties, I have had to be late coming here from Accra. I stand here in my capacity as the Vice President of All Africa Association of Small and Medium-Scale Enterprises. I'm also the Chairman of the Agribusiness sector of the Association of Ghana Industries. Just a month ago, we met at the First African Union AU Summit for SMEs, and we discussed access to finance. So I think this is very appropriate discussion, and I'm happy to be here in spite of the difficulties I faced early on. Just a week ago, we also had a discussion on access to finance for SMEs. I mean, no doubt, the COVID-19 and the Ukrainian and then the Russian war has caused a lot of disruptions. And we, the SMEs, have been the biggest hit. And Charles' presentation, he's also did a presentation on Ghana. And I also want to say that currently the central bank is offering a base rate of 24.5%. That's the base rate from the Central Bank of Ghana. We also have the interest rate, the cedi has depreciated over 40%. And we also have an inflation of 36.7%. I mean, can you imagine this? How can we, the SMEs, compete in the market, and our businesses, are suffering? So I think I may want to implore this occasion to look at maybe an innovative way of co-creating strategies that will help the SMEs to take advantage of the emerging financial market. And currently, the African Union strategy for SMEs, we are looking at what we call the Enterprise Africa Network, EAN. And the strategy seeks to link the SMEs appropriately to the African Continental Free Trade Area to leverage on capital financing that would eventually leapfrog us into industrial park and then special economic zones. So I believe that, yes, all these are very appropriate. The discussions have been very appropriate. And I want to see more synergies that we would do to be able to support the SMEs. Because if the SMEs don't stand on our feet, the youth unemployment is high. And this is a special appeal.
Thank you very much. Can we get to the question?
All right, so the question is, how is this forum actually collaborating with the African Union strategy, SME strategy forum, so that we can have a more direct, a more robust focus for financing and then improving the access to finance? Thank you.
Thank you.
Thank you very much. I think there was another gentleman, and please introduce yourself and try to keep your questions short, your remarks short, because we have a few more. Thanks.
I'm Mr. Donald Coro, CEO of the Euxon Consulting. My question is simple. I just telling a story about myself, and you understand. I was working at the hospitality industry. So, because of COVID-19, all the things have been dropped. But now, because I learned finance before I enter in hospitality industry, now I can convert myself in the other industry. But a part of me, there are some of the young men, as you said, like me, who have lost the job because of the COVID-19. How they convert from the one industry to another, and how the development bank, the central bank, have been prepared to help them to convert. So I want to know. That's my question. Thank you.
Okay. Thanks a lot. Maybe we'll take a couple more. And
maybe, Barbara, before moving to the next question, we would like to really ask the people to get to the question, because otherwise we won't be able to take as much question as we want.
Yes, yes. And also, to stay on the topic.
Yes, good afternoon. Jean-François Klein from the International Labour Organization. Thank you very much for the panelists for a very interesting session. I just wanted to come back to what you said. I'll be very brief. Charles, about the political influence, and I would be actually more interested to know about the policy influence of this public development bank. And if you recall, in the fixed declaration, the idea was that public development bank would also strengthen their policy influence. And what I would be particularly interested to know is to what extent these public development banks are actually supporting and aligning and contributing to the national development policies, employment policies, trade policies, industrial policies. I think this is absolutely key, because we need to know what they can do in terms of also strengthening and adapting their financial and non-financial products, through feedback loops, to make sure that at the end of the day, they contribute also to target, most vulnerable segments of SMEs or of the population. And I think this link to policy development, I think, is a little bit missing. So I wanted to know whether, as part of your research, you've came across any such alignments or evidence. And I think the shift from public development banks to commercial development banks is perhaps a worrying trend, and I wonder what you think about that. The ILO has just completed now a employment expenditure review in 7 countries, including Tunisia and Rwanda, and it's quite interesting to also see to what extent government are fulfilling their commitment in terms of expenditures related to employment, including, of course, the role of public development banks. Thank you.
Thank you. Maybe just one more, and then we give the floor back to the panelists.
Hi, thanks so much to the panel. Yunan Chen from ODI. I'll be very brief. Actually, maybe just quickly to respond to Jean-François' question, something that came out of our study is also that in quite a few of our cases, African PDBs did play an advisory role to the government in informing the COVID response. And there's some interesting cases where they conducted studies, they targeted certain sectors, and really played a sort of consultancy role to the government. But my question is to the wider panel, but specifically motivated by Colin and your presentation. Given that we are in an era of high debt risk and debt distress for many sovereign governments, governments are unable to provide sovereign guarantees in many cases, which some of the PDBs in our study that we found really required to be able to access international finance. So given that this constraint on PDBs to international finance really depends on the financial structure, the constraints on the government, what are some of the solutions to that? How do we navigate this challenge? Thank you.
Thanks. So who would like to start? Maybe Charles, you want to go ahead with the... Yes.
So I'd like to take your question first. You're asking to what extent are government fulfilling their policy agenda through the public banks. In our study, what we found out was that in most of the public banks in Africa, the main challenge has been funding. So government set it up as the main shareholder, but could not further fund them. So then what happened was that these banks decided to go to the market to raise their own funds. Now, in the situation where you see banks actually becoming commercial, is because once they get into the market and raise funding together with commercial banks, then they actually are responsible to the central bank in terms of the reporting requirement and all of that. So then it becomes very difficult to fund policy agenda looking at the long term. So what happens is that government still try to find a way to get its agenda through the influence that I talked about. So because they've appointed the boards now force management to eventually lend to those particular sectors or support those policy agendas. And then also sometimes because of lack of analysis for policy direction, what happens is that they force these banks to lend to sectors that increase NPLs. And that becomes the journey for these banks going to the problems that we see. So it's not a matter of the banks not wanting to do that. In fact, they become very able partners to government over a very long time. But obviously with these key challenges that come in due to financing, and eventually once they access funding from the market, from other investors, then the reporting requirements or their obligations to those partners kind of supersede that of government. Yeah. On the question from our brother from Ghana, in terms of what public banks could actually do to support the SME space. I think that in this particular era where we're still recovering, what I would call is winning in these challenging times. Now, what we saw banks doing, including even the public banks, in these challenging times is that most of them were actually strengthening their balance sheets and optimizing performance. Now, the third thing which most of them haven't done, including even commercial banks, is actually positioning to win. Now, when I'm talking about positioning to win, what I mean here is where especially public banks start to invest in infrastructure that would eventually make it more attractive for other funding or other investments to come into the space to work with SMEs in that manner. I mean, we realized that, or we saw that, especially the Russian-Ukraine war, because of the commodity-induced inflation, local funding is becoming very expensive. And that's where you see countries like Ghana, with our monetary policy pushing interest rates up, coupled with inflation and all of that. Then it becomes very difficult for even banks themselves to access funding from within, less SMEs, who will usually borrow at minimum over 40%, and you know that. And in some cases, it goes all the way to 120% when they access funding from the non-banking finance institutions. So I think this is where we're going. We need to position ourselves to win by investing into infrastructure that will make it more interesting for other private funding to come in, invest, and work with SMEs. And I can say, okay.
I mean, I can just check the paper. My memory is failing me in my old age. But in terms of kind of the more of the policy kind of linkages and policy support and integration, we saw in Tunisia in particular, so work that the Tunisian Development Bank was doing informed actually the budget formulation over the last few years. And a number of these banks we saw in Tunisia, the East ECOWAS, EBID Bank, and also in Tanzania, undertaking kind of studies on behalf of the government to understand the impact of COVID, which then kind of informed government policy in terms of support, but also the development of financial instruments, and there's some discussion of that. And in previous work that we've done, we have come across, I think, the Development Bank of Uganda, the Uganda Development Bank, as well as quite closely integrated in terms of kind of government policy, but also influencing influencing government policy in that way. But also they play an important role. We've come across examples where they're actually also kind of advisory in terms of kind of structuring and negotiating kind of infrastructure kind of development as well. So kind of there's the policy level, and then there's the kind of practical kind of where they have the expertise to kind of structure things which the government doesn't necessarily have. And actually sometimes you see some banks then, the government actually, I know in PTSMI in Indonesia, the kind of the hub of expertise in that area is so strong that actually the government kind of, if you like, allows the bank or asks the bank to be custodians of a lot of external kind of concessional resource. So if you look at SDG Indonesia 1, for example, they can play a very important role.
Thank you. And I think the macro question is for Colin.
Thank you. So I don't know if I can give you any kind of easy solutions, but I can give you more problems if you want to hear that. So you mentioned the increase in sovereign risk and how it's making it more difficult for them to for the sovereign to issue these guarantees to the public development banks. There are even more problems, I think, here. So the sovereign obviously usually has like an implicit guarantee for the banking sector, also the commercial banking sector, and at a time when the sovereign risk is elevated, the value of that implicit guarantee weakens. So this is probably another factor which is contributing to increased local currency funding costs, particularly on the bond market. So as we saw in the report, there was a bit of an increase in the amount of banks that were looking to expand their operations. That obviously means an increase in their funding also, in their local currency funding in particular. And what the banks said in the survey this year is that they're probably going to try and reduce their reliance on local currency bonds, which are becoming more expensive, and maybe try to increase their access to IFI funding. So you're going to have an increase in probably in the demand for this funding at a time when it's more difficult as well for the government to give that implicit guarantee that is needed. As economies get weaker, there's a lot of factors at play at the moment that could be pushing up on non-performing loan rates. So lower economic growth, higher inflation, higher domestic interest rates. These all challenge the abilities of households and firms to repay their debt. And it could be the case that the banks, the commercial banks, that is, start to perceive the private sector as even more risky, increase their kind of bias towards public sector lending more, and you get even more of a restriction in credit to the private sector. So I think there are several issues. I think the issue only gets better when sovereign creditworthiness starts to improve. At the moment, if you look at sub-Saharan Africa, if you look at the share of debt servicing costs as a percentage of revenue, it is both higher and rising more quickly in Africa than in any other developing region. So there isn't any forecast at the moment that things are going to get immediately better. Obviously, you have support from the IMF. I think half of the countries either have a program or are negotiating a problem. So I think it's about trying to get sound policies in place, more support, maybe some of the issues people were talking earlier about, recapitalization of the FIs, but I don't think there's any real easy answer here.
Thank you, Colin. I don't know if there are any other questions from the audience. There's a gentleman at the back of the room.
Thank you very much. Francesco Rampa, European Center for Development Policy Management. I'm a bit surprised that today there's not a lot of talk about food security and agriculture. And the triple-double crisis is really pointing to the fact that to give employment, to sustain livelihoods, and also to adapt to climate change, there should be definitely more public and private investment in agriculture. So I was wondering, why isn't that happening as a crucial part of the transition? if we don't solve that issue, especially in Africa, there's not going to be any sustainability, really. So is there any case, is there any element that the panelists can give us about a public development bank that has actually tried to do more in agricultural development and food security? Thank you.
Thank you. Who would like to take? Yasmin, maybe you want to come in on that one?
Yeah, in Egypt, the public banks that I mentioned, they have, in terms of irrigation and so on, they are sponsoring some projects. So agriculture is on the agenda of the public banks, but we talked previously about the private banks. Here I don't have information, but I doubt that this is on their agenda. But in terms of the public banks, there is a lot of work. We are also trying to improve the production of wheat in Egypt because we are importers of wheat, and this is a lot of financing is needed to do that, and this is done through several initiatives by the 3 public banks that I mentioned.
Sam or Charles, would you like to add on that?
I mean, just to add to what she said, the banks that we undertook the studies on, you see that in their mandates, especially in Ghana, specifically it's agriculture. I mean, though some of them have become commercial, with the current government's agenda, those are referring back. Like I said, some of them are actually evolving to realign themselves to the original mandate, especially in these turbulent times where the economies need to recover. They're looking at going back into the original mandate. So some of them are looking at industries. And when they look at industries, they look at value chains. And then eventually you realize that agriculture becomes one of those important sectors within the value chains to really drive the growth for this recovery. So yes, you may not see them as direct, but the interventions are going towards those value chains that eventually also pushes funding or financing into the agri sector.
Just to say, in one of the sectoral kind of priority kind of analysis that we did, we actually saw the majority of the banks were more frequently focused on agriculture and agriculture-related industries. There was a slight kind of shift in prioritization with the impact of COVID, but we don't know whether or not that will shift back. But there's a figure in the paper which shows actually many of the banks that we studied were quite focused on agriculture as a priority sector.
I saw a hand up. Thank you.
Thank you. Melson Mbalo from Maastricht University in the Netherlands, assistant professor. My question is related to what he was mentioning with the fact that the astronomical interest rate here in Africa, which is practiced across different countries. So my question is related, since you guys are basically, in the industry, how can we reduce this interest rate? How can we mitigate it by, providing assurances to investors and so on, in order to increase the capital flow within the African continent, to, impulse the investment and the development of industries and so on. And also, would you guys consider basically, for instance, creating a new rating agency for Africa in order to compete? Because basically, I personally feel like there's a huge bias from some of the credit rating agencies that are located basically in the US and in the UK in regards to many of African financial institutions. When it comes to rating of these institutions, a lot of reasoning used as for the reason for these ratings, basically because of the risk associated with these investments, and it's probably warranted. But my question is basically, how can we mitigate this thing? How can we change the status quo by increasing the capital flow within the to Africa? Because it is understood that there's a lot of capital stuck in the West, basically providing no return. Especially from the institutional investors. So how can we, as Africa, create mechanisms to attract these investments, especially from institutional investors, basically from the Western countries? Thank you.
Thank you. I think the rating agencies part, unless there is some rating agencies in the room, we will leave it for another time. But maybe on capital flows, Colin has done a little bit of work in the Finance in Africa report. He can tell us how they have been evolving through the COVID crisis and whether there's any sign of pickup, and then if others want to add on interest rates.
Thank you. So when we looked at the amount of financial interconnectedness, what we've seen over time is Africa is becoming more connected globally to the financial system. So if we look at measures of financial integration, which look at the total external assets and liabilities of a country, what we see is that these measures of financial integration are increasing across all regions in Africa over the last 10 or 15 years, certainly since 2010. And where we kind of stand is like in West Africa, it's at about 75% of GDP, and it's more than 100% of GDP in East Africa and Central Africa. That would still lag what you would see in developing Asia or Latin America. It would be more like 165, 175% of GDP, but there's certainly been an increase. Southern Africa is completely different. It's 400% of GDP there because of the very large size of the South African financial system and also in Mauritius. So this increase over time in financial connectedness has benefits like you can borrow more to invest when domestic savings are low. You can engage in more portfolio diversification and kind of risk sharing. But obviously, as you become more connected with the kind of the global financial system, you also become more susceptible to global shocks. And that's been an issue over the last couple of years, where we've had the pandemic and the war. So, for example, what we saw during the pandemic in Africa was that, generally speaking, there were outflows of equity liabilities across most regions. So, when you have these periods of heightened global risk aversion, you get capital outflows. And I guess it's it's kind of one of the side effects of the increased globalization. Interest rates, yes, interest rates are higher in Africa. Obviously, there's been a big impact in terms of like the kind of the food and the energy prices. I think if you look at most regions, inflation is probably more sensitive to food than it is to energy, because food has a bigger weight in the inflation basket. And it's going to take a while for these inflation rates to come back down, and I think until that happens, we're not really going to see the kind of the central banks reduce their interest rates. Like we're in a situation now globally where more tightening is likely, even though we're kind of looking at a sharp slowdown in global growth at the end of the year. But there are things you can do to I think to improve the situation. Obviously, countries where you have kind of good governance in place, deeper, some more developed, equity markets, things like this. These can help, but I think it's going to take a bit of time before we're back to any kind of sense of normality, because for sure capital outflows are an issue again this year. We don't have a lot of data for Africa, but what we're seeing for other regions is that it's more or less on a par with what we saw during 2008, during the global financial crisis. Not quite as bad as what we saw during the year of the pandemic. Thanks.
Thank you, Colin. I'm told that it's time for a wrap-up, and I will try to take away some key messages. This was my promise to Regis, because I was the one insisting to have this meeting before the summit, so that the research could speak to the policy dialogue. and a few takeaways from this session, but I think some of the messages have resonated throughout the day. We had heard since the morning, in fact, that PDBs have been resilient and adaptable. They have helped responded to the crisis, even with some innovative solutions. So they can play a critical role in building resilience, in being agents for national economic policy, and even to serve as think tanks. On the other hand, I mean, there is no room for complacency. A lot needs to be done to strengthen them, to make them more efficient. And we heard a lot about PDB's need for independence, for flexibility, and for the right expertise. So that brings me to the importance of a well-functioning governance system, sound regulatory framework, and we've heard a lot also this morning about really robust credit risk management, which is super important for PDBs to be well-positioned to be effective and in fulfilling their mandates for SMEs, for global value chains, and for climate lending and digitalization. So I think these are some of the key messages that we're going to bring tomorrow. All the papers have been posted online, so I would like to thank you very much for your patience. It's been a long day, and I maybe hand it over to you for a quick closing word. Thank you so much.
Yes. Thank you, Barbara. Thank you all. We have reached the end of this research conference, which I recall was held under the auspices of the third edition of the Finance in Common Summit. The summit is going to be held tomorrow and on Thursday in this same venue, in the bigger room. We have been discussing on how the public development banks can play a greater role and maybe a more pivotal one in the transition towards in a greener and just transition towards sustainable recovery. This, as Barbara just mentioned, this conversation have been generated a lot of ideas, a lot of takeaways and insights that will be put together and be published, made public ahead of the conversation of the summit that will be happening with the policymakers and the practitioners. The conference was co-organized by the African Development Bank, the French Development Agency, and the European Investment Bank that I would like to thank for having us today. I would also like to thank you all, the speakers, the moderators, but also you, the attendees, whether in the room or online, for the great and very insightful conversations. I would like to encourage you to take the conversation further and to reach out maybe directly to the researchers and keep the conversation going. As we mentioned, all the research papers and summary documents have been made available online, and you can also receive the presentations and everything that was presented to you today by asking to the organization team. So Jean-Baptiste is right behind and would be happy to help. So now, just again, thank you very much for attending this conference. I hope you enjoyed the session despite the very tight schedule. We know it was quite an heavy day. I wish you a pleasant stay in Abidjan if you're visiting, and if not, just have a good end of day. Thank you very much.